very warm good morning to all our audience out here with this lovely rainy morning. I'm very sure everybody has come on time. Thank you very much. We are just a couple of minutes away from starting the event. We have had a bustling start with registrations, and some housekeeping rules before we proceed. We request everyone to keep your mobile phones on silent mode, and please be seated too. I wish everyone a warm morning again. Thank you very much to be with us in this lovely raining morning. I know Mumbai's traffic is manageable, right? Thank you. So we welcome you to the third edition of the Modern BFSI Summit. I'm Lavanya, your host for today. The theme for this year is decoding inclusive growth. It involves around unraveling the strategies and mechanisms that enable economic prosperity to reach all segments of society, particularly those historically marginalized or underserved. This concept encompasses several key principles, and we will discuss this over the course of today. We will talk about financial inclusion, equitable access. We will talk about inclusive economic development. We will talk about technological advancements, yes, policy and regulations too, and sustainability. Over the course of today, we will have keynote addresses, fireside chat, and we will also have some panel discussions. Before we proceed, I would like to give a heartfelt gratitude to our sponsors and partners who have made this event commendable. And they are the supporting partners of Adani Connects, Cyril Amarchand Mangaldas, Pay with Ring, STT GDC India, and Utkarsh Small Finance Bank. We have a knowledge partner as IAS Sati, and our exhibition partners are Notify Visitors and Live Long. I'm sure these sessions that we have lined up today will tickle your thoughts, and we encourage you to join the conversation on social media with the official tag as FE Modern BFSI. With further ado, I start the program, and let's kick started with a special welcome address from Mr. Anand Goenka, Executive Director of the Indian Express Group. Over to you, Mr. Goenka.
Thank you. Very warm welcome, ladies and gentlemen. Since I have the pleasure of introducing Dr. Das today, I can't resist a small cricket reference. You know what made the World Cup victory so special for me was the fact that nice guys won. Which is not to say that the South African team aren't nice, but what I mean is that Rohit Sharma and Rahul Dravid won. Because if you think about it, in whatever field, business, politics, or sports, generally the gentlemanly nice guys aren't winning very much. I think the message going out from around the world in every field is that to win, you must be hyper-competitive, hyper-aggressive, egoistic, and a bully. Just compare the public image of any founder of industry in any part of the world to all the tech founders we meet today. Don't get me wrong, aggression and competition is welcome, but a day after the Trump-Biden debate, it was nice for the world to see two gentlemen win, Rohit Sharma and Rahul Dravid. Another gentleman who has been winning and representing the nice guys is Dr. Shaktikanta Das. He's in his 6th year. He's in his 6th year, already one of the longer-serving governors, who has seen Indian economy and the BFSI sector through wars and pandemic. I get PTSD when the word COVID comes up, so I won't spend much time there. But we came out post-pandemic hitting a 666 number for inflation, GDP growth, and interest rates. Last year, our GDP grew at 8%. We're projecting 7.2% on that high growth base this year. Repo rate 6.5%, inflation's 5.1%. Yesterday, our markets touched an all-time high. I haven't had time to see what they opened today. So I think in no small part, we are sitting at the center of the world's attention today because of the work of the governor, who has played a very constructive, level-headed regulator. The news of the past few days itself shows that he continues to play his favorite Rahul Dravid-style innings, especially when it comes to technology. He's taken strong positions in the interest of citizens and consumers on safety data leaks by fintechs. He's moved fast on India's digital currency. He has high-tech enabled RBI, which now uses AI and ML for its own data monitoring. And even outside the tech space, over his 6-year tenure, he has brought back gold from the UK. He's helped banks buy oil from Russia, bypassing the USD. He successfully ensured the turnaround and isolated the fallouts of the collapse of at least one significant private bank and 2 large NBFCs. And no matter how large the private bank or the payment bank is, Dr. Das has taken strong positions towards safety without compromising on growth. It's for all these and very many more reasons that he was even awarded the globally prestigious Governor of the Year in 2023. So we're excited to hear from him today, and we have a fantastic lineup of speakers that I'd like to congratulate my colleagues at Financial Express for inviting and thank them all for being here. I'd like to thank our sponsors and our partners. And speaking of sponsors, I get the feeling that I'm being the unskippable ad playing while your favorite batsman is going to be on strike. So I'll quickly end this welcome note and forgive my forced cricketing metaphors, but whenever I see Dr. Das, I think of cricket, so I have to, so excuse me for that. So with great pleasure, please let me welcome Dr. Shaktikanta Das, 3rd annual Financial Express BFSI Summit today. Dr. Das, thank you so much for making the time. Please join us and give us your note. And since we have said so many nice things in classic Express style, our editor is going to have a fireside chat with you with some tough questions. Sure.
Yeah, there's a lot of moisture in the air, so naturally the ball will take a lot of swings. So I think your editor will probably put some reverse swings also. But thank you for those nice comments, pun intended. I'm extremely delighted to be here. You mentioned about that this is the 3rd one. I have a prepared speech. I will go through it. In between, of course, I will deviate and speak. And looking forward to the fireside chat and the questions from the FE team, as well as from the audience, if there are any. Shri Anand Goenka, the entire editorial, organizational, and the entire team from the Financial Express, distinguished members of the audience, ladies and gentlemen, good morning, namaskar. I'm happy to be back at the Financial Express Modern BFSI Summit. I remember having participated in this event in June 2022, where I had spoken on disruptions and opportunities in the financial sector. The macroeconomic conditions back then were quite different and challenging, to say the least, as we were grappling with the overlapping shocks from the war in Ukraine and the surge in inflation at a time when the world was still recovering from the impact of the COVID-19 pandemic. Since then, we have come a long way. Amidst global challenges and uncertainties, today India stands out as a fast-growing major economy with stronger macroeconomic fundamentals and a healthy and resilient financial sector. The theme of today's summit, Decoding Inclusive Growth, aptly captures our combined aspirations for high growth with inclusiveness. During the next decade and beyond, the financial sector is expected to grow and play its role. This sector is a key enabler for the realization of our aspirations. With India's strong macroeconomic configuration, favorable demographics, and significant pace of digitalization, the Indian financial sector is poised to scale new heights. The recent annual financial results of banks and NBFCs indicate that the financial system remains sound and resilient. Further, macro stress tests conducted by the Reserve Bank reveal that the banking sector will continue to remain resilient even under stress scenarios. And the same applies to the non-banking financial company, that is the NBFC sector also. Now, in terms of market dynamics, the financial landscape in India is undergoing a structural transformation. And this transformation is primarily driven by factors like innovations in technology, financial deepening, and changing savings and investment patterns. Each of these shifts has a bearing on how financial entities carry out their business and adapt to the emerging risks. New and emerging technologies have reshaped the financial services industry by bringing in innovative solutions and personalized products. The demand-side factors such as rising consumer expectations for digital services and supply-side factors relating to regulatory support and emergence of fintechs have converged to drive a frictionless customer experience. The Reserve Bank has also been actively fostering innovation by envisaging mechanisms like the UPI, the regulatory sandbox, co-lending models, account aggregator framework, and several other similar initiatives. With the synergies provided by mobile phone penetration, internet availability, reoriented payment systems, and the multitude of customer data points, lending institutions as well as financial markets have been able to leverage upon such mechanisms to amplify their reach to the largest segments and also carry forward the agenda of a more inclusive financial sector. Overall, there has been a transformation in the banking and financial landscape in the last decade, which is driven by technological innovations, changing consumer preferences, and emergence of alternative business models. While these have fostered competition and collaboration, they have also implications for consumer trust and regulatory oversight. Such structural changes also create opportunities as well as challenges. Financial institutions like banks and NBFCs and others need to carefully assess the impact of these changes on their business models and on their resilience and sustainability. As Walter Weghorst said, adventure is the life of commerce, but caution is the life of banking. I repeat, adventure is the life of commerce, but caution is the life of banking. These words are relevant even today. As I have stressed in various fora, good times often sow the seeds of complacency and vulnerability. In my address today, I would like to present my perspective on some of the contemporary issues and emerging risks that banks and other financial entities need to address in today's context. There are 9 specific issues which I would like to highlight. The first one relates to loan and deposit growth. Let me first upon the current divergence between loan and deposit growth rates. It goes without saying that there will always be some gap between the two. But credit growth should not run ahead of deposit growth by miles. More so when banks are required to maintain CRR, SLR, LCR, etc. It is, of course, recognized that almost every loan creates a new deposit in the borrower's name or adds to his account balance, to his or her account balance. In other words, money begets money in the banking system. But the fundamental point is that there has to be a reasonable balance between credit and deposit growth. As I just mentioned, deposit mobilization has been lagging credit growth for some time now. This may potentially expose the system to structural liquidity issues. While there could be a debate regarding deposit funding loans vis-à-vis loans funding deposits, The current regulatory concern stems from the fact that there could be structural changes happening which banks and NBFCs and other lenders need to recognize and accordingly devise their strategies. Household and consumers who traditionally leaned on banks for parking or investing their savings are increasingly turning to capital markets and other financial intermediaries. While bank deposits continue to remain dominant as a percentage of financial assets owned by the households, their share has been declining, with households increasingly allocating their savings to mutual funds, insurance funds, and pension funds. To be precise, households are increasingly turning to other avenues for deploying their savings instead of banks. On their part, banks have sought to fill the credit deposit gap by increasing their reliance on other sources like short-term borrowings, certificates of deposit, etc. This increases their sensitivity to interest rate movements and poses challenges to liquidity management. The shift in deposit preferences from current account and savings account deposits, that is, CASA deposits, has various implications which banks need to keep in mind. With credit growth remaining strong, banks need to continuously focus on improving and refining their credit underwriting standards and pricing of risks. The second point I wish to highlight, which arises from the first point, is management of liquidity and interest rate risks. The 2023 banking crisis in certain advanced jurisdictions have brought to focus the risks of banking stability from certain business models and their inherent vulnerabilities. These incidents have also, I'm referring primarily to the banking crisis which we saw last year in 2023 in the United States and also in Switzerland. Now, these incidents have also triggered debates and rethink at the global level about design and calibration of the Basel III liquidity standards, deposit insurance, and resolution tools. Hence, it is imperative that our banks put in place prudent liquidity management measures proactively. It has to be borne in mind that incorrect valuation of liquid assets can give a false sense of short-term liquidity resiliency, which is not desirable. And whatever I am saying with reference to banks would be in a large measure relevant for NBFCs also. Now, the Reserve Bank, on its part, is reviewing the liquidity coverage ratio framework, that is the LCR framework, to address the emerging issues. This will be done after detailed public and stakeholder consultations. We will be putting in place a discussion paper or a draft circular and inviting your comments and comments of all stakeholders before taking a decision. In fact, that is the consultative approach which we have adopted in our regulatory actions in the recent years. In the latest annual report for the financial year 23-24, which we published in the month of May, there is a separate box item, and in the annex it has been listed, we have listed out the number of regulatory measures which were taken by the Reserve Bank and which were preceded by consultation with stakeholders. Interest rate risk is inherent to the business of banking. It goes without saying. Last year's banking crisis in certain countries, as I have said, have also shown the importance of managing interest rate risk in the banking book. The books of banks are highly sensitive to interest rate fluctuations. It goes without saying that banks need to manage their interest rate risk exposures using processes and symptoms commensurate with their business models, risk profile, earnings and capital levels, complexity and scope of their operations. The third point I wish to highlight relates to cybersecurity and IT-related risks. In an era of increasing technological footprint and rapid digitalization, it is critical that due emphasis is placed on managing cybersecurity and IT risks. Globally, there are growing incidences of cyber attacks on the IT systems of banks and other financial institutions. This necessitates high level of vigil and strengthening of the IT systems by banks, NBFCs, and other financial institutions. The Reserve Bank's supervisory assessments continue to stress on the importance of improving information technology governance arrangements, making the technology systems, processes, and infrastructure more resilient, and mitigating the third-party risks. Banks and other financial entities need to continuously invest in technology while also developing the right kind of capabilities to successfully tackle these challenges. In fact, one can even go to the extent of saying that going forward in a few years, the convergence between technology and on one side and the banks and NBFCs on the other hand, there will be greater convergence, and banks and NBFCs, to remain competitive, have to adopt technology, have to invest not only in technology infrastructure, but also invest in building up internal human skills and capabilities. The fourth point I wish to highlight relates to digital frauds. Another area of concern is the rise in digital frauds. Though many of such frauds are due to various social engineering attacks on customers, there is also a rapid increase in use of mule bank accounts to perpetrate such frauds. This exposes the bank not only to serious financial and operational risk, but also to reputational risks. Banks therefore need to strengthen their customer onboarding and transaction monitoring systems to monitor unscrupulous activities, including suspicious and unusual transactions. In fact, this is a point which we specifically discussed with the bank CEOs in the first week of this month, when we had interaction with the CEOs of both public and private sector banks. And it is necessary to monitor the transactions are being undertaken in various accounts. We have come across cases where an account, the volume of transactions is very less for a long time, but suddenly there is a spurt in the volume of transactions. There are also transactions taking place at odd hours, in late hours of the night. Now, systems have to be built in, and I'm happy to note that banks are putting in place the required systems to monitor these kind of transactions which are happening, because they are potentially risky, and it has to be really seen why suddenly an account which was doing very few transactions and the balances or the account balance was low, suddenly how the balances go up, come down, there are fluctuations and there are too many activities and at very odd hours. This also requires effective coordination with law enforcement agencies so that concerns occurring at the systemic level are detected and curbed in time. The Reserve Bank is working with the banks and law enforcement agencies to strengthen transaction monitoring systems and ensure sharing of best practices of control of mule accounts and prevention of digital frauds. I would again impress upon banks as well as NBFCs and other financial institutions to ensure that necessary measures are taken, including for customer education and awareness, to maintain public confidence in the use of digital banking, in the use of technology in our financial sector. The fifth point I wish to highlight relates to third-party risks. In the current business environment, it has become necessary for banks and other financial institutions to outsource certain functions to third parties. While doing so, it is necessary to exercise strong oversight and monitoring of such outsourced activities. Regulations clearly provide that outsourcing of any activity by a regulated entity does not diminish the obligations of the regulated entity itself. Banks and NBFCs also need to consider whether cost optimization strategies are leading to overdependence on third-party vendors, even for critical functions, without commensurate oversight. We have seen a few instances of this and have dealt with it in the recent past. Strong governance and oversight mechanisms with regard to third-party relationships for both IT and non-IT services are essential components of resilience for any financial institution. The protocol with the outsourced agency should clearly define the roles and responsibilities of both the parties in such relationships. The Reserve Bank has already issued guidelines on IT outsourcing and draft directions on managing risks and code of conduct in outsourcing of financial services. The sixth issue relates to issues in unsecured retail credit. Now, I have attempted to highlight all the contemporary issues and touch upon them as briefly as possible. A copy of this address will be uploaded in the Reserve Bank of India website. So those of you, as well as your viewers who are watching this program online, you may have a look at this if you wish. Now, with regard to unsecured credit, I would like to say that the rise in the share of retail portfolio within the overall bank credit is a recent system-wide trend. As you may be aware, the Reserve Bank has taken certain preemptive measures in November last year to ensure that growth in these segments does not lead to potentially excessive risk buildup. These measures appear to have led to a certain degree of moderation in the targeted segments, as observed in our recent financial stability report. It needs to be emphasized that the delinquency levels and leverage in small-ticket consumer loans warrant enhanced vigil. Matters such as fixing limits on unsecured exposures are left to the banks and their boards. It is also left to the boards or the management of the NBFCs. It has, however, been observed by our supervisory teams that in some entities, it is noticed that some entities have fixed very high ceilings, even where they have already a high exposure. While it is not our intention to be prescriptive on such matters, banks and NBFCs are expected to show prudence and avoid any form of exuberance in the interest of long-term sustainability of credit growth and in the interest of long-term resilience and health of the concerned bank or the NBFC or other lenders, as the case may be. The seventh point relates to conduct-related issues. Fair conduct is not just a regulatory requirement, it's a core business requirement. I'm emphasizing on this issue because conduct risks may arise when the going is good, as it prevails now. Conduct risk needs to be seen together with risk culture. Fair conduct and practices foster consumer confidence and public trust in financial institutions, and they also strengthen their resilience and stability. The Reserve Bank has issued regulations from time to time to ensure fair and reasonable conduct by the regulated entities. In the recent past, guidelines have been issued on key fact statement. You would be aware that every loan we have mandated should be accompanied by a key fact statement which captures, broadly the significant material aspects of the loan, including in particular the annualized rate of interest. So guidelines have been issued on key fact statement, on penal charges in loan accounts, on reset of floating interest rate in EMI-based personal loans, and release of movable or immovable property documents on repayment or settlement of loan accounts. We still come across instances of regulatory entities resorting to high-handed recovery practices, framing non-transparent loan contracts with inadequate disclosures of important terms of non-disclosure of charges, levying excessive interest rates, especially in microfinance loans. Now, let me say that what I am pointing out, I would like to emphasize that what I am pointing out are cases are outliers. Overall, I can assure you, and I would like to emphasize and stress that overall, our financial sector, consisting of banks, NBFCs, and other entities, overall, they remain robust. Overall, there has been considerable improvement in governance, in risk management, in compliance, or in discharge of assurance functions in all these financial entities in the recent years. But we still see outliers here and there, which has to be, and in those entities, it is our endeavor to see that, compliance is ensured, there is better risk management, and there is, improvement in their governance. So overall, it should not be assumed that there is a big problem. Overall, the system remains very stable and healthy, but there are outliers, and what I am addressing is those few cases which are outliers, which have a potential to sort of, spill over to other entities also. Now, critical issues relating to conduct sometimes get sidestepped in the pursuit of short-term gains. For instance, charging of very high interest rates by certain regulated entities, especially for microfinance loans, is not in order. I would like to reiterate what I said in my monetary policy statement on June 7. That is, regulated, and I had said, regulated entities should use their regulatory freedom responsibly to maintain fair and transparent pricing of small value loans. Unfair or usurious practices under microfinance loans would compel us to have a relook at the revised regulatory framework for microfinance loans, which were issued in March 2022. The eighth point relates to transition financing. Climate change poses a growing threat to economic growth, and it needs immediate and sustained action on all fronts. Recent extreme weather events globally and also in India, such as heat waves, droughts, floods, and wildfires, are stark reminders that we have to take decisive actions. The Reserve Bank has initiated steps to address the risks posed by climate change to the financial system. Since we commenced this journey, several initiatives have been undertaken, which inter alia include issuance of framework for sovereign green bonds, acceptance of green deposits, and issuance of draft disclosure framework for climate-related financial risks. Going forward, our overarching approach would be to consider sustainability aspects as a focal point of the entire credit ecosystem. The onus of spearheading sustainability initiatives will, however, reside with regulated entities eventually. These entities have a crucial role to play in climate action by taking steps to provide climate finance. They need to explore innovative transition financing models. At the same time, they should also be mindful of associated risks and greenwashing concerns. In addition, the regulated entities may undertake transition planning to prepare for risks and potential changes in the business models of their borrowers who may undertake such transition. The ninth and the last point I wish to highlight relates to private credit markets. Private credit as a preferred alternative mode of capital mobilization is growing rapidly. It is emerging as an attractive investment avenue for investors with high risk appetite. While these markets may carry economic benefits by providing a greater pool of financing outside of regulated financial markets and institutions, and their risks appear to be contained at present, it is important to bear in mind that vulnerabilities and interconnectedness in these markets can amplify negative shocks and pose financial stability concerns. We continue to remain watchful of such developments and would welcome ideas and thoughts in this regard. In conclusion, I would like to emphasize that banks and financial institutions, NBFCs and others have a critical role in taking India to the next phase of economic growth. Regulated entities of the Reserve Bank like banks and NBFCs are well positioned today. I would like to emphasize regulated entities of the Reserve Bank like banks and NBFCs are well positioned today in terms of capital, asset quality, and profitability to contribute to the economic acceleration which we are expecting in our country. Embracing technology and innovation while remaining focused on governance and risk management can ensure sustained capacity and resilience of the financial sector and enable it to meet the needs of our growing economy. While much has been achieved, there is still more to accomplish. With these words, I thank the Financial Express team for giving me this opportunity and wish the summit all success. Thank you. Namaskar.
Thank you, sir. We appreciate your profound perspectives on the future of India's economy and the financial sector. May I invite Mr. Shamal Majumdar, the editor of Financial Express, to join us for a fireside chat? Mr. Prakash, over to you.
So, Governor, you referred to some reverse swings coming your way. But, a governor who plays with such a straight bat, it's difficult to, instead the bowler gets hit out of the park. But I have a tough job on hand because the governor is sitting with me and I'm been told to watch the clock because there is a time constraint. So let me be as quick as possible. Governor, my first question to you is, India needs to, according to RBI's own research paper, India needs to grow at about 7.6% annually over the next 25 years to become a developed nation. Now, to fund that kind of growth, the financial system has to be well capitalized. There has to be a lot of new financial institutions also coming in of all shapes and sizes. Given that background, is it time for the RBI to shed its hesitance, or I should say reluctance, to allow business houses, private equities, venture capital funds to have larger stakes in banking entities? Your views?
You see, banks are different. We have articulated on this issue a number of times. Banks are different. They're different from other businesses. Experience world over has shown that real sector companies, when they enter the banking space, there are potential conflicts of interest, and also the issue relating to related party transactions also is a major issue. And we had in our country, we had several private banks earlier. Of course, I'm not going into the issue of bank nationalization, why it was done and what was the outcome and all that. But there are there are potential conflicts of interest, and experience world over has shown that it will be very difficult to, monitor or to regulate the, to sort of prevent the related party transactions. So the risks involved are very high. So therefore, world over, although there is no specific bar on, take the case of United States, for example, or take any other country, emerging market economies, it has not been done. And there are good reasons why it has not been done. So far as India is concerned, the banking penetration has been quite wide. Today, the number of banks, the number of bank branches have become less relevant. I will not say irrelevant, but they have become less relevant. Because technology is achieving that for you. The reach is being achieved through technology. The reach, the customer reach and the reaching the, the far-flung areas is being achieved through technology. It is also being achieved through several new business models. Take, for example, the BC model, the banking correspondent model, or the handheld payment equipments which they carry. So therefore, what India needs is not proliferation in the number of banks. What India needs is sound banks, healthy banks, well-governed banks, which we feel will be able to mobilize savings throughout the country through technology, which will also be able to meet the credit requirements throughout the country through technology. And you have new players, especially in the NBFC sector, who are entirely, digital lenders, for which the Reserve Bank has come out with detailed guidelines. Having said that, I would like to say that we are open to receiving new applications for setting up universal banks, And as and when an appropriate fit and proper application comes, the Reserve Bank will not hesitate. I'm not implying for a moment that the today's number of banks is enough and no more license will be granted. That's not, by any stretch, I'm not suggesting that. All that I'm saying is that if applications are received, we will certainly examine and take a call.
But at this point, your RBI is ruling out entry of business
At this
house.
point, there is no thinking in that direction.
Right, right. Your predecessor, Mr. Subbarao, in his book, both of you have worked both in the government as well as the RBI. Now, in his book, and I quote him, he says, there is little understanding and sensitivity within the government on the importance of central bank autonomy. He also wrote that he was invariably discomfited and annoyed by this demand that the RBI should be a cheerleader for the government. Now that you have spent 5.5 years most in RBI, the central bank governor, and especially it is important because you came in at a time when there was a huge tension between the two institutions. What has your experience been, and how do you respond to the fact that there is always this demand on the RBI that you be a cheerleader for the government?
No, nobody expects RBI, at least I am saying from my experience, nobody expects RBI to be a cheerleader. I have had no such experience. And the coordination between the central bank, that is RBI, and the government during crisis times like the COVID, were, I think, very smooth, and it was the coordination and cooperation between the fiscal and monetary authorities which ensured that our economy revived, and revived very fast and revived stronger in the aftermath of the COVID-19 pandemic. There have been differences of opinion, because differences between fiscal authorities and monetary authorities, between government and central banks, are inherent in the system. There are bound to be differences because it is inherent. But what we have done is to sort of discuss this directly between the government and the Reserve Bank, and whenever there are differences of opinion, they have been internally discussed and they have been resolved.
Now, on interest rates, the invariable question on interest rates, the minority view in MPC was that as interest rate trend downwards, the real repo rate goes up, so long as the RBI holds the line. Second, growth may be sacrificed on account of interest rates staying higher for longer. Then there is the Fed chairman saying the other day that he will not wait till inflation reaches the 2% level. We also heard a BIS official saying that while inflation target should be a guidance for central banks, it should not become an obsession. Now that you have already said repeatedly that you are focused on a 4% sustained inflation rate, but that is not visible at this point of time. So would RBI be open to reconsider its stance?
You see, first thing I want to clarify is that BIS report, quoting a certain BIS official, he has been actually quoted out of context. When he said that, what was that sentence you said?
That, while interest rate should be a target should be a guidance, it should not be an obsession.
Yeah. He said it in a different context. I have read that full article. And he said it in a different context. What he meant is that just because you reach the inflation target, it doesn't mean that you start cutting rates. He was saying it from that perspective. So the first part of his sentence says that, the target is not very sacrosanct. It doesn't mean that once you,
Yeah.
So therefore, what he meant is that just because you reach the target, don't start cutting the rates. So he was saying in a different way altogether. In fact, I would suggest that that article is read in totality, because what he is arguing in that article is exactly the opposite. He is saying that inflation targeting is very important and central banks should stay the course. Now, with regard to growth coming nearer home, with regard to India, with regard to growth sacrifice, we monitor the growth numbers very carefully, and I have said it on a number of occasions, because the law in our country, the Reserve Bank of India Act, says that Reserve Bank is mandated to maintain price stability, and price stability in terms of maintaining inflation at 4%. So we are mandated is to maintain price stability, keeping in mind the objective of growth. So in all our monetary policy decisions, growth aspect is always kept in mind. And I can say that even with the current interest rates, the growth in India has been very robust. Last 3 years, the average growth rate has been 8.3% in the last 3 years. This year, our projection is 7.2%, and we are very optimistic that 7.2% will be achieved. In fact, the nowcasting team of the Reserve Bank, and it has been published in the State of the Economy Bulletin article which we released yesterday, the nowcast team of the Reserve Bank believes that the first quarter growth, that is April to June growth, is 7.4%. Although our internal, what MPC said was that it is 7.3%. And we see even today the growth momentum in the second quarter continues to be very strong. The fourth quarter of last year was 7.8%. The first quarter, the numbers will be released in the end of August. And end of August. So the first quarter of this year, the momentum of economic activity is strong, and we see clear evidence of that momentum being sustained in the second quarter also. So growth is holding steady. Now we have to therefore focus clearly and unambiguously on inflation. And this talk of, neutral rate, etc. In fact, another bulletin article by our researchers yesterday have shown that now that, that earlier neutral rate of 0.8 to 1% was immediately in the aftermath of the COVID pandemic, when potential growth was low. But now that the impact of COVID is well behind us, the potential growth is now gone up, and the neutral rate of interest is now pegged in the range of 1.5 to 1.9%. So even if you were to argue that the real rates are high, it's not so, because the real rates, the range is 1.4 to 1.9. And also the point is, I have said it again a few days ago, what is our target? Our target is inflation. And what are we supposed to keep in mind? We are supposed to keep in mind growth. We look at all aspects that are happening in the economy. We look at international developments. We also look at real interest rates. It's not as if we don't look at them. Finally, we take a call. The target is inflation. The target is not neutral rate of interest. So therefore, a neutral rate of interest, again, is subject to a lot of uncertainty. It depends on your assessment of potential growth versus my assessment of potential growth, or versus somebody else's assessment of potential growth. So target is inflation. Monetary policy has to be geared to achieve that, keeping in mind the objective of growth. Neutral rate, etc., are theoretical, abstract concepts that cannot determine policy in the real world.
I'm
sorry for those long answers.
No, it's perfect. There has been a series of actions against NBFCs, banks, and other institutions for non-compliance. Are you worried about this overall culture of non-compliance? Do you think too many institutions are taking unacceptable risks?
No, let me emphasize, as I just did a little while ago, that it is not so. There are outliers. Totally, if you look at, we have about 90 odd banks. We have about 1,400 odd urban cooperative banks. We have about 9,400 NBFCs. Now, all these are lenders. If you put together, it's about 11 or 12,000 banks and NBFCs and cooperative banks also. Out of that, we have taken action against maybe 4 or 5 or 6. And after 6 months or after 8 months, when there is compliance, we withdraw the business restrictions which we have imposed on them. So action has been taken only against about 5 or 6 or 7 entities out of this universe of 11,000 odd financial entities. So therefore, I think it's not correct. I think I want to dispel that sense that Reserve Bank is chasing and going all out to we don't play a 20-20 game. I mean, we are there in Test cricket. We have to be steady in our approach. We engage with wherever, and these are outliers. Let me very clearly say, these are outliers, very few outliers. Whenever we see such problem, our first effort is to engage with them bilaterally. We engage for months and sometimes more than a year also. But where we see that the compliance is not happening, or the compliance is slow, or it is not adequate, there we have to impose business restrictions, because the idea is not to penalize them. The business restrictions are imposed in the interest of the customers. Because if the business grows, when there is an inherent problem, eventually the customer is put into difficulty. So all our actions have been taken in the best interest of customers' interest. So therefore, we take action after months or after more than 1 year of engagement with the entities wherever we take, and these are only very few cases. Overall, the system remains very resilient and very strong.
Governor, the union budget is just about 3 days away now. Now, while the GDP grew at about 8%, over 8% actually in FY24, the domestic consumption growth is half of that, 4%. So what would you like to see the fiscal authorities do on that?
You see, it's not proper for me to comment on the budget, especially because it's just, next week. So I don't want to comment on the budget. But so far as consumption is concerned, I would like to say that urban consumption has been doing well for quite some time. In fact, immediately after the COVID, urban consumption has revived very well. But I think in the last few months, we have seen rural consumption also to have picked up. And we are very optimistic about rural consumption, because the monsoon this year is doing well, is expected to do well. Agriculture is expected to do well. The crop sowing so far has been very satisfactory. So therefore, the agricultural production is likely to be high, and that will put more hands in the hands of the rural people. Quite naturally in this season, and because of monsoon and because of good agricultural, output, the demand on Narega has also come down. Then so far as, FMCG sales, for example, the FMCG sales over the last few months in the rural sector have actually outpaced the urban FMCG consumption. So we are quite optimistic about the rural consumption, to have picked up. So consumption is picking up, and certain measures like, for example, the free rice scheme is leaving that much more money in the hands of the rural people to spend on their other consumption. And inflation, the whole idea of bringing down inflation is that to reduce the burden on the people, both urban consumers as well as rural consumers. So if you measure, today the inflation is at 5.1. So just measure, quantify, if the inflation goes to, let us say, 4%, that 1% difference and that 1% additional money which will be available, if you just try to extrapolate on that basis, how much of surplus will be left in the, disposable surplus will be left in the hands of the people, which they are going to spend on the economy. I think the contribution to the growth will be enormous. So therefore, inflation management, a stable inflation at 4% will be the biggest contributor to our GDP. And we are moving towards that. This latest print, which went up again to 5.1, vis-a-vis the earlier number of 4.75, was mainly caused by the vegetable prices. Past experience shows that they have been seasonal, but we have to see how this year plays out.
I want to just have a couple of more questions. Banks or financial entities' exposure in unsecured lending, personal loans, even project finance, has come under RBI's attention because of rising bad loans. But if you look at the numbers in March 2024, loans to agriculture sector, the bad loans were the highest, and then came industry. Do you think, is there a need to explore raising the provision requirement for agriculture loans so that banks can price it effectively?
If I remember correctly, subject to correction, with regard to agricultural loans, the latest GNPA figures are about 6.5%. I think that was March 24.
24, yeah.
Yeah, it was about 6.5%. 3 or 4 years ago, it was 10%. So it has come down. And I would not like to comment on any specific sector, but I would just like to draw your attention to the expected credit loss framework, which we have, the draft of which we have put in place. It's a draft which we have put in place in the public domain. We are getting the comments. Based on that, we will issue the circular on expected credit loss. So when that circular is issued, it will address all such problems of, any higher NPA or risk buildup in any particular sector, not just agriculture, but in every, wherever it is visible. But today, as you are aware, the GNPA levels are at a historic low. The bank's GNPA is 2.8%. So far as the NBFCs are concerned, it is at about 4%. In fact, if you take out the, the NBFC loans which are under resolution in NCLT, etc., the, the GNPA is less than 3%. And, or around, about less than 3%. So therefore, I think overall, the problem of bad loans is now well contained, but we have to remain there. That is why, we keep on giving all those cautionary advice. It's not as if there is a big problem and we are worried and we are trying to deal with it. It is basically the current times are good times. We don't want the bad times to come back. We want the good times to last, and we want the good times, to put it in a metaphorically, we want the good times to become even better times.
Right. Governor, you love cricket, so this the question is that one of your favorite cricketers, Rahul Dravid, he loved playing test matches. Now, but as the RBI governor and given the volatility in the external world, you must be forced to play T20 cricket almost every day. How do you cope up with it?
Well, first of all, I would like to say that whatever, Anant Goenka just said all those nice things about me. But whatever we have been able to do, I must say very clearly that it is the outcome of the effort of the entire team at the Reserve Bank, the entire team in the Reserve Bank of India. I cannot corner all the credit to myself. We have a good, robust team in the Reserve Bank. So it is the entire outcome of the entire teamwork. So modern times have become much more uncertain, much more, there are new challenges coming every day. And so therefore we have to deal with it. I think, I don't want to be philosophical, but I think the principle is to maintain your cool. And I think the word Captain Cool has been mentioned about Dhoni. So the approach has to be a mix of Captain Cool, Dhoni, and Rahul Dravid's approach. But having said that, let me say that both the cricketers did not play to draw the game. They played to win the game, and I think both of them have won the game. So that's our commitment. That's our endeavor.
Finally, Governor, your this term ends in December. I would want to say whether are you open to another stint as RBI Governor?
I don't know, as December 10th is approaching, I think I'm increasingly confronted with this question. But honestly, I'm really focused on my current work, and I said it elsewhere also. I'm completely focused on my current work, and I don't think, anything outside that. So focus remains on the current work. And what will happen in the future, one has to deal with it as and when the situation arises. I mean, why do I sort of worry about that? Let me first focus on the ball which I am now playing.
Yeah. We'll invite a couple of questions from the audience. Yeah, Shobna.
So, Governor, it on? Yeah, Governor, you spoke of private credit. So much like, when the fintechs came in and they were lending, the RBI did move to put in some rules because it is important to understand the interlinkages, especially of smaller units, because the banks must know who the other lenders to that client are. Otherwise, there will be one borrower will be borrowing from many lenders. So is the RBI working on some rules for private credit players, just like you rolled out rules for fintechs?
Thank you. Now, private credit, many segments of private credit are really under the control of the SEBI. And we are engaged with SEBI on all these issues. You have venture capital funds, you have equity funds, you have AIFs. So there are many segments of this private capital, and most of it is under the regulatory jurisdiction of the SEBI. So SEBI will take a call. But in each of these areas, whenever we have any ideas or thoughts, we share them with the SEBI. And we discuss with SEBI, and SEBI will have to come out with this, the required guidelines. But we are watching this, the evolution of this sector very, very closely. And as of now, there is no, whenever for example, the AIF, there were certain issues relating to the AIFs, both the SEBI and the Reserve Bank, we took certain measures, and we have issued certain instructions. SEBI has also taken some measures. Our endeavor is to ensure that all these segments play their important role. They have an important role. AIFs or venture capital funds or equity funds, HNI is giving, venture fund for doing venture funding, startup funding. All these things have to be there, and they will grow in the years to come. So intention is not to stifle them or not to create impediments. Intention is to ensure that they function in a manner so that there are no undesirable spillovers or there are no undesirable, negative consequences so far as the overall financial stability is concerned. But most of it, as I said, is within SEBI's jurisdiction, and we share our thoughts with SEBI. I have also mentioned that we welcome, because this is a growing area, so we welcome any suggestions and or thoughts in this regard.
Good morning, Governor. Thanks for your address, and lucky to listen it today on a historical anniversary of a historical day when the banks were privatized 55 years back. Myself, Pawan Goel, I am doing my PhD from IIM Indore. My question on your point about lagging in the deposit growth versus the credit growth. When you compare India versus US, when we see the number of banks taking the deposit in US being around 4,000 versus in India, how do you see that scenario is much different in India? Why India can't have a large number of banks taking the deposit, hence contributing into the deposit growth?
No, as I said, the reach is wide. We have Reserve Bank has, please sit down. We have, we have the small finance banks now, and the small finance banks are growing at a very fast pace. And there is also a framework provided for transition of the small finance bank into universal banks. They have to comply with certain requirements. What is the framework under which the Reserve Bank will allow the small finance banks to transition into full-fledged universal, full-service, universal banks? So therefore, the total number of banks in India, as I said, is about 90 odd. To that, you must add the urban cooperative banks also, because they're also providing credit to the bottom of the pyramid. And basically, urban cooperative banks are, what is called the bank of the, they are the banks of they're basically neighborhood banks. And the urban cooperative banking sector, I am happy to mention and report here that, again, thanks to the actions of, the coordinated action between the Reserve Bank as the regulator and the Reserve Bank as the supervisor with the urban cooperative sector, the overall health of urban cooperative banks has improved, and in terms of various performance parameters. So therefore, US had a long history and of a large number of banks. India, I feel, number of banks is not the solution, because the corpus of domestic household savings is the same. So too many banks doesn't mean that the household's financial savings will increase. Household financial savings will increase because of so many other factors. I alluded to, some of these savings moving away from the banking sector to, other financial instruments. But of course, when it goes to other financial instruments, it does come back to the banking system in somebody's account. But the point is, the preference of households to park or to invest their invest their savings is shifting to other areas. That is shifting from banks to other areas. So to come back to your main question, India, I think, has got sufficient number of banks. If there are new applications, we will examine them. And the point is, the household financial savings, there is a certain amount which will grow due to other factors. It will not grow because there are more banks. And in any case, we have the whole, universe of the urban cooperative banks and NBFCs, small NBFCs throughout the country, this 9,400 of them, which are meeting the credit requirements of the bottom of the pyramid.
And then the last question, please. Yeah.
Good morning. Sir, just yesterday we saw, one of country's largest crypto exchange. Half of their assets were actually hacked, 230 million of it. Crypto, sir, crypto. One of the leading exchanges lost half of their asset, 230 million. How are we looking at this? Does this has the potential to, cause a financial crisis in the crypto world? And sir, separately also, the June WPI hit around 16-month high. CPI, again, like you mentioned, because of food inflation was at 5.06. Does this mean that, the elephant is not going to the forest and we'll have to, in FY25, do you rule out the rate cuts?
You see, with regard to this crypto, I think I have articulated sufficiently in public domain earlier. The Reserve Bank's position remains the same. So I don't want to add anything because I guess, I suppose all of you would be aware of the Reserve Bank's position. What I have been articulating, that position remains the same. And we see it as a big risk to financial stability, this whole cryptocurrency thing. I have nothing more to add. With regard to WPI and its spillover and its impact on the CPI, we are very watchful. And WPI also, the food component has gone up. So it is the food inflation today which is the main, cause of, which is drawing our greatest attention, because that is actually giving the push to the headline numbers, because core inflation as well as fuel inflation are quite low. Core inflation is 3.1%. So therefore, WPI and its spillover, we are very watchful of that. Food inflation is the worry. And you asked about the elephant. The elephant is overall moving towards the forest, but it's taking pauses. And sometimes I think it's moving very grudgingly, at a slow pace. So the last mile is always challenging in inflation. When you are on a path of deflation, the last mile before reaching the target is always very sticky. The elephant is getting distracted from time to time, but it is unidirectional. It is moving towards 4%.
Thank you, Governor. Thank you for... we're running out of time. Thank you for spending time, and we're indeed grateful to you. As usual, you've been forthright and frank in your views. Thank you once again.
Thank you.
So if you may stay on the stage for a few minutes, sir, may I call Mr. Anand Goenka? We want to present a memento to you. Mr. Majumdar and Mr. Goenka together, please. Just. continue the conversation with Mr. Piramal within a few minutes. Thank you. Seated. We are awaiting Mr. Piramal's address next, within the next few minutes. Requesting all our audience to be seated and please be in. Can we close the rooms? Yeah. May we please have everyone in the room seated, please. A request to all ladies and gentlemen to please be seated. We would like to start out with the next conversation. After the enlightening speech with Mr. Das, we would request Mr. Piramal to take the podium. So it's over to you. Yes. Thank you.
Sorry? Yeah. Good morning. I think we've had a great session with the governor. He played two parts. I think first he played the wall with Rahul, like Rahul Dravid does, and gave all the risks that could happen in the environment. And then I think the second part was how he just hit the ball for sixers. So Shamal, I think he was the Virat Kohli for your bowling. We all know that India's growth story, and we've heard enough of it. I don't want to comment on that, because I agree with what's said, that how resilient the economy is and how the future looks bright. I thought I'd just talk a couple of points on this and then really see what I feel is necessary, that not only do we achieve the growth that we have are expecting, 7-8%, but how can we ensure that and probably accelerate that further? One of the things that I'm hoping that in the next few early on is that we could get a rating upgrade as a country. So today, India is BBB minus if our fiscal deficit is controlled, and it seems that the government is, through all these years, doing that. I think there's a good chance that we could get into a BBB category, which is the same rating as China has, which will mean that we will attract more funds into the country and our cost of borrowing will also go down. The second thing, like I look at as an opportunity, is where India is today placed in the whole. There's a lot of geopolitical crisis, as you know, and every day there's a new risk. The governor has given many risks, and we've seen that. Who expected COVID? Who expected the conflict in Ukraine and Russia? Who expected the conflict in the Middle East? So it keeps happening. But I think also when you see globally, a lot of people, particularly in the West, there is a lot of change happening on the political side. There are new governments formed. There are more coalitions being formed. There, India actually presents a strong political leadership which can take the country forward. And that, again, makes us in a pivotal position going forward into the future. And added to this, of course, is the demographic dividend we have and the strong technological stack that we have built. I mean, UPI is a pride for all Indians, and when you travel anywhere in the world, you see how much advanced we are digitally. But I thought I will now focus on some areas, in my view, which could help us to achieve our dream of becoming the third largest economy by 2028, 2029, and also probably some concerns that I have. I want to say first is on the cost of funds. The second part I want to talk about is the credit penetration and the availability of funds. And third point I want to bring forward is on the alternate credit support for NBFCs and the bond market. And finally, how do we talk about inclusion? So with that, coming to, first of all, the cost of funds. Over the last 3 decades, if you see, Indian interest rates have declined. I remember in the 90s, the interest rates were almost 17%, and I remember paying 19% to good companies were paying that. Now those rates have come down to 9%. But yet, I think, frankly, this has been because of a lot of policy reforms that has happened. But yet, in our view, the real interest rates today are still highest amongst the 5 largest economies. We are the 5th largest economy. Our real interest rate is still the highest. India has a 2.3% real interest rate. In the USA, it is 1.2%. China is also at 2%. Japan, of course, is 0.2, but leave out Japan. And so is Germany at only 0.1. So we are paying a higher cost for interest, which means in an environment where we want to actually become more and more competitive, we are finding that our interest rates are not matching that to the rest of the world. And therefore, our belief is that private capex which is a concern over several years now, one of the reasons is also that our interest rates are higher, and therefore there is not enough investment taking place in CapEx, and our growth story to that extent is still we can accelerate it further. Because if you have to be one of the largest economies in the world, our share of global trade has to go up. Today, our exports of goods are only 2% of global trade, and services is 5%. I think there is definitely a scope for us to go up further. The second point I want to bring is that whereas we have credit growth, I think we need more. Debt is the one which is the really raw material for growth. We've all seen how the cost of debt is much lower than the cost of equity, and we need more debt. The private sector credit to GDP ratio for India is just 55%. The ratio of private credit to GDP in India is 55%. This is much lower than the world average. World average is 148%. China is at 182%, Korea 165%, and even Brazil is higher at 72%. So I think we need more debt to be given. The governor spoke about the banking sector. But India's banking sector is amongst the smallest, if you look. We are the 5th largest economy. Our banking sector in size is the 15th largest. Our banking sector has $2.6 trillion of assets, while that of the USA, of course, is 30 trillion. China is 47 trillion. So if we have to move into that, I think we need larger banks. The FM also spoke about it yesterday, that we need not one state bank, but many such banks and many larger state banks. And to be an advanced nation, our credit has to grow at 18%. Till now, we have not been able to do that. Our growth rates have been about 15, 16% at best. And if we have to do 18%, I believe that we will have to expand the credit growth. Your session today talks about inclusion as one of the important things. I think it's really important that we include MSMEs as well as the other areas which have been left behind for inclusion. And I want to just talk a little bit about it. The MSME sector, they are major drivers for growth and employment. It's said that for every MSME, at least 2 people are employed. And we can generate 11 crore more jobs. We've seen that in the last few years, there has been a lot of tension as whether people are getting enough employment and are they fully employed. And therefore, MSME is one sector which should help in this growth rate. This sector also contributes to 40% of our exports and 28% of our GDP. If this sector has to grow, I think we have to recognize that though it contributes to 28% of GDP, only 3.5% of the bank loans are going into this sector. And therefore, more and more such these entities must have access to credit. And because of only availability of credit, can they grow faster. And some ways people say that our economy is getting a K-shaped recovery. So the governor spoke about it. Yes, urban growth was good. Rural consumption was lacking behind. It's coming up. But this has to continue because we cannot have a K-shaped recovery where some sectors do exceedingly well and others don't. And we believe that there is an option that different financing options need to be really looked upon so that these sectors, which till now have not got enough credit, can be given. And now I come to the role of NBFCs. I think NBFCs, as even the Honorable Governor said, play a big and significant role in it. And whereas they are banks, they are complementary to banks as well, because there are areas where the NBFCs can reach where banks may not find it profitable enough. There are also certain types of loans which NBFCs can do, which banks may not want to do. And if you look at it, the NBFC sector, as the governor also pointed out, has been able to withstand the stresses that have come about, the risks that we went through from 2018 onwards. The NBFC sector has come out strong. Whether it was, as you may remember, the ILFS crisis, whether it was the failure of the banks like Yes Bank, the DHFL crisis, and then, of course, COVID and all the other issues that have had. I think the NBFC sector has come out well. There is enough capital adequacy. It is about 27%. It's well capitalized. The NPAs are in good situation, and the NBFCs are much stronger. The RBI has taken many measures to ensure, as the governor said, to see that this sector remains healthy. So I think today the NBFC sector is well positioned to meet the credit needs of small and micro enterprises. With the India Stack, we have a strong opportunity through the digital identity and digital payment technologies. This will help technology-driven NBFCs to efficiently assess credit, underwrite risk, and improve the loan recovery. Additionally, there is enough data available from many other sources, whether it is the GSTN data, the income tax, credit bureaus, and the fraud registry. All these are now interlinked. All these also share data, and therefore we believe that the underwriting processes are much more robust today and will continue to get better and better. And therefore, this is a time when NBFCs also need to have access to more funds availability. Today, for NBFCs, the major source of funding is still banks. 55% of the funding from overall for NBFCs comes from banks. There is a concern which RBI has often now raised, as more so in the last few months, when they are saying that there is too much of contagion effect, that if there is an issue with NBFCs, it could affect banks and so on. And therefore, we need to widen the scope of availability of funds for NBFCs. And this is where I think now the RBI has also done what is the upper layer of NBFCs, where the regulatory oversight is much more than it was before. So earlier on, there would be an arbitrage between banking regulations and NBFC. This arbitrage is more and is getting reduced more and more. And hence, this is the time, I think, for the RBI to start looking at giving the ability to raise deposits for NBFCs. Today, if you look at it, amongst the top NBFCs, there are only 5 NBFCs which have a deposit-taking license. And no new deposit-taking license has been given since 1997. I think with so much now of regulatory oversight, with so much more of technology, I think this is a time for the RBI to look at, consider giving deposit-taking licenses, at least to the large NBFCs, which are in the upper layer, which the RBI is also regulating in a much stricter way. It is possible that we can also give the insurance to deposit takers as it is done for banks, and a charge, the insurance premium could be put onto the NBFCs. In addition, we could also have a minimum fixed deposit that you can take, nothing below a lakh or something of that sort, so that more intelligent or more knowledgeable investors put in public deposits for NBFCs. But I think I would urge that the RBI and the regulators look at this. The second issue is on a weak bond market. This is one of the challenges which we as a country have faced over a long time. There have been many attempts to develop a bond market, but it has just not gone there, and more needs to be done. Our corporate bond market is much smaller than that of most other countries. It is only at 16% of GDP, which is even lower from other peers like South Korea, which is at 87%, Malaysia is at 57%, China is at 36%. So our corporate debt market is only 16%. And that also, the bond market is biased towards government. 70% of all the bond issues are with the government. The balance, out of the balance, 30%, 21% of these are only on the AAA and AA companies. So what is happening is that the companies which are lower, the BBB and so on, are not being able to attract the bond market, and their costs of funding is low. In fact, I find that in our own experience, there are many companies which are on the verge of becoming good, large players, not only in India but abroad with exports, but their cost of getting credit is much higher. I think these are the companies that have to, which need to be supported at this time with lower credit costs so that we can move forward, and the growth that we are envisaging of the 7 to 8% is realized, and it is spread across the country. The good news, of course, is that the inclusion of our bonds in the JP Morgan bond index would mean that almost 2 lakh crores of extra credit would be available in the system. I'm also now going to talk about, since we talk about inclusion, I just want to talk about an important fact in our country. If you look at the country, there are some parts of the country, if you look by and large on a basis, the eastern part of our country is much different in terms of development compared to the west, compared to the south. And if you were to look at just people in the aspirational districts which the Prime Minister has identified in 2017, these are the most backward districts. Here, out of about 200 million people, if that was a separate country, then in terms of human development indices, we would be amongst the worst in the world. We would be compared to Burkina Faso and such other countries. But the fact, if you take the rest of the country, in terms of sustainable development goals, we are almost at what the World Bank wants us to do in 2030, we'll reach there. But this part is which is lagging behind. And I think this is the part which we need to bring focus on. 16% of India's population lives in this, but only 1.5% of our CSR money goes in it. You will be shocked. Almost our tribal population is about 8% or 10%, something in that region. And there, the average, and this is a personal experience I had, our Honorable President today is from a tribal community from Orissa. And she was telling us that in her village, she's age 64. She's the longest surviving person in that village at age 64. The average longevity, if tribal India, is 11 years less than what you and me have. So this cannot continue. If it continues, our growth rate, if we don't take the whole country into with us, we will have issues. So I'm very glad that Anant, you and your team thought of doing the inclusion, that it should be an inclusive growth, and highlighted that. So if I was to say, in summary, India is really looking good as we look at the future with a lot of optimism. And I think that the crisis in the world actually is an opportunity for India to become a leader. We can do much more if we can bring the availability of more credit, if we can bring down the cost of credit, if we encourage more NBFCs and have a more inclusive growth rate, then we should do very well to become the third largest economy in the world in this decade itself. I thank you. I thank the Financial Express for calling me and for you all patiently listening to me. Thank you.
Continuing the conversation with Mr. Piramal, may I invite Ms. Shobhana Subramanian, who is a Deputy Managing Editor of Financial Express, to have a fireside chat with him.
We got some good insights. So, since you spoke of credit, it is actually the first question on my list. There is a growing perception, and some bankers also admit it, that while there is a demand for credit, the terms and conditions now have become so onerous post the cleanup, and bankers have become so risk averse that borrowers don't actually want to borrow.
So they have definitely become much more risk averse, and that's the point actually I made. There is enough demand for credit today. So if you look at the banks, by and large, they're only giving to the AAA companies and the AA companies where the risk is relatively lower. But there's the rest of the countries, and I think you raised the question about private credit. These are the companies which are now paying a lot for private credit. And these costs, I mean, we also have a private credit fund, so I can tell you that the costs are like 15, 16%. So these cannot be sustainable. Today, what also happens is that many of the better performing companies, though are BBB, they are hoping to get an upgrade in their credit, or also listing on the markets. But in the long term, you need to have more people or more companies which are in BBB, BB, which can get credit. So we have to ensure that.
Also, there is a structural change in India's savings pattern. It has begun, and I think in the financial savings piece, we are likely to see more money going into mutual funds, direct investments in stock markets. Now, if you were to look at this, that means the cost of borrowing for banks is going to rise. It's likely to rise because, if they want to garner more deposits. So, how are you actually reading the interest rate situation? While we feel that everything is benchmarked to a repo rate or a T-bill rate, actually it is liquidity in the system which determines the ultimate cost of money. So, because you're saying that the rates are already high, and the real rate you pointed out is 230 bips. How are you actually seeing interest rates move?
I think we will also have to see that how we can get the corporate bond market to be more, become much more efficient so that more and more credit is available. Just like I gave you the instance of the JP Morgan index and 2 lakh crores will come more into the system. Similarly, we will have to get this corporate bond market to be more available. We'll have to ensure that, see how we can have pension funds and other savings come into the market. I think there has to be a collection of several such initiatives to see that we get there. Still, I think the deposit ratio, how will we get into, as the economy grows, there will be more wealth coming into areas which are not there. That cash, can we get into the deposits? It will be a multiple of things.
But, bond markets, we've spoken about this at least for 25 years.
That's what I said.
I myself, since I was in ET.
I said that, but if the rest of the world can do it, we have to learn. I think I'm told there are lots of tax and, many things have to be done to get this to be a really good
So
market.
in the near term, where are you really seeing interest rates come down? Because the repo coming down by 25 bips or 50 bips, to my mind, is not going to make much of a difference.
I think we heard what the governor said. We'll go by that. I don't see much in this year, the rates coming down. I don't think so.
Also, in this context of debt, there are a lot of, I would say, entrepreneurs or potential entrepreneurs or people with wealth who believe that it is better to invest rather than set up new capacity. The kind of returns they are seeing, whether from a startup or even existing units or even in the markets. If you're going to earn 10%, 12% a year, why take on this enormous risk of borrowing? This seems to be worryingly a growing trend.
This is temporary. We've seen markets go up. We've seen markets go down. Over a period of time, an entrepreneur is willing to take risk, I believe, and their returns are generally going to be higher than what the markets do. Today, the market is, it's the record high, but it can also go down. People are aware of that. So I think it's a much more sustainable if you build a business than it is when you just invest in the markets. That's
so you do see private
I think
capex.
so. I think, it's a question
because
of
we've
time.
been talking about this for 3 years now, and now the 15% concessional tax is gone.
So I think we have to also encourage. Now, there was also, a paper put out by RBI, for instance, on project finance and how greater provisions have to be made by banks and by NBFCs if you do project finance. This means that the cost of funding again goes up if this is implemented. So we have to make it more and more. We have to make it more attractive, really.
But you yourself are pointing out that the rates are so high, and you pointed out for MSMEs, the flow of credit to that sector, and for them the interest rate difference is the margin.
But still, I think the entrepreneurial spirit in India is still there. Fortunately for us, if you go and see, the young people want to do some more things. I can see it across many people I meet. They want to invest in new businesses. And frankly, that's a big plus as far as India is concerned. You go abroad, especially large parts of the world, I don't want to name them, you will find that there's not this enthusiasm and optimism for the future. So.
But the largest part of the capital which has funded the startups is not local money.
That's
it is
the point.
Foreign money which has funded. No Indians, the share is minuscule.
So that's the point. We have to encourage all types of capital. We will need foreign capital if you want to grow. Every country needs it. We also find now the first time, actually, if you look at the markets also, the high net worth individuals or the domestic investment is more than what the FII is. There's an outflow, as you know, of FDI. So this is but that's fine. I think as the country is growing, as people get confidence, if we get capital from outside, there's no problem in it. We need to ensure that the cost that we are paying is not high. And therefore, if the rates are competitive here, then globally also you'll get that.
It's just a general question that, we in India, we do have a history of entrepreneurship. I mean, from the Tatas, Birlas, Mahindras, Goenkas, and not a single business house has spawned a successful startup of the nature of a Zomato. Not one young entrepreneur in this country.
If I look at...
and the one who did failed.
No, it's not like that. If you look at
what is like that.
What is Jio? Wasn't it a startup at some time?
No, I'm talking about in the e-commerce space. Jio is a hybrid.
In the e-commerce, I know that Tatas have invested a lot of money in the e-commerce. You'll see the things coming up.
No, my question is, why is it that, most of the startups have been founded by youngsters from IITs, IIM dropouts, etc. If you think of even the poster boy of startups in India, he does not come from an established
So that's
family.
good. No? In fact, I'm happy that that's happening because you want entrepreneurship to spread across. Microsoft, Google, Amazon, all these were young fellows. Many of them were dropouts.
Okay. A slightly political question. What do you make of the reservation that state governments seem to be increasing?
You've seen the response. I don't think I need to comment more. I think...
No, because you noted, in the context of jobs, you pointed out that, we need to create the jobs. You pointed to the K-shaped recovery. So in this context, how do you view such a development?
I think, in my view, you have to, it is one country at the end. And we have seen that people have moved from forget one state to the other. You've seen so many of our young fellows have gone into the US and have done so well. So I think why start restricting within our country when even other countries are encouraging our people to come? Now you have many people. You have probably the vice president nominee's wife being from Andhra. So that's how we should be.
With the budget around the corner, would you have a message for the FM, a spiritual message?
No, I am no one to give a spiritual message to the FM. I think she knows her job well, and we'll just wait for it for the 24th.
One wish.
I think, frankly, we've had really good fiscal discipline. We just continue on that path.
Thank you. We'll just take a couple of questions, if it's all right with you. The gentleman here.
So Raghav Subreddy, NM Rothschild.
I can't hear. Just speak in the mic, please.
So Raghav from NM Rothschild. So since you raised the issue of the credit funding, so I wanted to ask you, so business houses such as yours, all right? So if you have, what do you think of the ECBs and the play, external commercial borrowing, and then you have the subsidiaries of foreign currency exchangeable bonds, convertible bonds. So do you think that the rules which have already been relaxed to such an extent so as to facilitate the foreign portfolios, do you think anything more can be done with regards to?
I think even now, yeah. So you're seeing that the number of ECBs that are being now raised are significantly higher than before. That's just that the attractiveness of the Indian market itself is there. And there are certain issues on taxation and all, which I think hopefully we'll see that it'll get resolved. But that is an important source of funding which is required for the country. Today also, as you probably know, in the US, you talked about private credit. I think the concern is more of private credit in the US. Today, the rates are so high and so attractive for private credit. 12-13% in dollar terms is becoming very expensive for Indians to raise that.
Mr. Piramal, this is from Financial Express Online. You mentioned about tribals, and I think, as I see, you have pharma also in your hold. You also have sickle cell anemia, which I think also was something which recognized earlier by Piramals. My pointed question is actually we have decoding inclusive growth as our agenda. What about inclusive credit as a leading NBFC? What would be the 1 or 2 areas in which actually you can take some measures that we can further this cause? Second, we are a news publication. We are always looking in terms of Piramal Group's aspiration, in terms of moving to bank. There's so many things which are there. If yes, what would be your immediate priority on that?
So we are definitely in the inclusive credit. So for affordable housing in tier 2, tier 3, we have actually made significant investments today. We've got about 13,500 people in the field force itself. And in terms of incremental credit being given to the affordable, that is average of about 15 lakh housing loans, 15 to 20 lakhs. I think we are one of the largest now in terms of disbursements of loans in the NBFC sector. So yes, we believe that inclusive credit is really required, because we've seen in all our businesses, I mean, how have we grown? It's not only through equity. The cost of equity is much more expensive than that of credit. You need a healthy mix of both.
What about your aspirations in terms of when will you be a bank? What would be the, you are always growth driven and metrics driven.
We will wait for what the RBI says. So as far as we are concerned, we are taking all whatever necessary measures it is so that you fall in line with all the regulations that the RBI has, and then we will wait and see.
Hello, my name is Vivek Srivastav, and I had a comment rather than a question that I'd like you to expand on. So I'm doing a startup. I'm going to be launching a very interesting startup. And what I'm finding is that the ecosystem for startups is quite challenging and really lacking in India, really. Both from funding, from any sort of support. You know, basically it's like a catch-22 situation, I'm finding, where they want you to be, you know, successful, EBITDA positive, et cetera, then they'll come in and help you. But I don't need your help if I'm already there. So, you know, it's at the early stage where I'm finding it that it's very, very lacking. I'd like to hear your comments.
So, you know, the startups, first of all, it is a tough journey. So I'm not saying that, because it's the idea itself, and I actually applaud you for doing a startup. But as you know, that there was a lot of euphoria a couple of years ago. So people were, actually nobody was talking about EBITDA at that time. They were just talking about GMV, and they were just talking about, you know, what the sales was, and a multiple of sales is what people were getting. And many of them have lost money in this. Therefore, people have become much more careful in that. I mean, Byju's is the great example, as you know. It was, 20, 30 billion at its peak, and now it's nowhere. So we have to be, I mean, this will continue. I mean, there will be times when there's euphoria. There will be other times when people will start becoming a more conservative. But let me say that if you have a sound business model, it's not only you have to be EBITDA positive in the first few years. People will appreciate that. And I can wish you luck in that, because it's always a tough journey.
Last question.
Hi, this is Sanjay. Sir, I would like to know, what is your opinion that within the organizations, just like innovations are one of the wing we are already working. Can we think about the employees to promote within the organizations, to think, to build entrepreneur within the employee?
I think today you have to have entrepreneurial spirit within organizations. And therefore, we also try and encourage innovation within this, because you may say entrepreneur is not only outside, but within corporations as well. And in such a competitive thing, you have to have that innovation within. Actually, if you see the success of most companies, it is the innovative ideas. They are creating markets which were not there earlier. So I think that culture has to be there. We also try and encourage it. And
okay, thank you.
if Mr. Piramal allows, I was enjoying the presentation. I've written a few rapid-fire questions.
Okay.
Can I ask you from here? Because I think there's some things that I wanted to hear from you.
This is a tough one, but yes. And then I always get scared of your rapid fire. So
you can leave them if you find if you find them as no balls. So firstly, how much should we be concerned about India's sovereign credit rating?
Sorry?
India's sovereign credit rating. How much is that a concern? How much should we be concerned? Are we spending too much time on it? Too little time on it?
No, I think it's always better to get a better credit rating because then the cost of funds comes down significantly. And there are many indices which will give you funding because of the credit. So it's good to have that credit. It'll increase the availability of funding and the cost of funding.
Okay, the one lesson the Fed can learn from the RBI.
I think just look at the regulation. Governor spoke about crisis in 2023. If you looked at what happened at the SVB, frankly, there was no regulation at all. There was no risk, nothing. I think they should just follow what RBI has done. We've not had any such blow up. Or look at the blow up of Credit Suisse. It is one of the top 2 banks of Switzerland, and what happened. So.
Yeah. The one thing that excites you about digital currency?
I think digital currency, I'm not the expert on crypto, so let me pass that.
This is a way to bypass crypto and for government to officially get involved with digital currency.
Yes, so that's what it is, but I'm not really well versed in it, so I don't want to.
Okay, in one word, the future of the US dollar.
US dollar? I think it's always going to remain strong, whatever happens, because the US is just too big. You need economic size, you need military power and strength, which is what US has. So I don't see that coming down.
And it will remain the global currency of trade.
I think so, at least, yeah.
Okay, one piece of advice for the next American president, whoever he is.
I'm no. Just stay fit and healthy.
Okay. Okay, your advice to someone who is bullish on the future of cryptocurrencies.
I don't understand it, so if I don't understand it, I'm not a person to comment, as I said.
Okay, by the year 2047, when Bharat is Viksit, will we have more or fewer banks than we have today?
We'll need definitely more banks and larger banks.
No, larger or few? If you have to choose between larger and more.
It has to be more banks and many more larger banks.
Okay. One piece of advice you have for a fintech founder today.
Fintech founder, I think you just have balance. You can't go either way.
Okay.
Neither through great times or bad times. All things balance out at the end.
Okay. And the one failed NBFC whose turnaround or, whose, turnaround's a better word, but whose rescue you're impressed with.
So what we had, so DHFL was a failed NBFC.
Yes.
It had a 90,000 crore, loan from the system, and we took it over, and now it's turned around.
Okay. And last, the one word for the future of futures and options.
That's not my area again, please.
Thank you so much. Thank you so much.
Thank you so much. That was really very informative. Thank you for the perspective.
Thank you, ma'am and sir, for being part of this conversation. We'll be back in a few minutes with the standalone session soon. be starting our next session, a standalone session with Mr. Raj Zaveri, who is a Senior Director BFSI and Large Conglomerates from STT GDC India. May we invite Mr. Raj on stage, please? Yeah.
We'll wait for some time, or we are good? Sure. We'll get going? Okay. There's the presentation. So good afternoon, respected dignitaries, ladies and gentlemen. My name is Raj Zaveri, and I lead the BFSI and the large conglomerates vertical for STT India GDC. What a day to have the modern BFSI session today, As we talk way back in 1969 on 19th of July, 14 banks, were nationalized. With that said, I would want to begin. And as I start, I have a question for all of you. Can anyone tell me what does 131 billion stands for? Anyone? I represent a technology company, Each one of us who's sitting back here must have contributed at least 12 transactions to get this number going. Any guesses? Yeah? UPI? No, but it is the digital transactions what we talk about. Not only that, it's almost 200 lakh crores which are transacted in the year 2023-24. And as I go ahead, we see CAGR growth of almost 45% between 2017 to 2024. And as we talk and take things ahead, there is one more era. What are we talking? We've been hearing since morning. That's about AI. We've been talking technology. What is the BFSI AI era? As you see this chart which has come up, on my left, it states the global GDP being impacted with technology. As the way in which the technology is growing, where we start primarily from the printing press era to the AI era, each leap of technology, has got its own spur, and it is contributing towards our economic growth and the possibilities and the innovation, what are we getting ahead. As I go ahead, the next era would be an AI era. Now, we've been hearing about AI, we've been talking about AI, so that's not that new. But at the same time, the use cases which are going to be coming down more from a perspective of banking and others would be contributing to much more higher innovation what we're trying to look out for. With that, when we say what is getting AI fueled more, the kind of chipsets, which were all as good as 500 million transistors which were able to process power, are raising back almost to 4 trillion in terms of computing powers. Now with HPA, high performance computing, and AI, what it gets for us. Number one, 2x in terms of the productivity and innovation. It contributes 1.2% of the GDP growth on an annual basis. It gets $15 trillion, worth global GDP moved by 2030. And it contributes, only Gen AI, would itself contribute to almost 4.4 trillion to the global GDP. What's that for India? In the next decade, we see $1 trillion of innovation and opportunities what lies with us in India. Now, as we are talking data, so data growth, says revenue growth, say is the economic growth. With that, I just wanted to understand, that as we are into a BFSI session, I just wanted to get a brief area that where this data gets stored. Anyone? Precisely. So just to get you familiar, quickly on the basic IT infrastructure of a bank, which consists of a front end, which consists of a middle tier, and which consists of a back end. Now, where exactly the data is? The data is in the data center. And this data, what are we talking, is very critical. All of them, we've been listening to the governor, to Mr. Piramal, and to the future, fireside chats, what we're going to have. Every conversation is going to be revolving around data, data, and data, and these are critical data. Now, for a bank, or for an insurance company, or for an exchange board, or for that matter, an NBFC, okay? These are the basic guidelines, okay, what one needs to be saying, that if my data, either I store in my own captive data center, I have a cloud provider who would help me to store that data. Even that cloud provider stores his data into a data co-location center. Somewhere down the line, the data center comes into the picture. It's not that I'm from a data center company, but that's a fact. With that, we say the infrastructure reliability is one of the key areas, especially when our government and RBI mandates critical data have to be saved on Indian soil. The reliability factor on infrastructure becomes evidently more and more high. Second aspect is energy efficiency. Today, as more we grow in terms of our expansion, okay, in the terms of reach of the data centers or the kind of IT innovations we are doing, it will consume more and more energy. And for anyone, okay, familiar with PUE, am I right? Productivity usage, electricity in the sense where we consume least energy, okay, to contribute the max. Now, the PUEs in a data center typically would be the operational front where it helps to reduce the cost. It has to be, renewed in terms of the renewable energies which are available like solar, wind, etc. Third aspect is data security and privacy. We had those 9 points by the governor, and this one was the major, am I right? Where your data saves, okay, it has to be secured. That integral is it. With the modern working style, okay, it becomes more detrimental of data not operated from a siloed location, but from a remote location. How secured is that in front of your data? What are you maintaining it? The fourth part is sustainability. It's critically important, okay, that whatever you are investing, okay, it has to be sustainable. It has to emit least carbon going in the future. Now, what is the way ahead? If these are the 4 imperatives when we talk about, what are the way ahead when we talk about is the challenges and the way forward. So one is most of them, okay, the traditional banking structure, all the companies which are almost 3 decades, 4 decades old, the biggest challenge what they come out is in terms of modernization of legacy systems. How do you modernize your system from the legacy to the new age technology which is been offered? Second, in terms of the cybersecurity threats. Third, from a regulation compliance, that it has to be complied the way the government is asking us to. Managing complexities of the data centers technology, that as and when the things are innovating and are changing, you would be primarily responsible if you're maintaining that data center to upbring that change, adapt that change, and take things forward. And last but not the least is in terms of competent technical manpower. Even this was one of the points what the governor mentioned today, that running a data center is more critical than running a Boeing 747. The Boeing between 2 takeoffs, okay, has at least some downtime. The data center cannot afford to have a downtime ever. It goes 24/7 into 365 days. That critical the operations are, and for that, you need to have someone who's competent. With this, when I talk about the basic bank or any financial institution, okay, their basic job is to run the operations, okay, and do business. Where we come into the picture, okay, is you do the work what you are expected, and you can get the work what we've been able to do. And that's where we say that we can be a trusted partners, okay, in this entire journey. With FTT GDC Global, okay, we are present in most of the emerging, geographies, okay, starting from, India, Singapore, Malaysia, Thailand, Japan, Germany, UK, with more than 1 gigawatt of IT load currently workable. In India, we are present in 10 different states, okay, 28 data centers what we are operating, and almost a 400 megawatt of IT infrastructure planned in the coming years. With that, what services what we offer is in terms of co-location services, where we say, if you have, we have brokers from NSE and BSE, okay, who come down to us asking us for 5 racks and 10 racks, and then we have large banks, we have got large exchange boards who says that they want to have a build-to-suit data center with us. That's the capability in terms of co-location what we have. We are into connectivity, where you're able to, communicate to your primary, to your secondary data center. We have that services available. We are into support services, where we say, we manage the entire support for your data center operations. Okay, so you have a good night's sleep, and we take care of that. And last is in terms of high-performance data centers. I'll speak more on the high-performance data centers on cloud today. Major of the hyperscalers, okay, when I talk about the big OEMs today, when we talk about, I cannot name them, but most of them are with us. With this, the way in which STT is offering services, okay, is end-to-end. Where we say we have started services, especially in terms of AI as a service, GPU as a service, where these services, okay, can be planned for you to run your AI load. And that's where we say we run it individually from our data center. The folks are in India, the support is from India, the software from NVIDIA, which is latest available, which we can make you enable. With that, I would want to, just share our first partnership what we had with Firmus. Okay, Firmus is basically an AI architect from NVIDIA, and we have collaborated with them to offer the infrastructure as a service, to the Indian market. When we've been talking about buildings of data centers, okay, this is where we say is the future of data centers. That's the hypercube. This is where the size would take a 5-story building or possibly a 3 acre of land to be coming up, and it can be fit here into. And by end of 2024-25, we announced at least 3 more partnerships into AI ML, okay, as a service for hyperscaler data centers. With that, we are very committed, okay, in terms of our ESG guidelines, in terms of decarbonization of our data center operations, social welfare, inclusivity of work, and last, in terms of governance. We have the right set of things moving for us. As we go ahead, these are some awards what we have got, but 2 to be mentioned and categorically called out. Number 1 is we've been the best data center company in the last 6 consecutive years for civilian. We've been in the 5th year where we've been awarded as one of the best companies to work with. Now, with these 2 things, okay, it makes a lot of sense to partner with us for your critical data. With that, I end. Any questions? Thank you. Okay, I go by that. Thank you so much, and thank you, Financial Express, okay, for providing this opportunity. Thank you.
Thank you so much, Mr. Zaveri. Thank you so much, Mr. Zaveri. Our next topic of discussion is empowering India's digital economy through a robust data center ecosystem. And for this, Mr. Sanjay Bhutani, Joint President and Chief Business Officer, Adani Connects, I would invite you to please come up on stage. Financial Express Digital's Lavanya Iyengar will be joining him in this conversation. Thank you so much.
Hello. Am I audible? Yeah, thank you very much for this. Yeah. So, due to the paucity of time, we will just go straight away to the subject. We've all had a lengthy discussion with the RBI Governor. He spoke about the pointers which was required, for a healthy economy, which he's looking at. And in that, he had mentioned that all banks have to embrace technology and see to the technology is one of the drivers for that. So this is totally apt with what we are talking today, right, Sanjay? We're talking about empowering India's digital economy, right? And how do you perceive the role of technology in driving financial inclusion and enabling business reinvention?
Thank you for having me here. Glad to be here back. I think I was here about a year back. I think a very relevant question. BFSI plays a very vital role in the economy of India, and all of us are aware India has played a significant role in a global economy. And out of that, BFSI is something which is very, very important for any organization and a country. And good to share 46% of world's digital economy, which is basis BFSI, is in India. And the growth, what we have seen in last 10, 12 years is 90x of digital economy growing in BFSI is significant. And how does that play a vital role? Because I'm sure all of you are aware, UPI is the game changer in India. And whole world is looking at us and seeing how UPI system has helped us to make sure we actually cut inefficiencies on many types. And as far as digital economy goes, of course, and digital way of doing things in bank goes, we have seen evolution in last 10 years. It's big time. And CIOs are a driving seat. They are no longer a support system. And getting a lot of stuff, which is, we are seeing GPU coming up, CPU played a key role, conventional played a key role. So a lot of products which are being driven, and those are coming on a technology base. So clearly, technology will continue to evolve. We know artificial intelligence in our way, and a lot of new evaluation we are going to see. And I think we are at the right time, at the right place, and helping banking. And of course, data center plays a key role. And data center also has got many faces. So happy to deep dive into a data center part of it. But at the same time, really, really excited to be part of a journey which helps banking to become more efficient and making sure we lead the world. And banking is leapfrogging day by day.
And it's almost like $1 million question. What came first, whether it was a digital transformation or technology part, right? So how are companies future-proofing their IT infrastructure strategy? And how do data centers play a pivot role in this?
Absolutely. Data center is something I keep telling everyone. So cloud meets the ground is called data center. And data center is the house where all the digital stuff takes place. And we at Adani Connects have, when we entered this business about 3 years back, we started making a mega centers, which helps people to have a more efficient. And of course, the design flexibility is something which is very important to have it in data center. And while building a data center, of course, everyone has taken a sustainability goal, while some day, some month, and some year, and most of our company have taken a pledge by 2030, everyone is going to be a 100% sustainable company. So that is something which is very important. While designing data center, network plays a key role. A lot of stuff which goes in data center, and data center becomes a premise to do all the compute, all the technology, and all the products, which is helping bank to be more efficient. So we are building a scale, we are building efficient data center, which is helping banks to be more efficient. And when we need a scale, of course, government is playing a key role while while building policy, and policy is also playing a vital role to become data center as an industry very, very efficient. Now we are seeing a new era of 5G coming in, and the smaller data center will, of course, come in, and which will help be closer to a customer. And yeah, that's how the data center is the premise of all innovation, all the activities which happening, which front end is a product or a bank, but ultimately data center is the back end, the director of a movie.
Okay. And you were talking about cloud today. The clouds are literally meeting us out here, right?
Yeah.
And see, our main theme today is on inclusion and sustainability goals too. Okay. How is data center driving sustainability goals?
Sure. So sustainability, if we look at it holistically, we at Adani Group and Adani Connex is looking at it two ways. Of course, everyone has taken a goal in terms of energy part of it. How do we make sure we are energy efficient? Second is water also goes in a data center big time. So how do we become water neutral? So we have worked a strategy wherein we can become a water neutral. And how do we help community? Ultimately, data center doesn't create so many jobs. But at the same time, we can help community to make sure they are able to get water, cleaner water. And that is something which is helping us to make sure sustainability is not only a goal which is for the organization. We are helping all the community to go and come and travel with us and make sure they are the one who's helping the society gets benefited. While data center industry is still not evolved big time, if I have to compare the kind of population what we have got a huge runway to cover. While digitization is taking place, cloud has evolved. We are still at a nascent stage of almost 9-10% of cloud adoption. While if we look at our developed countries, it's almost 60%. So huge runway to cover. At the same time, when it comes to sustainability, I was sharing with the colleagues outside, the kind of data center what we are building, of course, we are becoming efficient in a GPU. When we look back at the telecom sector, we used to see everything in air condition. Now we see every infrastructure is on a road and a bridges. I think the day is not far while the data center will also be, and a similar kind of ambient temperature will be accepted, and we will have the data center ecosystem 35 degree to 50 degrees Celsius. So I think there's an exciting journey. We are evolving and making sure sustainability, one side is clean energy, other side is water, third side is we have to evolve it and make sure we need lesser cooling so that we are able to consume less.
Okay. Can you talk about your journey, the sustainability journey you just spoke about? Any instances or any case study that you would like to talk about?
So India is blessed to have the kind of infrastructure what we're building. We are building one particular center which is 30 gigawatt, which is across the globe, the first center which is under one roof, and that center is as big as a Singapore size. And 30 gigawatt of campus, which helps you to make sure you are able to give a lot of power. The kind of growth what India is having, India is almost it's got an infrastructure of 450 gigawatt. And we are growing at almost 10% CAGR in terms of energy consumption. And while we are building such kind of infrastructure, which is 30 gigawatt, one campus, such more campuses have to be built, the kind of consumption happening, the kind of innovation happening, I think clearly India needs more and more this kind of infrastructure, which helps India to grow faster. Of course, we keep saying India can become a global data center hub. How? We have to make sure policy helps. So we are working on a very unique program, which is Digital Embassy, wherein we can get data of other countries. And legislation is out. And we are making sure with the sustainability and making sure the countries who are not able to build data center, and we need to get them here. So we are helping them to have larger campuses, having sustainability goal met. Of course, data privacy also plays a key role, which we are keeping eye on that.
Okay, so you are marrying both sustainability and data center together and trying to march forward. Is that what? Yeah. Thank you very much for this. Yeah. Thank you. Yeah. we thank you, audience, to be with us for the next session. We're going to start our next session, and we're just getting the stage ready for the same. And this session is going to talk about the road ahead for all-inclusive growth. Our panelists would be Mr. Dinesh Kara, Chairman of State Bank of India, Mr. Keki Mistry, who is a non-executive director of HDFC Bank, Mr. Vaidyanathan, who is the MD and CEO of IDFC First Bank, and Jarun Daruwala, who is the CEO India and South Asia Markets, Standard Chartered Bank. This session will be moderated by Mr. Kumar Sharma, who is the Deputy Editor of Financial Express Digital. Can we invite our panelists to please be on the dais?
Good afternoon. First of all, a big thank you to the speakers that we have here. We have Mr. Dinesh Khara, the chairman of SBI. You can't get bigger. Fortune 500 company, biggest microfinance company. So many bigs to the entity like that. Mr. Vaidyanathan from IDFC First, a veteran banker. By the way, he says that I don't go to events like this, but he has come here. So thank you so much. Mr. K.K. Mistry, the veteran banker, wearing a hat with frothing with many feathers, is into so many areas. And Ms. Zarin Daruwala, she is, I don't know, I think maybe you should say a foreign bank with an Indian heart, or someone who's an ace, who has great acumen in finance. Or probably you're a rank holder in your chartered accountancy, I think so. Lots of things about you. So thank you so much. I have one round of applause for speakers. Thank you so much. Dinesh, if I can begin with you. The RBI Governor actually touched upon some of the key areas of concern. And one of the first things that he flagged was essentially about the liquidity challenge, so to say. That deposit mobilization is a huge challenge. In a scenario like this, what do you think would be the first key priority areas for banks, especially given that SBI is leading the way in many ways?
Thank you very much. When we look at the liquidity, there are various components of the liquidity which enables the banking system to raise deposits. I think there's a paradigm shift, and that paradigm shift is essentially attributed to the efforts on the part of the government to ensure that the spending should be just in time. There are different phases when the spending is quite constrained or maybe restricted, and there are times when liquidity is available in abundance. So I think as the intermediary, this is incumbent on the part of intermediaries to look at deposit as a franchise and not to wait for the deposit to be raised when they see the opportunities.
Deposit as a franchise.
Deposit as a franchise. And that is something which we did during the peak of the COVID, when there were not enough opportunities for deployment. We continued to raise the deposit. And today when we look at our excess SLR, which is to the tune of about 3.7, and with the credit deposit ratio of 68%, we are better off as compared to many other players in the industry. So that's why, role of the intermediary is to even out the peaks and the troughs. So that is something which we have done. But nevertheless, I would agree with what Honorable Governor has mentioned, because the kind of growth which we get to see for the loan book, as compared to that, the deposit is not going commensurately. And
so very briefly, what would be your key priority now before I go to the other ones?
No, of course, we are also very mindful in terms of ensuring that our ability to continue to grow the deposit should be there, and all our branches on the ground, they have been very clearly told that deposit should continue to be a major focus of growth. And that is something we are offering all kind of, wherever required, some improvement in interest rate, wherever required, improvement in the products and the services, and also some of the add-ons which are required to make the deposit attractive to the customers. So that is something which you are doing. But having said that, I must also acknowledge the fact that deposit is one of the asset class. There are other asset classes also. And with the formalization which we have seen, normally during inflationary conditions, there is invariably effort on the part of the customers to deploy their savings into the most profitable sources or the asset classes which are available. Okay. But if at all people are looking for coupon, people are looking for the assurance for the repayment of the principal and the interest, perhaps bank deposit would be the all-weather product.
Okay, that would be a nice pitch for that. Mr. Vaidyanathan, until unless you want to add anything to what he says, but my question is again, just to kind of bring in more areas, decoding inclusive growth is the main theme of this conference today here. So from a banker's perspective, where do you find ourselves in the journey? And for you personally, where would the priorities be now?
See, when we see the next maybe 6 or 7 years of the country coming up, let me say 2030, a large number of new sectors are going to come up, and our banking system's ability to be inclusive towards new sectors coming up is going to be a very critical item.
Such as?
Such as, let us say, gig economy. Okay. So if you see the gig economy people, they are neither very well educated, you can't call them postgraduates, but they are not undereducated, uneducated also. Okay. They are not very high earning people, but they are not very low earning people also. Therefore, and they're all kind of platform workers, delivery people, etc. This is a very big area here. Now that number will be, say, 7 million today, will be 30 million people in 7 years. So this is since you asked for an example, this is an example of what sectors coming up, system has to figure out, because that's one thing. Now, secondly, the process of formalization, which all of us are seeing, for the last maybe 70 years of independence, first maybe 65, 70 years, corporate credit got a lot of the credit, and the bottom pyramid hardly got any credit. They operated from equity. And all of us in this room know that you cannot run any business out of equity because there's no leverage. So this, that 63 million enterprises, that 400, that 25 lakh crores of unfunded credit, all the numbers we talk about, that sector is truly unfunded. And not more than 15% of MSMEs are funded today. Back 85% is not funded at all. So this is one big sector.
So are you seeing formalization leading to more credit to MSME? Are you seeing it?
It should happen, because I'm saying conscious effort, apne aap se kuch nahi hota hai. Conscious efforts have to happen to make it happen. So third is agriculture. There's more we see agriculture, I find it's a big focus area for our bank, rural economy. Okay. Not only from priority sector requirement, we need it from priority sector requirement point of view also. But it is pretty tragic to see how unfunded the rural economy in the country is. So if you ask me what are 3 focus areas, since you asked me, I'd say these 3 sectors, which is maybe the rural, the microcredit of the small entrepreneurs, and of course the new emerging sectors coming up.
Now small or medium also, nowadays they mention as NAMO, which is essentially, I think...
NAMO or even Nano, yes, Nano enterprises.
NAMO also now. Anyway, Mr. Mistry, one thing which was touched upon in the first question also about the deposit mobilization, you also understand the housing space really. Which housing mortgage building, how does one then fund the expected credit growth? I mean, from your vantage point, how would you look at it?
So if you ask me on liquidity, in my opinion, this phase where banks are running short of deposits is a temporary phase. Is a temporary phase, in my view. I think at some point of time that will change. You need to understand the reasons also. If you take the last 2 or 3 years, there has been some pickup in inflation. Post the Russia-Ukraine war, oil prices shot up and we saw inflation going up. And I think RBI did a fantastic job, truly mean it, in terms of bringing inflation down. But having said that, what has happened is, whilst the core inflation number is about 3.13% or something, certain items of certain products which are consumed by the lower middle income and the poor, the inflation on those items has gone up. Food inflation, for example. If you take food inflation is 8%. Within that, vegetables is higher, cereals is higher, pulses is higher. So the type of products which are consumed by the middle income, lower middle income people, inflation has picked up. That's one. Second is, if you had taken a housing loan in 2022 and you've taken the loan at, say, 7.5%, that same loan today is being serviced at 10%. That's a 33%. 7.5 to 10, say. So that's about a 33% increase in the interest in the liability. So all in all, the saving capacity of the lower middle income people has got impacted. And that is probably one of the reasons why you're seeing that bank deposits has come off. Also, what we've seen is that the investment in real estate has picked up substantially. So within household saving, real estate has gone up, bank deposits has come down. This is a phase, in my opinion, at some point of time, difficult to say whether it'll be 1 quarter, 2 quarters, 3 quarters, but I'm sure it's going to change. Now on housing, I think it's not that there is no availability of money for housing. There is availability of money. Housing is booming. Housing markets have been growing very well. A lot of people talk about the low-income housing and the affordable housing and the high-income bracket and the metros. And a lot of people, I've read a lot of comments about how metro prices have gone up and the demand and the lower-income segment has come down. I would put it a little differently. I would say don't look at the last 2 years or 3 years. You have to look at the longer time frame. If you look at the period from 2016 to 2020, the metro market was very weak in real estate. And you may remember all newspapers were carrying reports about oversupply and the fact that demand was not there and things like that. So from 16 to 20, house prices in the metros did not go up at all. If anything, they came down. So when you're seeing a sharp rise in prices and demand from 2020, late 2020, post-COVID, to now, you have to look at it from an 8-year or 9-year point of view. And if you look at it from an 8-year, 9-year point of view and average it out, it's not that high. So I think as liquidity comes back into the system, I think the lower income market will also start picking up. And I think the government, in my opinion, will do something for the affordable housing segment in the budget.
In the budget, you say?
In the budget. Whether it's in the budget or it's immediately after the budget, I don't know, but I guess there'll be some allocation in the budget. And the reason I say that is, apart from the need to provide housing or make housing affordable to that segment of the market, housing is a huge employment generator, massive employment generator. So it has a multiplier effect on the entire economy, because it's not just the jobs that you are creating in the housing sector, it's also the jobs that you are creating in sectors like cement, steel, paint, all the other ancillary industries associated with housing. So I think you should, I would expect something in the budget for the affordable housing segment.
Okay, so that's a good insight. Hopefully there's something on the budget that we have to see from the housing side. Ms. Darwala, this point that Mr. Mistry left us with about job creation, which since it ties in with our inclusive growth thing as well, in your view, which are the areas where you think, creating employment and therefore that banks, what is it that, how can they drive in this journey? So if you can throw some light on, how will we see the credit, therefore, scenario change?
Okay. So I think as we see, jobs is a real focus for the government. And if we look at various sectors, if we look at, for example, China in 1991 was 9% GDP in manufacturing, and today it's 30% plus. And clearly that is one sector where we'll see a good amount of job creation. If you look at manufacturing again, all the industries which are infra-linked, like steel, cement, we're seeing good amount of capex happening. If we look at non-infra, like Keki said, real estate, 35 million square feet was done in H1 of this year in terms of just residential real estate. That is a big employment kicker. And today, if we look at construction sector, it's today employing about 7 crore people. That's expected to be 10 crore people employed. In terms of manufacturing, again, if we look at the new age sectors, like the whole EV ecosystem, the battery storage, the whole battery manufacturing, all the new age manufacturing sectors are going to see serious capex coming through. And that, again, will create another cycle of jobs. Electronics, for example. If you take one Foxconn employs 77 lakh people, 7.7 lakh people globally. So that's the kind of employment electronics creates. And that's, again, something thanks to the PLI scheme we're seeing good amount of job creation happening. So there will be various sectors, and of course the government needs to focus on labor-intensive sectors like garment, leather, footwear, etc. Those are, again, very, very big employment generators. If you look at garments, every 1 lakh rupee you invest, you're able to create 8-9 jobs. And it's 240 times more labor-intensive than steels, for the same amount of capital investment. So it's very, very imperative that those sectors are focused on. As far as banks go, I think banks would be happy to fund any of these activities as and when the investment cycle has already kicked off. It will only accelerate.
Okay. On the previous point of Keki, on the previous point Keki was making, see, the thing is that, while we talked about the fact that money is moving from the banking system maybe to investments or stock markets, whatever. But remember, for everybody who's investing, there is on the other side, there is a seller. And that seller is putting the money back in the banking system. If you're investing the money in a mutual fund, that money is going to some company and so on and so forth. So it's not that money is leaving the banking system. It is only the nature of the money is changing from being a retail deposits to maybe a corporate deposit or something. So I'll share you one statistic which will be important for you to understand this discussion, what Mr. Khara said and Mr. Keki said. See, the thing is that if you see the total deposits of the country, in the peak of COVID, 61% of the total deposits was retail deposits, 64%. Today it has come down to 61%. So obviously money has left and gone somewhere in the last 3 years. But if you see the corporate deposits, which is financial corporates or even normal manufacturing corporates deposits, that has grown from 21% to 24%. So I just want to clarify to you that money has only changed shape from retail, but the money is still the banking system. So we should not make it feel, oh my God, mutual fund is growing, so deposit is going to leave banking system. Aisa nahi hai. I just want to clarify that to you.
Yeah, but then when it invests in a stock, you invest in a stock, isn't it? It's not that one is... it's being used as a vehicle, isn't it? The banking system. A
vehicle. Money is going outside to a bank. Yeah. It's maybe, you get the point. So the thing is that, I told you, of course, the nature changes from retail to corporate. So still the issue of being able to raise retail deposits and compete for retail deposits, that is still real. You still need to go through the process. And for that, I really believe we should give really fantastic experience layers. Like you asked him the question, in our case, we have built a bank like a very, very digital bank. Our experience layers, we really made it fantastic for people building the app and using. So with that, we are able to get deposits to customers from having with us. So in the fight of retail deposits, experience layer becomes very important. But overall money is in the banking system.
Yeah. Mr. Gage,
I just add to what Vaidya said. I think absolutely is right. When money goes to the stock market, ultimately it comes back into the banking system. Now the only difference is that instead of it coming as possibly a fixed deposit, which is a longer tenure deposit, it may be coming as a shorter term current account or a shorter term savings account.
Can you keep the mic closer to
No, I'm saying instead of it coming as a fixed deposit in a bank, it's probably coming now as a current account deposit or a savings account deposit.
Right. And current account
It's
deposit.
An important point to understand, because people tend to think, oh my God, money is leaving banking. Kuch nahi ho raha, yahan se wahan
but
gaya.
as he says, coming back as current account deposit, this is 0% interest rate also.
Achhi baat hai na, to kya problem hai?
There is no benefit in that in any case. So, Mr. Khara, coming back to the point which we touched upon with Ms. Daruwala also, if the newer sectors are there, if the areas in which we will see investments happening, what would you think as as sectors that will see investments coming in? So how will, therefore, as you see it today, the direction of the growth, how will the growth in the future now be different from how it was in the past, given the way in which the investments and the drivers that we're looking at?
Sure. One of the major paradigm shift which we are observing on ground is the focus for the renewable energy. And it has got implications across the sectors. I'll first touch base upon the solar in particular, and also the way the solar capacity is being increased with the overall goal of the country to have 450 gigawatt solar energy by the year 2030. The way these new projects are coming up is something which affirms that we are on the right track. The second aspect of this, of course, which is essentially in terms of the new scheme which has been launched in terms of PM Surya Ghar, where more than 1 crore households are going to have rooftop solar. I think it is going to be another major game changer, because the rooftop solar means also the solar panels, solar cells, the whole lot of new industry. This is actually a new lever of growth which we get to see in our economy, and it is moving very fast. The capacity is getting created in terms of solar cells, solar panels, execution of the solar panel for the household sector. There's a whole lot of new sector which is coming up. That is one. Secondly, the other area which to my mind is very, very promising, what was rightly mentioned in terms of the rural economy. Logistics is becoming a very important sector. With the kind of road network which has come up in past few years and the kind of efficiency which is there on the road sector, logistics is becoming a huge opportunity, and right from the warehousing and cold storages across, it has actually given a significant fillip to the rural economy as well. So it's a new way of looking at the rural economy, I would say. And SME, of course, things are changing quite a lot. Availability of data relating to GST, availability of data relating to the unstructured data relating to SMEs, it gives a very clear visibility in terms of the SMEs' conduct and behavior, and which has improved the underwriting for the SMEs also. So that is one of the reasons why perhaps we get to see much more traction. And of course, the last but not the least, to address the last mile funding, the way the NBFCs are growing and also adopting the newer ways of lending is something which is going to be the other reality. Having said all this, retail, because of the ambition and the aspirations of the common man in the country, that is something which will continue to be the flavor of all seasons. That's how I look at it. So I think these are the areas of growth, and we are seeing good traction in all these sub-segments of the economy.
Yeah. Mr. Vaidyanath, I'm sure you will agree with whatever Mr. Khara has said, unless you would want to add anything to that, and to you, Mr. Mistry, and Ms. Daruwala, to the same points. But to you, the additional question which I had is which something Governor also addressed to. He talked of cyber frauds, technology and all of that. Technology at one stage used to be for risk aversion, actually increasing productivity, then risk aversion, now identifying problem areas. Now we are getting into a scenario where even the regulator is looking for automated audits and no human interface. Typically, I'm told that 10% of the funds are invested in technology or something, but technology is going to be increasingly a huge budget for banks. at a strategy level, how is the approach to technology and funding to it, how is that being looked at? If you could share some thoughts.
So when you say approach to technology, one is, of course, the point that you made just now, that cyber security is a very serious threat, and investments, of course, needs to go there. But let me just move from there to say that to build the entire technology stack of a bank, which is the infrastructure layer, the applications layer, the middleware layer, the channels layer, the customer interface layers, the data lake, the data engineering, the pipes connecting, this whole stack building of the new modern stack to build, to take advantage of the new ecosystems, is going to be really important. Because if the stack is not good, we cannot give a good customer experience. We can do whatever painting you want to the app. It won't give experience layer. So we at our bank, to your question, are investing in building a really, I believe, fantastic, top of the world stack here, and that is our focus. And with a really good technology stack, and people who have experienced a bank app, for example, can now almost see a big difference in terms of the experience. Now, again, at a strategy level, the difference is about how will we connect to the ecosystems, because this is a stack. There are ecosystems. There are account aggregators come. Bureau is there. Open is there. ONDC is there. A lot of this ecosystem, KYC, e-stamping, e-agreement, the whole ecosystem is coming there. So our ability to connect with all the ecosystems will depend upon how well we build the technology.
Because ONDC, supply chain, financing, all those elements come in.
So how do you connect? You can have all these ecosystems there, but how do you connect? Only with a good technology stack. So we believe that, to your question on investments,
yes.
To build a modern stack which is set for the future, or building the bank for the future, is our focus area.
Okay. Mr. Mistry, unless you would want to have any view on what we discussed on technology, one thing which I do want to address from a banker's perspective is, it's flavor of the season to talk of interest rates. So your outlook on interest rates, this has been something which just gets meshed into any discussion. So before we get into other things.
All right. So before I talk of interest rates, I'll just add to what Vaidya said, which is that at no point of time in a bank's history can you say that my technology is perfect. Because there are changes that are happening by the day. As we speak, there is something or the other that is happening. And the kind of cyber risks that are increasing day by day by attacks from different sources, I think that's a big worry. And artificial intelligence and so many new things are coming. So your cost on technology will always continue. Now, my view on interest rates, I think we put too much emphasis on interest rate. I think it's more important to understand the liquidity situation rather than just talk of interest rates. Because if RBI was to reduce interest rates by 0.25%, which I'm sure in my opinion, in the course of the financial year, it will happen. Maybe November, maybe December, maybe January, I don't know, it probably will happen. But at the moment, it is more important that there is some liquidity which is infused in the system. Because by reducing interest rates, effectively what will happen? The benefit of the lower interest rate will go back to the customer. But the cost of funds of a bank is not necessarily going to come down. So you may put a little more pressure on the margins of the bank. That's at least my view.
But whereas you're talking of liquidity infusion.
Whereas if you were to put more liquidity in the system, maybe by reducing the CRR a little bit or some other mechanism, then you will automatically, the benefit of that lower cost of funding would be passed on by banks to customers. So liquidity infusion, in my view, is at the moment more important than just reducing interest rates.
Even with the inflation rate that you talk of 5.1%, do you think there is a case for liquidity infusion?
Yeah, but you look at it like this. Where is the inflation high? Inflation is largely high because of food. Now, would reducing interest rate make a material difference as far as food inflation is concerned? Your core inflation is now 3.13%. So core inflation is very, very manageable. So I think there could be a case. Monsoons are good this year. Hopefully food prices will also come down. There is no geopolitical issue at the moment. It's been continuing for the last 2 years. There's nothing additional that is happening. Oil prices are not suddenly spiking. So there is room, in my view, before the end of the financial year to perhaps look at the interest rate cut. And we are seeing that in the US. more and more we are hearing about the US, possibly the Fed reducing interest rates.
Okay. Ms. Daruwala, you have any thought on this? Or you could...
I would agree with what Keki said.
Can you be a little keep the mic a little closer?
I would agree with what Keki said on the interest rates. I think liquidity is also a very important factor. And interest rates is a function of global interest rates plus local inflation. So it's many considerations which go into whether to reduce interest rates or not. So it's a very dynamic thing.
Yeah. One quick point which I do want to refer to, and I think you have done some work at Standard Chartered on this as well, is on sustainability financing. That is one area which even the governor referred to. The problem that is, when we talk to people in this sustainability space itself, they don't know define kaise karna hai. How do we measure it? We really don't know. And that is going to be a regulatory compulsion for the corporates as well. So there is a need, but there is still no understanding on this, and it has to ramp up. How are banks thinking at it? And I would appreciate if all actually can share some thoughts on this, starting with you, Mazari.
So globally, we have a practice, sustainability practice, where we sort of guide our clients, handhold them, and it's something that we do as pro bono kind, just sort of with our clients. And also there are external agencies now who sort of actually validate your assumptions, etc. They give you ratings. The big companies in India are already looking at those agencies for an external validation of what they are doing. So that process has started for sure. Actually, one is a very clear kind of sustainability. The second is transition finance. I think that is also very important. So if it's a steel company, and how are they looking at the electric arc furnace transition?
In fact, the governor specifically referred to it.
Oh, okay. Yeah. So you're seeing different companies actually, which are very energy intensive, actually looking at transition. So that is also an important element of the whole sustainable finance. And the third element is also how are you, for example, how are you recycling your water? Many other parameters also very, very important. So it's a fairly comprehensive kind of play, I would say, in sustainability. Yeah.
Mr. Dineshkar, how are you? I mean, are you reskilling your people? Are you? How is the kitty on this front emerging for you? What do you see as the key priorities in this space?
No, well, of course, there are two sides. One is, of course, RBI also came out with their guidance for raising the green deposits. So we started doing that. And simultaneously, when it comes to green lending, that is something which is a part of our focus. As I mentioned in my previous statement, that renewable is one of the major focus areas, and we are encouraging renewable is one of the major focus areas, and we are encouraging even the corporates also, that wherever possible, if at all, they can go for adoption of the green through the solar, and also for the water treatment plant, etc. So we are funding them for all that. Actually, we have now for about 2 years, we have started doing the ESG rating. That ESG rating is essentially being used to nudge these corporates for improving the ESG compliance standards. Now, of course, with the, for the listed corporates, it is mandatory because of the SEBI. We are required to give the status relating to adoption of green. So that is also one of the reasons why perhaps it has been made mandatory from the last year onwards. So this ESG rating which we are doing is actually helping these corporates in terms of ensuring compliance with the SEBI requirement too. Eventually, the fact remains that the green depositor expects little more from the bank, and when it comes to green lending, they expect little lower in terms of interest rate. We have started doing a bit in terms of when it comes to financing EVs. We charge about 5 basis points lower, and we fund 100% on-road price of the EVs. This is just to give a nudge in the society for adoption of EVs. some little bit of calibration we can do at our level. But eventually, if at all, we have to see these kind of things happening at an industry level. Perhaps we had, at a point of time, made a request to RBI if at all they can consider some kind of a lower CRR for the green deposits.
Lower CRR for green deposits.
Yeah, if at all that can be done, it will give some kind of elbow room for the banking system to pay a little more for the green deposits.
Okay.
And likewise, it is something which will go a long way in terms of encouraging banking system to raise green deposits and also lend for the green purposes. Yeah. That is something which we have taken some baby steps, I may say so. But yes, of course, almost about 50,000 crore worth of book we have already created in the green lending. So that is
50,000 crore.
Yeah, 50,000 crore book we have already created. And we are, of course, we are raising the funds from some of the multilaterals also, which is helping us in sort of lending to and at least adoption of the green across the corporate sector in the country. So these are some of the initiatives which we have taken. But yes, of course, as an organization, we have already set up a department headed by a fairly senior functionary in the bank, so that we can have a coordinated effort for the green. So at a bank level, we are doing so many things which are green, but at the same time, for the ecosystem also, these are the initiatives which we have taken.
Yeah, Mr. Vaidyanathan, if you have anything to add on this before I come to the last question and then we take the audience question.
Yeah,
I also want to check, I just want to add in this point, when these are green deposits, the problem which we talk in the market, they say that what is the benefit? I mean, if there is no higher interest rate there, if it's going to be like any other deposit, then why put money there? So any thought on whether tinkering with that will help and anything else that you would have?
Yeah, to your earlier comment. See, the thing is that ESG is now become a real focus area. Okay, I'm not sure even 3-4 years ago it had gathered the kind of heft and seriousness. In our bank, we have hired we have a person called Shikha Hora, who's a senior person, who's the head of one of our many large businesses. We have given her the responsibility of doing ESG and directly reporting to me. Okay. At my level, imagine, one down is head of ESG. And we do this to get the focus. Because ESG is not a department, though the person reports, it runs horizontally across the bank.
Across the bank.
And because if you think of corporate banking, they're also supposed to ideally do ESG financing, not avoid a coal financing, but finance a more ESG product. But if you go to retail banking, there's a lot of ESG work can be done there. We are doing. For example, when you're financing, say, let me say, solar lanterns, or solar panels. We started a business for that. Now we started financing, say, toilets. And by the way, repayment in toilets for the poor, for relatively poor people is fantastic, really good. And we have a close to about 800 crore portfolio, and repayment rate is 99%. So we are finding that not only large, but below the bottom of the pyramid, financing ESG products like the ones I talked to you about can be a focus area, and that comes through when you have a dedicated focus in the bank, in our opinion.
Okay, thanks. Mr. Missy, the point about now, we just want to conclude with this point about, I mean, everyone talks about what is happening in the budget, what's going to happen. In your view, you mentioned this point about affordable housing. In your wish list right now, I mean, we are free in a free country, so we can obviously have a wish list. One would be 2-3 wish lists that...
So I would say, in my opinion, the budget will probably revolve around 6 broad pillars. The first will be growth. We've done growth. We've done extremely well compared to other countries, compared to the Western world, compared to emerging markets. And I think the government, RBI, have done a fantastic job. And I think that momentum on growth would continue. The second will be employment generation, and therefore focus on sectors which create jobs. Like we talked about housing, we talked about infrastructure, sectors like that. Third would be consumption. How do you drive consumption? Maybe driving consumption could be done again in a variety of ways, so driving consumption. Fourth could be the rural economy. Fifth would be manufacturing. And the sixth could probably be just fiscal discipline, making sure that the fiscal deficit does not breach the level that was originally mentioned. And I think that would happen because the tax collections have been buoyant, and there are other factors which would point towards fiscal discipline.
Is there any new, or Mr. Vaidyanathan, anyone?
Yeah, to supplement what Keki said, I think government will continue to, the whole infrastructure focus, I see that continuing. Like CRISIL report says that 20 lakh crores per annum is the expectation per annum for next 7 years. I think that will continue. PLI, I think they will keep on refining it based on the experience of the past. And PLI particularly for job creating kind of sectors.
Though we still don't have a proof of concept, I mean, how they will survive without the incentives of PLI, we still have to understand that, but you still feel emphasis will continue.
Emphasis will continue. I think they will refine based on the experience of the earlier this thing. That feedback they are already asking industry and many others as to what needs to be done. So that for sure will continue. And employment generation kind of sectors, those to my mind will definitely continue.
You agree with that, Mr. Dineshji, or anything else you would want to?
I agree absolutely with whatever has been the wish list, if I may say so. But yes, of course. Only one more point which I would like to add is rationalization of the tax treatment on the earning through the various asset classes, investment asset classes.
Is that likely, you think?
At least it's a wish list.
It's a wish list, yeah, correct. So nothing wrong in wishing. If we can open up for the one or two questions from the audience. Yes, please, can you identify yourself and just be very brief because we are running short of time. Whom would you also address, want the question to be addressed to?
Yeah. Good afternoon to Khara sir and Vaidyanathan sir. Sir, firstly, you talked about deposit rate. We are open to changing, hiking deposit rate if we need more deposit in our bank. Product fixes, whatever is necessary to get the deposits in. So recently you did raise some tenures on term, but is it more likely that SBI will further hike deposit rate either on savings or on term side? One, to you also, sir. And on infra loans, sir, like ma'am mentioned that there's a lot of employment generation capability in the sector. The RBI draft guidelines have come in which suggest 5% provision. So would that actually lead to slowdown or a hike for infra costs? What is your suggestion or your recommendation to the RBI?
I think that we can keep it to this.
Yeah, that's all. And sorry, because everybody asks this question to Das sir, but to Khara sir as well. Will you, after your retirement, I mean, we are very near to that, so what are your plans after that? Thanks.
We'll continue, it will be extended. Mr. Khara.
Well, as far as the decisions relating to interest rate, we review the positions time to time in our ALCO, and depending upon the gaps where we feel that we need to be in line with what the market is, we do come out with some kind of a calibration in the interest rate. Your second question was relating to impact of the guidelines. Not the guidelines, it's a discussion paper actually about the provision for the infra loans or the project loans. Actually, it is project loans. So I think on that, RBI has invited the views of all the stakeholders, and all of us have submitted our views on the matter. So let us wait and watch what is the final verdict in the matter. But perhaps it has to be seen in the context of the introduction of ECL2. And if at all it gets integrated with the ECL, my sense is that impact may not be as high as it is being envisaged currently. And your third question, it is about a month away from now, but one thing is very clear, I will be very active, and depending upon the opportunities, I'll look into it.
Let me tell you, Mr. Khara works on Sundays also, okay?
Yes.
So he's like insane, man. Okay, so he is Sundays, by the way. Am I right? Yeah. So you can never keep him off work.
Bankers never go into the flip side, on the evolutionary flip side. They never go on that. So I think they will remain that way. So I think in the interest of time, sir, I can ask one more question, but if you can be very brief, because we just run out of time. Yeah, last question.
My question would be green. and again I'll keep Mr. Khara occupied. Mr. Khara, you said that about green deposit, you can pay higher interest rate, whereas general understanding is that those who put money in green deposit are willing to take little lower charge on that. Just wanted a clarification.
But the fact of the matter is, when we started building up our green deposit book, this is the actual ground level feel which we could get. That is why my sense is that probably the customer are expecting little more incentive for keeping the green deposit.
Yeah, thanks so much. One round of applause for our incredible speakers. They have given enough time and a busy day. Thank you so very much.
Thank you. Thank you very much.
And we break for lunch now. We'll convene after half an hour. Thank you very much. be starting our next session, a standalone. Welcome back, everyone. Good afternoon, ladies and gentlemen. We request you to be seated. And let's continue with the next session for today. We come out to an afternoon session which is going to be packed with fireside chats, panel discussions, and leadership notes. Requesting everyone to follow our housekeeping rules, which is like keep your mobile phones on mute, silent mode, and let's get prepared to attend the next session. So, requesting everybody to be seated. Before we go on, let me take a moment to thank our valued partners who have supported us in this much-awaited summit. Let's start by thanking our supporting partner, Adani Connects, Cyril Amarchand Mangaldas, Pay with Ring, STT GDC, Utkarsh Small Finance Bank. Our knowledge partner is IAS Sarthi, and our exhibition partners are Notify Visitors and Live Long. Do visit our partner and exhibition site so that you will have more knowledge of what they are bringing to this podium. So now let's start out with a special address and a fireside chat later with Ms. Praveena Rai, who is the COO of NPCI. Please, ma'am, welcome to this. We welcome Ms. Rai onto the podium, please. Please, let's start with a big round of applause. Yeah, thanks. This session will be moderated by Mr. Roshan Puvaya, who is the editor, Financial Express Digital. Yeah.
Thanks, Lavanya. It's usually pretty difficult, handling the session just after lunch. Everyone's kind of a little drowsy. But I'm sure all of you have, at some point today, used UPI. And we have here the people or the person behind UPI from NPCI. Mr. Dilip Asbe was supposed to be here, but due to some commitments, he couldn't. But he's sent his most able lieutenant from NPCI, Praveena Rai. She's the CEO for NPCI. And we've had the pleasure of connecting earlier as well in a few fintech panels that we had. So just to give you some statistics, and you can correct me if I'm wrong on this.
We closed FY24 with 164 billion digital payments, and 4 out of 5 of these payments were through UPI. 131 billion UPI transactions were noted. About 200 trillion rupees worth of transactions were done through UPI. Now that's a staggering number. And if you look at the year-on-year growth, there's a 49% rise in volume and 36% rise in value when you compare, say, last month's transactions to, say, 3 years ago in 2021. So if I may just ask you, the journey so far in UPI payments and with NPCI as well, not just with UPI, I mean, you have all the other payment infrastructure. FASTag is something that has been really picking up, so we'll talk about that as well. If you can just give me a perspective of the journey in the last few years post-pandemic.
Hi, wonderful to be here. Thank you for that nice introduction, so I don't have to go through all those numbers. So it's been, of course, a very interesting, challenging, but fulfilling journey, right? So what's fulfilling is during the pandemic, and since you referred to that, there was a lot of innovative use of digital payments, specifically UPI, that the industry really stood up and took to market to support the physical cum digital transactions that were prevalent at that time. And customers loved it, users loved it, merchants loved it. So there was already a good traction happening, and this sort of gave it a second level of bump, and whoever the users were who came on board have continued on board. And nearly every month, on a going basis, UPI adds anything from 3 to 6 million users on a monthly basis. So I think the love for UPI and how much users really enjoy and benefit from using it has not gone away. The journey in the, behind the scenes, of course, is where the fun intensity is. And that's really about continuously looking at, customer problems and looking at how that gets solved. So there is the entire experiential area. And there's also the piece around technology, right? Experiential area is to look at how do we eliminate friction, how do we make this user journey more convenient, how do we bring more use cases that users require, which go beyond a regular payment, like person-to-person payment, and of course there is person-to-merchant payments, and then there is the e-commerce, right? And then there is mandate subscription. We spoke about that some time back. And now there is, credit on the rails of, these payments. There is offline payments because in areas where, the signal is not very strong. Exactly. So I think looking at every problem statement and solving for that is one part of the journey. The second is to look at what really is the experience of the user. So one is to have a nice experience journey drawn out, but the second is to deliver that experience, which means that any time the transaction is tried, it has to work. And that's the whole, end-to-end piece. And this phenomenal surge of volume looked at the whole supply side of this equation that had to step up and up the game on infrastructure, on technology, how quickly these transactions are fulfilled end-to-end with a high level of reliability and availability. And that creates customer confidence, that creates trust. And I think that's really where, we kind of stand today. And you did refer to the fact that this is not just all about UPI. So UPI, of course, is a big pillar. But there is the whole credit piece with cards, RuPay. Another area where, RuPay today holds nearly more than 10% share of market, starting with hardly 1% or so as of just 3 years back. And there is the instant payments, right? IMPS, NACH, and that's where one would put things like Aadhaar payments and tolling. So tolling, the experience at the toll booths now is phenomenal with mandatory tolling, as long as, of course, you don't get stuck with somebody in front of you who's having a debate with the guy at the tolling window. And there again, the government has now, I think, made certain announcements on how they want to take that forward even further, and we're very much there in the thick of things.
Right. Since we're talking about, inclusive growth, and that's the theme of today's entire summit, you mentioned offline payments, and also, we were talking sometime earlier about how cash is still predominant in the Indian market. Your cash to GDP ratio, if I'm not mistaken, is still around 13.7. It's the latest figure that I have. It was around 8.7 at the time of demonetization in 2016, 2017. It went up to about 14.5, but it's come down a little bit now. But do you see, digital payments like this being able to completely disrupt that market, bring it down?
I think it's brought it down phenomenally, So when you referred the value of transactions, right? Not just volume of transactions, but value of transactions. Volume creates a velocity, the frequency with which we are able to make these payments. But value reflects the actual impact that it is making in GDP terms. So actually, 2 trillion is more than a turn of the GDP. Yeah. Having said that, this is retail payments, right? So there are many spaces and swaths of the economy which are beyond the realm of just pure retail payments, retail digital payments. So there are large value payments happening in many sectors which may or may not necessarily be amenable to the kind of solutions we have right now. So I would rather craft this and say, what is the growth of digital payments, digital retail payments, and to what extent are they solving that part of the puzzle? And if you look at anecdotally, today if you go anywhere and you're trying to expect change, you're probably not going to get it. I've had foreign visitors come in and say, I want to just collect some notes and coins, to take back to my son, and I couldn't find anything. So I think, yes, it's not a quantitative number, but I think it's a qualitative dipstick sense to say that when it comes to retail payments, clearly we've moved eons on the digital side. Broader GDP and cash to GDP is, I think, a conversation that has many more layers to it.
But what about certain sectors, like we were just speaking a little earlier about, the agriculture market, probably housing, infrastructure, where you have daily labor. There's still a lot of cash transactions that happen there. How do you think that can be reversed? Even though, there were Jan Dhan accounts announced and almost probably a large swath of the population has Jan Dhan accounts, but they're not active. So how do you think that can be activated?
Actually, a large part of these accounts are active. They are active on Aadhaar payments. Okay. Sometimes they're active, and I have we have a number of use cases where security, for example, right? Large security forces are paid with a prepaid card. So their salary is actually loaded onto a prepaid card, which then they can cash it out or use it for whatever purposes they need. So I think that's a process, and slowly that share is increasing by the day. Now, if there is intention to stay out of the formal economy, that's a completely different problem. But outside of that, I think people find convenience. Okay. And the use cases are there as long as it's within the limits of retail digital payments.
Okay, so so India is considered a leader in the digital payments space, and we are, thanks to UPI and the whole India stack, taking this to the global markets now. If I'm not mistaken, we are close to 30 markets now where we're talking about UPI transactions happening. Where does that stand?
Yeah, I think, there are different streams there, right? The first one, the most simplest, is that every NRI wants to use UPI. When they travel into India, they want to use UPI. When they are trying to help their family or friends or, make some bill payments in India, etc., they all have some either family or some, infrastructure in India that they are trying to support. So they're really, really keen to use UPI. Every foreign visitor into the country, notwithstanding the fact that they actually find it difficult to use cash, they want to use UPI. And this is a basic stream of services that has now been opened up. Then come the actual international pieces, right, which has 3 legs. Yeah. One is to say how are remittances happening, and both inward and outward remittances, and a number of corridors have opened up there. The second is actual deep integration at this level, so that somebody traveling out from India can use UPI. And again, UAE is a market which is very well penetrated, Singapore, and there are some where the market enablement is already in progress, and some that are in the phase of early MOUs being signed and so on. And the third is really lift and shift of the whole tech stack, guideline, operating model, both for RuPay and UPI. And the UAE, for example, will be one example of where that is starting to play out. So I think you're right in the ballpark, each at a different phase of that journey. But these are all the various streams in play.
Right, okay. Well, UPI is now almost ubiquitous with, payments. What about, your working relationships with mutual funds, insurance players, of, enabling transactions there through UPI?
Yeah, so any payment system inherently interacts with the banking account. So it is a debit to a banking account or a credit to a banking account, and including insurance companies or mutual funds who will have a bank account.
Okay.
And in compliance to certain requirements, the credit has to reach those bank accounts. So inherently it is enabled today. But we do work, and a lot of work streams are there currently in progress, where solutions which are more targeted and focused towards the needs of these two sectors are under play. So for example, if you look at the investment side, there is a requirement to have validation of the account or validation of the PAN before credit is actually made to that account. So that is in progress, obviously subject to certain regulatory approvals and so on. So that will solve a need so that it's not a two-step process that validation is happening independently followed by a payment. It can be stitched together. Similarly, of course, in the IPO space, I think UPI is already a strong player. It's called Block and Pay, and supports the ASBA process. About 55 to 65% of all IPOs when it comes to retail subscriptions is happening on this model as we speak. Okay. Now, there's also a proposition called the single block with multiple credits that can help secondary market transactions, and certain pilots are in process there. So a slew of actions happening on the investment side of things. As far as insurance goes, I think, the need of the market has been around how do you stitch this whole claim process together, right? How can that, become platformatized? How does one look at really addressing the need of making a part payment with your own funds and the rest of the payment being through the claim? So again, very interesting solutions being stitched together. The basic subscription service around UPI or RuPay AutoPay already supports what I will call mini SIP investments or small value insurance premiums. So some basic solutions are already in place, and many of them are starting to now getting stitched together. And I think broadly this is what the industry calls embedded payments. So basically you're embedding the payment into the flow of that transaction in a way that makes the whole process more seamless. And it's not required that there are multiple steps involved. Like the ASBA process, when it happened, I think it killed the whole end-to-end process from about 10 days to hardly a day, right? And without blocking the funds of the investor. So I think those are the kind of significant changes that can come about once these implementations are in force.
Right. The other thing that has been an ask in the industry is about enabling credit over UPI, and how would you go about, probably valuing your, creditor, or if there's some kind of a credit score that can be done through the UPI transactions before giving them credit.
I think this is, sort of in force and being deployed today using two models. One is, of course, it could be the bank and the customer of the bank who already has visibility to the digital payments and uses that data to really evaluate the propensity of a user, the credibility of the user, the kind of funds flow that the user has, based on which they are able to then provide credit. The second is using the account aggregator infrastructure, again a very strong consent-based architecture, where a user can ask for their data to be provided to a third party who then provides the credit or scoring interface. So I think both of these are in play, the first one to a very large extent. And in India, we really have a lot of opportunity there, because when it comes to our credit mechanisms, we still look for salary slips, and we still look for a lot of documentation. still, look for not surrogate information that tells us that there is a steady flow of income, that tells us that this user is someone with high level of integrity, reliability, cash flow, which data can do, right? And so we are starting to see that in a very significant way starting to play out.
Okay. The other thing I wanted to ask you about was, see, UPI is a very technology dependent service, right? And there is a certain failure rate. But how much of that is related to technology and how much of that is probably from the business decision or from the buyer side?
So the technology one is, non-negotiable and not acceptable from the user standpoint. It absolutely has to work, right? And all the way, if you look at a flow from the merchant to an aggregator, to an acquiring bank, NPCI switch, whatever this may be, let's say it's UPI or RuPay. And then we have the issuing bank, which is the bank of the user. This transaction end-to-end has to work through all these hops. And we look at a benchmark of 1%. So that's 1% of the transactions, not more than 1% of transactions can fail because of an issue in any one of these areas. Now, and there are many mechanisms, that we really look at for that. Earlier, there was a situation where if there's one large player who had a problem, then there is sort of a, pile-up effect on everybody else. And those kind of challenges were there. But with every issue, I think as technology comes in and solves it in different ways, we're able to isolate so that there is no follow-on impact at the overall ecosystem level. And largely, most players are in sync with this, and this is something that is tracked at a regulatory level and tracked at NPCI, and of course we have our observation centers where we look at this data very strongly. When you look at business decline, which is really more in the hands of the user, and that can come from different things, right? Somebody does not have enough money in the account but is trying to make a payment, and these could be errors also. I have a couple of accounts, I don't know where, I have some funds and I'm trying to make a payment from the other account, then I correct it and I make the correct account, but in the system it will still show up as sort of a failed transaction. But there are also cases where customer awareness, customer action by way of enablement, for example, RBI is quite particular, that customer users of cards have to activate and enable themselves for e-commerce, international, contactless, national, the offline transactions and so on. And if the customer is aware, not aware, or sometimes, I've had people tell me that I had enabled myself, then I thought, why I'll switch it off, and then I traveled abroad and then I was not able to change it back. So all this stuff happens. And those sometimes lead to certain level of business declines.
Okay.
But benchmarks that we look at is about 1% on technical, and about, I think we look at 5 as a acceptable number when it comes to business declines.
Business decline. But again, there's a very high dependence on telecom networks, right, for these transactions to go through, because or internet connectivity itself. But you were talking about offline transactions. How much of that, in terms of percentage of transactions, is now offline?
Very, very low.
Very low.
Very, very low. And it will continue to be because we do have a pretty good connectivity, data connectivity in the country today. So I think offline transactions as a use case will slowly start building up. And even as it builds up, one would expect it to be a lower contributor. But in that time of need, it sort of still helps to provide a reliable service.
Okay. What about caps on transaction limits? So far it's been about 1 lakh a day, I think, is the recommended transaction limit that you have. Different banks have different limits within that limit. When do you see that being raised, or in other use cases where you can actually have a much higher limit?
Yeah, there's a continuous review when it comes to limits, right? So 1 lakh is a UPI limit. On IMPS, for example, the limit is 5 lakhs. When it comes to RuPay, there is no product level limit. The limit is based on the credit lines the customer will have and the risk profile the customer has with the bank. But within UPI itself, there are now subcategories that have higher limits. So there's a limit of 2 lakhs when it comes to paying what is called verified merchants, which means merchants where larger ticket transactions are expected to take place. and they get whitelisted on the system, and with these merchants up to 2 lakhs can be made. For certain use cases, like the investment use case, the limit is up to 5 lakhs.
Okay.
So there is 1, 2, 5, all these are available limits today. And this is reviewed on a continuous basis. So it's not to say that the limit is static in nature. It is purpose-based and need-based. It has a risk management element balanced with customer convenience. Okay. Right? So if we find certain transactions that are going beyond that limit on a continuous basis, then that limit can be reviewed, and the limit can be upped.
The other thing is, of course, I have to ask you this question on security. I mean, the maximum number of digital payment frauds does happen on UPI. Somebody has scanned a QR code, or somebody has put in their PIN number at the wrong moment. So what are you doing to kind of educate the consumer? I mean, at the end of the day, it's actually the consumer's wrongdoing at that point. So what are you all doing to kind of educate the customer from the NPCI's point of view? Or are you putting in place some more checks that can?
So there are three levels of controls here, right? One is the actual technical and technology-driven control, which is completely bulletproof, if I may use that word. So really, between all the authentication factors available and the way the tech works, there is no compromise at that level. The second is really limits. So when you look at, and we just spoke about that, right? Why do you have limits? So 24-hour cooling, because we found that usually new users become more susceptible, or somebody is asked to download an app and immediately make a payment. So this gives a bit of window where no one can be made to take those kind of actions. On the technology piece, we also now have fraud AI models, which thanks to the industry, a lot of fraud that gets reported in, gets analyzed, investigated, because a lot of it is also misleading. It could be just a dispute. But once it is identified as a fraudulent transaction, that then goes into a model where if the model has a very high score beyond a cutoff, then we immediately reject the transaction. And within a certain window, it's provided back to the bank that can take a view on whether they want to, really process or reject the transaction, because they will know how savvy their customer is.
Okay.
So these models are evolving and help to have a view which goes beyond the intent of the customer. And the third is customer themselves, because all frauds today are socially engineered. How do you really identify this whole model of social engineering? So there are very large campaigns that practically everybody in the industry is running. And there is also a joint committee called the Financial Literacy and Advocacy Committee, through which we do this at an industry level.
Okay.
In terms of awareness campaigns, getting people aware of what the modus operandi is.
Right,
and how they don't fall prey to that.
Right. If we have any question, we can take one question now, and then the gentleman there. Can get him.
Yeah. So I have two questions for you, ma'am. First is on the digital payment score. You also talked about account aggregator-based underwriting when you were speaking. A few months back, you mentioned about digital payment score at a summit in Mumbai. I would love to understand where does that stand now and what should be looking forward to around that. The second bit being on UPI Autopay specifically. UPI Autopay, while the technical decline for UPI is less than 0.5% on more, the top 5 banks, is still between 5 to 12% on UPI Autopay. And even the business declines, while around 70% on execution, on NACH it is around 25%. So why is that, and what are the steps being taken to resolve that by NPCI?
So the first one is, I think, exactly what I had mentioned earlier. So on the back of a consent architecture, right, data can be provided on the back of which there is a good level of work happening on the credit scoring basis. Now, the second point on technical declines. Now, technical declines are addressed in two ways. One is, certainly the whole ecosystem has to get sorted and oriented end to end. And the second is conversion to digital, because NACH also has a challenge that a good part of the transactions are still on paper form. And on paper form, one is still doing signature verification manually and so on and so forth. And insufficient balance also tends to be one of the primary reasons. So insufficient balance, of course, will need pre-notification, and NACH earlier did not have this mandate for pre-notification, which is being introduced now. So that should also help the user so that they know that, they need to fund their account to fulfill this transaction. But as we move away from paper to digital, that should help the cause when it comes to better level of business declines. Now, the whole overall, the success rate which combines both of these, is a journey that is continuously tracked, and every part of the ecosystem, right? If there are 350 banks live on UPI and 50 apps live on UPIs, each one of them needs to deliver that service at a certain level, and that's currently in process.
Okay, since we're out of time, I just have one quick question for you. The budget is around the corner. Do you expect the finance minister to make any announcements that will be benefiting NPCI?
So I think we'll wait and see how that plays out for the digital payments ecosystem.
Okay.
So usually there does tend to be in the last 2 years there has been an incentive that has been offered to the industry. So I think we'll have to see what it brings to the table this year.
Great. Okay, thank you so much for this enlightening session, and hope to see you again next year maybe.
Thank you.
Thank you.
Thank you.
Thank you, Roshan and Ms. Rai, for a great session. Now, with great pleasure, we would like to introduce our next esteemed speaker, Mr. Debashish Panda, the Chairman of the Insurance Regulatory and Development Authority of India. You're invited to come on the stage, sir, please.
Very good afternoon and namaskar, ladies and gentlemen. And the esteemed guests, industry leaders, distinguished participants, a very good afternoon to you. It is a pleasure today to be part of this modern BFSI Summit 2024 hosted by the Financial Express. And I would like to extend my sincere appreciation for convening this remarkable gathering, where our collective minds and aspirations converge to chart the course for a fully inclusive financial ecosystem. An ecosystem where there is inclusivity, growth, and protection. An ecosystem where uncertainty no longer poses a threat. An ecosystem where risks are not daunting, but simply challenges to overcome. Where protection meets possibility, and an ecosystem where the future is secured by the promises we make today. This transformation is secured, or it is not just about economic growth, it's about the complete metamorphosis of our social landscape. Ladies and gentlemen, as we are all witnessing, our nation is evolving at an astonishing pace. We are not just participating in the global economy, we are leading, we are innovating, and we are redefining what progress means. Let's start by talking about the economic surge that India is experiencing today. Our nation operates with unparalleled zest and vigor. And our GDP is just not a number on a chart. It's a testament to our relentless determination and ambition. It reflects the passion, the drive, and the innovative spirit of every Indian. We are not just aiming for short-term gains. Our policies and initiatives are being fueled by a long-term vision. This vision ensures that our growth reaches every nook and corner of our country. Despite the numerous global challenges we have faced, whether it's the pandemic, the climate risks, or geopolitical tensions, India has shown remarkable resilience. Our ability to bounce back and continue growing has garnered global optimism. The world's top executives and industry leaders are convinced that this is indeed India's century. They see the potential, the opportunity, and the dynamism that India offers. Our financial services sector is yet another shining example of this dynamism. The growth we have witnessed over the last decade is nothing short of phenomenal. Innovations like the JAM Trinity, the UPI, the direct benefit transfers, the account aggregators, and so on and so forth, have completely transformed the landscape, making financial services accessible even in the most remote areas of the country. At the heart of this robust financial landscape lies the insurance sector. Friends, insurance isn't just about protecting individuals and businesses from potential risks, but it's about building confidence and building stability. It's about fostering an environment where people and enterprises can thrive without fear of the unknown. Right now, we are the 10th largest insurance market globally, but we are poised to jump to the 6th position by 2032. Demonstrating a sturdy growth, the industry had maintained a CAGR of over 10%, with a premium income exceeding rupees 11 lakh crores in the last financial year, and the assets under management exceeding 65 lakh crores, and the insurance industry providing direct and indirect employment to more than 6 million people. The numbers are impressive, but what's even more exciting is the potential for the growth that exists in today's India, driven by a young and diverse population, and that too with a widening middle class. We aim to tap this potential and take the benefits that insurance protection offers to every nook and corner of the country. And this reflects in our collective vision of insurance for all by 2047, through which it is intended that every individual has adequate insurance coverage and every business is supported by appropriate insurance solutions. This vision actually signifies our unwavering dedication to make insurance available, accessible, and affordable to every individual and business, irrespective of their circumstances. Towards this goal, IRDAI has taken some gigantic steps over the last 2 years, starting from reforming the entire regulatory framework, promoting extensive use of technology, reaching the hinterlands, onboarding all stakeholders towards the common goal, as well as transforming the industry and also making it future ready. With this, we are trying to script a new era of insurance, an era which is progressive, resilient, technologically advanced, and consumer-centric, an era where no one is left vulnerable, an era where every risk is mitigated, an era where every promise of security is fulfilled, and an era where all the stakeholders derive value. Consequently, the last 2 years have witnessed the entry of 6 new insurance companies into the market, and that marks a significant development after a hiatus of 12 years in the life segment and after a hiatus of 5 years in the non-life and health segment. This resurgence not only underscores the sector's inherent potential, but also reflects a renewed and heightened interest from the investors. Though the industry is growing at a double-digit rate, there still lies a huge potential for expansion and as well as deepening of the insurance market in India. There is a significant scope for insurance proliferation in the traditional risk areas like life, health, property, motor, crop, and so on. There's also a big gap to fill in the MSME sector. The missing middle in health requires urgent attention. Additionally, we need to address emerging risks like climate change, pandemics, cyber risks, and so on. As the world becomes increasingly digital, we anticipate a future of continuous underwriting and seamless insurance, wherein consumers demand more and more of personalized offerings. The future will be shaped by the young millennials and the Generation Z, who seek bespoke and flexible insurance products that fit seamlessly into their tech-driven lifestyles. more so in a do-it-yourself, the DIY approach. At the same time, older individuals are living longer and expecting more from their retirement, and that is necessitating flexible retirement plans for an evolving later life environment. There are segments of the population that are still unaware of their insurance needs, and it is the responsibility of the sector to bring them into the fold. These protection gaps, the disparities, represent a massive opportunity, and thus it can be said that the potential of insurance is nothing short of immense. India's vast resources, human capital, technological capabilities, all of this position us to seize these exponential opportunities. And I would believe that the next decade is of paramount importance for the insurance sector, marked by radical changes in the way insurance is perceived, insurance is bought, and insurance is sold. We are trying to build such an ecosystem. When I say we, the regulator, the industry, and the other stakeholders, all together trying to build an ecosystem where insurance is seamlessly integrated into our lifestyles, where premiums are no longer standardized, but the data analytics allows for more and more of customized pricing, where the premiums reflect individual risk and not just the average risk of the group, where the entire insurance process from buying a policy to filing a claim is not just efficient but also trustworthy, where smart contracts automate claim settlement and you don't have to wait for weeks to get your claim settled, but get it instantly, fairly, and transparently, where insurance is a simple, swift, and a personalized experience. This is the ecosystem we should be looking at going forward, while at the same time maintaining a delicate balance in ensuring consumer protection, fostering fair competition, facilitating growth without compromising the sector's financial stability. Friends, the insurance industry has matured over the more than 2 decades of liberalization. The traditional rule-based regulatory framework was not sufficiently equipped to harness the full potential of the sector, and especially in this era of economic and technological advancements. Rather, it was realized that it was acting as a constraint or an obstacle to growth. The evolving landscape demands necessary freedom and sufficient maneuverability, and thus a regulatory overhaul became necessary to align with the intricacies of contemporary opportunities and challenges. Keeping these in mind, the regulatory system undertook a 360-degree evaluation of the regulatory framework to check for its agility, relevance, and adaptability. It was found that there were many strict boundaries which were affecting the pace of the industry, and also realized that it was stifling growth and innovation and also hindering choices for customers. A lot of approvals were required from the regulator even for launch of a simple product. There were a lot of compliance requirements and myriad returns to be filed, affecting ease of doing business and also increasing the compliance cost. The next step was extensive engagement with the stakeholders, following a consultative and a participative approach. These engagements resulted in better understanding of the ground realities, the needs of the sector, and the transformation required therein. The critical insights and inputs received from these discussions and dialogues helped in ideation of policymaking. Not just that, the revised framework was again put up for multiple consultations and for further suggestions, improvements, and feedbacks. As a result of this very extensive exercise, a new landscape has been crafted for the insurance sector. The new landscape builds on the pillars of ease of doing business, more avenues for growth, promoting healthy competition, enabling innovation, and extensive technological adoption, while keeping the interest of the policyholders central. The insurance sector had numerous regulations governing it. If you ask me for the number, it was close to around 78. And this was still around a couple of years back, all accompanied with their respective compliance requirements. And just imagine, remembering only the names of all these regulations was such a tedious task, and compliance was yet another matter. And also the approach was rule-based, which became a little challenging to accommodate innovation and dynamism. So the first task we undertook was rationalization of the regulatory framework, removal of redundant requirements, and moving towards a principle-based regulatory architecture. As a result of this extensive exercise, now 78 regulations have been condensed into 20 regulations. And out of these 20, only 15 pertain to conduct of insurance operations, and the remaining 5 are internal to the regulatory setup. Further, in the era of volatility, uncertainty, geopolitical challenges, macroeconomic changes, we are enhancing the stability and resilience of the sector. And thus, a much stronger risk management and a much robust risk supervision framework is also being developed. The entire journey, beginning with the registration of insurance companies, have been made seamless. We have dedicated facilitation group assisting all the new applicants. Once entered into the market, various other flexibilities have been enabled in the spirit of necessary ease of doing business. For example, quick launch of insurance products under the use and file regime. Revision in the distribution architecture, allowing insurers to tie up with multiple distribution partners, and this is a step towards opening it up fully, which we call the open architecture. Increased empowerment and flexibility to the boards of the insurance companies to take business and operational decisions independently with strict accountability through a very strong governance framework. Flexibility in the overall expenses of management, which is now applicable and monitored at the company level. Hitherto, it had several segmental and sectoral caps, so this has been completely freed up. Further, keeping in mind that the insurance sector is capital intensive, the limits for raising other forms of capital or the subordinate debt have been enhanced, and with prior approval requirement has been dispensed of. Efforts are also being directed towards adopting the risk-based capital regime or the Solvency II regime to bring about efficient utilization of capital and alignment with the global standards of accounting and reporting by implementing the IFRS, the International Financial Reporting Standards. Dedicated mission mode teams are working at full throttle within the IRDAI in this direction, and we are expecting that we will be able to do the transition to RBC as well as IFRS by 2025. Regulatory framework for investments also have been revamped, paving way for more opportunities and better returns. A lot of new risk coverages based on market needs have been permitted, case in point being the surety insurance or the non-performance insurance. Various other risk coverages which were not available or inadequately available in the country are being taken up, like long-term products in property, motor, P&I clubs, NatCat solution, parametric covers, etc. Considering the importance of data and analytics for the sector, sincere efforts are directed towards strengthening the sector's data repository, which is the Insurance Information Bureau, IIB, to develop it into a dynamic innovation hub. It is anticipated that the transformation of the IIB into a resilient data analytics institution would enable customized structured solutions for the industry. The way insurance sector is monitored is also getting revamped as we move towards a stronger, agile, and a futuristic risk-based supervisory framework, which would not only discover the inherent risks, discrepancies, and aberrations, rather it would act as a guiding force by providing early warning signals, offering preemptive solutions, and recommending corrective actions, etc. And thus, it would make the entire ecosystem more robust and more resilient. Further, in order to incorporate dynamism and ensuring that the regulatory framework remains abreast with the evolving landscape of the 21st century, the provision of sunset clause is being introduced in all the regulations. It mandates the review of each regulation once in every 3 years. All of this is an essential part of our larger vision of insurance for all by 2047. We shoulder the responsibility of addressing the protection needs of 1.4 billion people. This means reaching 140 crore people, offering protection to them and their loved ones, their businesses, their assets, their properties, while acknowledging the rich diversity that exists in our country. We encompass a fifth of the world's population. Such is the diversity that we have multiple markets within one market. These come with multiple pocket sizes and multiple preferences. Our demography is favorable and disposable incomes are rising. A one-size-fits-all approach simply cannot meet the varied needs of our beloved nation. So what is the solution? The answer primarily lies in leveraging technology that not only drives development, but also caters to the diversification needs that exists in India. Undoubtedly, insurance, like practically every other business, is being redefined, is being reshaped by and around technology and real-time data and insights. Today, blockchain-enabled smart contracts, telematics, variables, chatbots, and other tools leveraging AI, ML, big data, IoT are causing disruptions and changing the traditional fabric of the insurance sector. Even fraud detection has become more effective with the help of data analytics. However, the question arises whether all of this is sufficient. Ladies and gentlemen, IRDAI's objective extends far beyond establishing mere tech-led insurers. It is driven by the ambition to utilize technology to extend insurance coverage to each and every corner of the country. The goal is to empower customers with choices, not only regarding insurance products, but also in terms of how they access and pay for them. While the extensive use of technology is crucial for achieving these objectives, the aim is to ensure that technology serves as a means, not merely an end in this pursuit. Our trajectory is steered by democratizing insurance, which permeates to the last mile, to the last house, and to the last person. In line with this commitment, the insurance industry is passionately working towards creating one-of-a-kind, unique e-marketplace called the Bima Sugam, leveraging the nation's indigenous digital infrastructure. It would be a game changer in the insurance landscape. You may ask how. The universalization of insurance would become possible as Bima Sugam would provide the reach and a bouquet of insurance services in real time at the doorstep of the prospect or the policyholder. The tech-led e-marketplace would transcend geographical boundaries and income disparities. It would be integrated with various data stacks, enabling seamless flow of information, making onboarding, processing, pricing, underwriting, and claim processing more efficient. Bima Sugam is expected to cause a big explosion in the insurance intermediation. It would become the tech arm for the insurance agents. The insurance agents are the foot soldiers of insurance, and they can do it through a plug-and-play model, making them more accessible, more productive, more efficient, and thereby enhancing their reach and also their income. For the other intermediaries also, the Bima Sugam would act as a growth catalyst, reducing cost of intermediation and promote seamless access to a wider consumer base. Bima Sugam further would host all necessary information and available offerings at a single place, thereby reducing the information asymmetry. Access of such information would result in more choices and avenues for insurers, intermediaries, as well as the consumers, creating a win-win-win situation by not only enhancing reach, but also the depth of the insurance market. However, it may not be achievable without the active involvement, support, and participation of the state governments. In this direction, a state-level insurance plan has been formulated, wherein each insurer has been entrusted with the responsibility of increasing insurance inclusion in the assigned state or in the assigned union territory. The support that we have received from the state governments in this initiative is very encouraging, with many of the states formulating the state-level insurance committees and the district-level insurance committees. Working at the grassroots and providing protection to the most vulnerable would be the key to our vision of universal coverage of insurance by 2047. However, this is not the end. Our goal is to script a tomorrow which is truly inclusive. For this, we need India to be a fully banked, a fully insured, and a fully pensioned society. And thus, all the participants of the BFSI sector need to come together as one unit, catering to all the financial needs of one customer. Through this integration, individuals gain access to a wide array of financial products and services tailored to their diverse needs and aspirations at one place. By harmonizing the efforts and sharing resources, the BFSI sector can amplify its impact, reaching the underserved communities and empowering them with the tools to build a secure financial future. All of us, all the stakeholders, be it the industry participants, the distribution forces, businesses, professionals, media personals, common citizens, everyone's participation is important. Everyone is a change agent, the torchbearer of this transformation, which would ensure that our nation's journey encompasses not just milestones, but a harmonious symphony of progress and security. We all have got this opportunity to be part of this Mahayagya of taking our nation to the heights she truly deserves and witness the emergence of the Viksit Bharat. Achieving the objective of universal insurance coverage, resulting into sustained growth and development of India, is an integral part of this journey. Ladies and gentlemen, our vision of insurance for all before 2047 is very much a possibility, and 2047 is just the outer limit. Let us strive together to make it a reality very soon. Thank you. Namaskar. If there are any questions, couple of questions, you're free to. Yes, sir.
Hi, sir. This is Sanjay. I am basically from insurance industry, now into the tech side.
Yeah, is it on? I can't hear you.
This is Sanjay. Is it audible now?
Yeah.
This is Sanjay from the insurance industry, now into the tech side. Now, only thing that it has been recognized that Devasys Panda is one of the innovative chairman in the insurance industry, always being spoken about. And that's the growth has been insurance industry has been happen across the corner, left and right, center, everywhere. And it has been recognized by everybody. Only thing is that I would like to know, just like the insurance company are allocated to each state level, or the same kind, are they allocated just like public-private partnership on the education side, just like Insurance Institute of India tie-up between the state level with insurance company, so that they can get the allocated land over there, so education can be transformed on that state level, and the with educations the transformations can happen. Is there any kind of thought on that area, on the education side?
Well, I couldn't really capture the question. You are talking of
educations, just like
I mean, to propagate the idea of insurance through the education system? Or?
Yeah.
See, insurance awareness or creation of insurance awareness is also a very big challenge within the country. Many of the people wouldn't understand what insurance does. So what we are contemplating is to also run a massive insurance campaign through a multimedia campaign. Both the industry will run it through the councils and the IRDA. We are in the middle of that journey, and hopefully in the next few months we will roll it out. And for each of the segments which are particularly for the most vulnerable population, like health, property, life, accident, so that we intend to run. And yes, of course, your suggestion of, through school, through colleges, through the students, that could be a very powerful channel of also reaching out to the people, propagating the idea of insurance and how it can help people at times of, uncertainties. So surely that is something we are looking at.
Yes, tying up with colleges and educations through that kind of public-private.
Thank you for the question.
Thank you, sir.
And the comments. Thank you. Yes, sir.
Yeah. Jaideep here. The question is that the medical insurance... Can you hear me? Yeah. Medical insurance has been stagnating for quite some time in India. And one of the arguments that has been put forth is that because of portability, people shift their policy and they don't buy new policies. So is there some kind of thinking in the regulator, from the regulator, on handling this?
I think many changes have been made, particularly in the health segment, empowering the policyholders, their rights and their empowerment. So only very recently a detailed master circular has been issued. I would request you to go through it, wherein now the restriction of age has been lifted. Earlier it was It said that beyond 60, insurance covers were not being offered. So for all ages, for all kind of pre-existing conditions, for chronic illness, all of that now gets covered. Of course, the cost will be different for different kind of products. So all of that has been taken care of. Now, so what's your question? Your question is?
The question is that the medical insurance growth has been stagnating. Medical insurance growth has been stagnating for a while. That was the question.
Insurance stagnating?
Growth, medical insurance growth.
Float. Can somebody reframe the question?
Medical insurance growth has been stagnating for the last few years. So that was the question.
No, the growth, see, the year-on-year growth is more than 25%.
Yeah, but overall, as a percentage of GDP, it has been stagnating.
No, but you see, the good point is that with the removal of a lot of barriers that were there, including tariffs, the wordings, all of them have been removed. As a result, prices have also come down. And what we are looking at, if you widen the base, then obviously the costs will also come down. So it's a very promising as far as the health sector is concerned, because the growth is consistently happening year on year. It is around 25-26% growth. A lot more new players have also entered into the health segment. There are a lot of others who are waiting to also open new entities. These changes which have been brought about and they have been given a transition time also to implement. In terms, and we're trying to make the customer journey seamless and frictionless, and this is what the attempt is towards. And I think going forward, more and more people will opt for health insurance.
Can I
yes, sir. I think we'll just, the gentleman, the last one.
Sir, my question about the data security of the end user, is it any guidelines are there? Because generally, wherever we took any motor insurance or health insurance, the moment you enter any data, car number and something like that, you receive the multiple calls from the every corner of, the insurance companies, like, it's like painful them to, address these things.
See, there are detailed cyber security guidelines which have been, very extensive guidelines have been issued to protect the data and the data privacy part also. Now, we are also instructed the insurance company for this telemarketing as per the circular which has been issued by Telecom Regulatory Authority of India. So, I'm sure the TRAI is also taking necessary action to make sure these kind of calls through telemarketing doesn't go to the customer or whatever the protocol that they have decided. So that also we have asked the insurance companies to follow very strictly. But protection of data, cyber security guidelines, all of them have been detailed guidelines have been issued by the regulator.
No, but as you are also a regulator, no? You also be regulator, so you are putting your responsibility to someone else.
We have issued the cyber security guidelines to all the insurance companies.
Okay. So they need to, the follow.
Right.
Okay.
Thank you. Yeah. Thank you very much and for the patient hearing. Thank you. Namaste.
Thank you very much. I know there were a lot of questions about insurance sector. There was a gentleman who had a question. If you can just note it down, we'll see to that it's been answered or it reaches the chairman. Due to the paucity of time, we would move on to the next session, which would be the Fintech panel discussion. May I invite Mr. Alpesh Shah, the moderator, on stage, and along with them, the panelists, Mr. Rajesh Bansal, Mr. Sabjasachi Goswami, Anuradha Ramachandran, Sashank Kumar. Please. Thank you. Yes, preferably, you should go to search your names.
So I guess we are running behind, and so we are told that we should go fast. So we're going to play this in the fast forward mode. So good afternoon. I have a very, how should I put it, interesting panel on stage. We have people who have actually created, run fintechs. We have people who have funded them, and we have people who are actually driving a lot more innovation. I guess the question is, when we talk about fintechs, and I will get us started with something completely offbeat, right? Fintech has got 7 alphabets, as you know, in the word itself. And it's quite fascinating, but over the last 20 odd years, or maybe even 25, there are 3 of these 7 alphabet words which have started changing the world, right? So digital was the first one. Then came fintech, and more recently also here all these things, discussion on climate. So I think it's quite interesting when you look at fintech along with digital and climate. These are 3 big, for want of a better word, mega trends shaping the world. As I look at it, the other question is, why are we even talking here at growth and innovation in fintechs? The reason for that is very simple. There is a lot that is changing. And change is actually very difficult for all human beings, all animals actually. So I don't know whether you know this, but if you see an elephant gets tied with a rope to a small wooden peg, and the elephant will never try to move away. Why do you think that is? That is because when the elephant was born, when the elephant was literally a week old, a month old, the elephant was tied with this rope to a wooden peg, and it tried and it could not break away. Fast forward a few years, the elephant could, as they say, even with a toe, break that peg, but the elephant looks at the rope and says, I can't get away. This is human conditioning. This is animal conditioning, right? And that's the problem with change. I could make it come alive even more, but in the interest of time, I'm going to ask you to try and take this trick on, right? Just free up your hands. Both hands. Put your hands together, just clasp them together. How many of you have your right thumb on top? Just raise your hand. How many have the right thumb on top? And how many have the left thumb on top? So not everybody raised their hand, so half and half. Now I would ask you to do the reverse. So those of you who had your right thumb on top, change all the fingers, but not only the top. Change every finger such that your left thumb is on top and vice versa. Just try and do that. How does it feel? Uncomfortable, different, strange. It's quite remarkable, right? And it's not, you might assume it's because I'm a right-hander or a left-hander. No. When you were younger, you got used to doing things a certain way, which is either your right thumb was on top or your left was on top. And that's it. That's what you're now comfortable with. It is actually completely remarkable how difficult it is for us to change. And the reason I start with that is we now have the fintech world, which has forced all of us to change. Right? The number of changes, many of you are very young, so 30 years back, there was no internet. Literally, I'm taking a poetic license 32 years back. There was no mobile phone. So I grew up in a world where I did not know what a mobile phone looked like. 20 years back, and you laugh at this, there was no T20 cricket. Right? Just 20 years back. It was literally invented or started in 2006, 2007. 10 years back, there was no UPI. Just think about it. And can any of us, is anybody in this room able to live without UPI today? It's actually only 7 or 8 years old, 7, right? Nobody spoke of fintechs as well 10 years back, more or less, right? So, and that's why we are here. That's the pace of change that is driving this world. And so with that, why don't I stop talking and get the group to start? As I look at it, right, and I'll actually get all of us to jump in. In the last 2-3 years, especially coming out of all the challenges post-COVID in the last 2 or 3 years, people have all been talking about big terms, right? Otherwise, there was the wild, wild west with innovation. But now people talk about fiscal prudence. People are beginning to talk profits, right? That was an unheard of word. People are talking about long-term sustainable differentiation, mean reverting valuations, high-quality governance, building resilience. All of these things are now top of mind, both for founders, for promoters, but also for people looking at the sector. Now, as you look at that and you fast forward to the next 3 to 5 years, because anything beyond that is really long term, where do you see the new frontiers of innovation? You know, where do you think you see the world really moving ahead, specifically from a fintech and an India perspective? And I guess keeping it simple, Sabyasachi, why don't I get started with you, and Rajesh, if you can go after that.
Sure. Thanks, Alpesh. I think this is a very valid subject from today's context, but I would say this is only valid subject from today's context from if there are any PEVCs in the room. But ideally, as a business person, it is always supposed to be valid from day one. You can't start a business without having a sustainable business model. You cannot think of innovation if there is no light at the end of the tunnel. That means you need to break even at a certain point. There has to be time-bound sustainability model where to start generating money to run the business itself. And I think there was a season when there was enough funds available for fintechs to do a lot of exploration without really thinking of the business model. And there was rush to raise money or rush to get the valuations right instead of focusing on the product or the product journey per se. So I would say that myth has got busted, whatever time it has taken, but for the good it has. And the focus has come back on EBITDA. So I think morning also there was a couple of conversation which was happening on no more GMB conversation, Mr. Piramal said, and it is rightfully so towards EBITDA. So I think what the key that fintechs have taught us as an ecosystem is that it can quickly disrupt. And rightfully, Alpesh, as you started with, that we are not so used to change management within the organization, as a human, and across as an ecosystem. But what it has done for the good of the citizens of the country as a nation, now people have started accepting that we are fine with experimenting and trying new things. Now the question is only, while you are trying things, are you able to monetize out of it? Like I know for sure, I mean, as a company, when we started B2C and we realized that there is no money in the B2C, honestly. Spend billions to get millions, so no ways. We switched to B2B. Not that B2B pays you enough, but still it is better than B2C, because anything on internet means we are used to get it free. You can charge something from network effect, but otherwise the product doesn't pay for itself. Now, that's a myth or that's a reality for all of you to judge. So the quick point that I'm trying to say is you need to stay clear on the business model and the idea that you are working on. It shouldn't be a valuation game, which I think the industry has realized. And it is moving in the right direction. Now, coming back to the second point quickly, what are the innovations that we will see in the next couple of years? I think one thing that we have seen as a nation is quick digital transformation. Now, it has taken years. When it was first on the commerce side, it took a little longer. Then when it happened on the delivery side or logistics side, it was little lesser. On the financial side, it is further lesser now. So people expect, when I see and when I talk to people in the industry, they say that we want a Swiggy-like experience in financial services. Now there's a difference, because that's food delivery and this is regulated financial product. So there's a difference. While we can try to make Swiggy-like experience available for financial product, you need to operate under a certain boundary, because there is a risk involved very clearly, because it's a financial monetary transactions that's happening in some form or sorts. While this is happening, so what we are seeing recent trends. Every day you open the newspaper and you see new frauds happening, new fraud. So all of you know that fraudsters run a parallel economy as we run the economy sitting in this room. So you have to outsmart them, they try to outsmart us. But anyways, I think the fraud is something that a lot of innovation as a country we will see from the fintech ecosystem. That's what I'm saying on a positive side. The second that I believe that is happening apart from fraud is the compliance and governance. I think Governor sir also spoke in the morning. A lot of automation from an audit standpoint, reporting standpoint, alerts will be done by the fintech's ecosystem. And when I say fintechs, means fintech is not directly proportional to the lending fintechs. It is TechFin as well, the technology players across. They will create a lot more solutions from fraud and compliance standpoint. That will be my top two, apart from the green one, which I'm not touching here.
So I hope Swiggy paid you enough to do their ad here. Rajesh, if you take your top 2 or 3, sort of your crystal ball gazing, what are the top 2 or 3?
He is, thanks for inviting me. He has spoken about some of them. I'll articulate in our way as a public policy institution. The fact that fintech and valuation is today talked about, you think that will be passé? Because 1 billion Indians are expected to avail digital finance in the next few years, I would say 2030. And for that to happen, a few things. One of the things in payments, Praveena is there. The UPI has taken care of payments and is getting there. Because not everybody with a smartphone currently uses UPI, but we are getting there, especially with the new products. The big innovation that is going to happen is in terms of savings. I'm sure all of you will be yawning, what is savings innovation? But do we realize that every Indian cannot save when they want, how they want, where they want? 450 million women in India cannot save how they save or how they were saving in a rice jar. So that's one. Second, credit. Yes, a lot of digital lending is happening, but still only touch the surface. And the fact that the public credit stack that we have built with RBI will actually reinvent or lead to, as I always call, the UPI moment in lending in a few years from now. So as you said, there is no UPI. For credit, things will change. Third and last is if digital finance is going to be the way 1 billion plus individuals interact with finance, robust trust mechanisms need to be built, whether it is fraud, and in one particular thing I want to mention is grievance redressal. So grievance redressal, I don't want to go into, the example he gave because, one of these platforms offered me I ordered pav bhaji, only pav came and no bhaji, and they said, we'll give you $20. So imagine, I got wild. So I'm saying these platforms still are no match to what you and I need in terms of grievance redressal. You have a grievance, you just tap, it'll go to the digital footprint and give you the resolution instantly. That's what Gen Z, that is what millennials, that is what the next innovation in finance will be.
Shashank? Yeah, thanks for the invitation. Rajesh sir, very well spoken. I think I truly agree with you. The innovation scope for the next half a decade or a decade, if I can say so, right? I see it on 2 different dimensions. One, a lot of innovation has happened on payments, on credit, but it mostly caters to the top 100 million to 300 million consumers in the country. So all the services that we are used to in our day-to-day life today, from banking to credit to payments to savings to investments, all of that, how do you translate it to the next billion Indians that are present in the country who are still not in the fold of the formal economy in a big way, right? So there's a lot of scope for innovation there, a lot of new models, technology, all of those applications. And the primary delivery mechanism will continue to be via internet and via mobile. A lot of the brick and mortar and those kind of scopes, they don't work at that scale. So that's going to be a big innovation scope, and we will see a lot of value created on that front. I think on the more traditional side, right, if you talk about consumers like us, or the, if I can say the top 100 million, 200 million consumers in the country, I think in the next 10 years, we'll see that the well-to-do consumer, right, they'll keep becoming more demanding. They'll want services to be a lot more personalized, a lot more efficient, a lot less patience if the incumbents, if the fintech industry doesn't deliver on its promises, and they'll quickly move on. There's no established loyalty. If your favorite fintech app or the bank doesn't promise and deliver the services that the impatient consumer needs, right? And we see that today in our conversations with a lot of consumers as well as businesses. I talk to a lot of CFOs. Pre-pandemic and 5 years ago, there used to be this conversation, why should I use this software? I have a lot of people who can do the same job cheaper. But today, I think that mentality has changed. And I see that in a lot of sectors and industries and people who usually are not technology savvy by default, right? But the conversation is now, how can I automate? How can I improve my operational efficiency? How can I ensure that I have lesser people in the loop in doing all these activities? So both on the consumer and businesses side on this front, I think there's a lot of work to be done to meet the consumer expectations and needs, especially as we keep moving up the digital curve and we keep seeing more and more people having higher disposable income and higher expectation from the industry.
So Anuradha, same question, but slightly different. Since all of us want to know where you put your money. So if you had to pick your top 3 bets to invest in, what would those be?
Sure. Thank you, FE, for having me here. Thank you for that great question, Alpesh. The disadvantage of being in a very, distinguished panel is that you have to, say something truly, truly smart for people to remember you. If as an investor, what we are thinking about, right, in terms of fintech, for us, it is about technology-based financial services delivery, right? But if you look at the world and if you look at how it has changed, in our third fund, there are 2 companies which are what we call technology bets that we have taken. And there are about 6 companies which are financial services companies which are tech-enabled. For us, it's now become actually par for course that everybody needs to have tech at the back end. Otherwise, there are a few metrics which don't work out. What are those metrics? Turnaround times, right? It's no longer true that you wait for forever to get an approval to get a loan sanction. People expect sanctions in seconds when it is a digital transaction. If you're buying something online, people expect a sanction within the day if it is something which is, you've applied for an occasion and want to take a loan. People expect a response within a week if it is a large home loan, right? And look at the ticket size variances. It could be somewhere 5,000 to 50,000 rupees when you're transacting online. It could be in the 3 lakh to 15 lakh bucket when you're actually looking at a sanction within the day. And it could be as large as about 50 lakhs when it is coming to actually home loan, or maybe even a crore when it comes to home loan sanctions. But everywhere, the expectation of the customer has changed. It's not that you wait forever, right? To get your response, to say to wait for your bank to say yes or no. So in that kind of a world, technology is a given. It's a given word, right? So you need to be either technology enabled at the back end, or you need to be tech first, where you're getting people through tech platforms and then you're serving their needs as such. So 2 of our largest bets, if you will, from the last fund, I'm saying last fund because there's a new fund we are launching right now, are PhonePe, which is actually at the cutting edge of the UPI transactions. The second is UB, which is actually building something which is absolutely new in the financial ecosystem. It's a co-lending platform, a co-lending switch. Right? How do you enable a large number
large number of lenders who who originate to fill in their actually balance sheet as well, right? Like, so that's the co-lending platform that they run. And in the last financial year, they had 3.5 billion transactions running through their platform. That tells you the scale. And this is a company which is like hardly 6 years old, right? Like UPI, there's like a huge amount of change. But there's also a thinking which is going through us as investors to see if there is innovation which is truly, truly necessary, right? Or is it innovation which is a feature which is getting added to what already exists? The second will not meet our criteria. We are private equity. We look at investments which are at a slightly higher stage. We look at putting in 100 crore plus money in a company. So for us to have an established business model, to have a company either demonstrating profit or a path to profitability is very important. So the feature kind of innovations doesn't cut the check for us, right? It has to be innovation which is sustainable in an organization. So in that kind of a context where we are looking at, we're kind of looking at whether there's fresh innovation needed, or is the current innovation needed to actually like settle in different kind of way. Technology makes sense, like tech first financial services makes sense when there is disintermediation. If you look at that, that's not yet happened in the financial services sector. There's a new intermediary who's come in, and that actually like increases your cost of service. It doesn't decrease the cost of service. So what is the innovation in business model which disintermediates or brings down the cost of delivery? That is basically like what we're looking at. We continue to look at financial services from a new fund which is roughly about like 4,000 crores in size. We will deploy roughly about 2,500 to 3,000 crores in financial services. And much of this will go towards actually like people who are bringing credit close to the last mile. Some of the customers that he spoke about, the next billion. And smaller merchants, who's also, I think, like customers that he serves, right? So, so taking credit there, actually enabling what Rajesh was saying, which is helping people save, right? Helping people actually like transact better. So we are looking at all these innovations, but in the context of ensuring that there is improved margins along the value chain. And that's actually like where we are placing our bets. You could be an innovative distributor, but you have to tell us who you're disintermediating. You could be a manufacturer, and then basically you're building your own direct-to-consumer kind of a distribution channel. So you could be either. We are happy to invest in both. But for us, it is about ensuring that whatever service you deliver, A, it comes with the speed that the consumer requires, B, it comes at an affordable cost. And this is the kind of like, these are the kind of companies that we're looking to fund at this point in time.
Okay, so why don't I change gears and ask a slightly different question. And let me start, Shashank, with you, and Rajesh, if you can go after that. In the financial services world, I'm now taking everything, as you said, saving, insurance, credit, transactions, right? Fintech player versus incumbent, or fintech player plus incumbent, right? How do you think of it? Collaboration versus competition. What's working, what's not? And keep it brief, but Shashank, one or two things that you think hold this collaboration back. And what's the challenge? What can we do?
See, I think the fintech ecosystem cannot exist without banks. So, I don't think they can be at odds with each other, right? I like to think of the collaboration that, the banks are building the infrastructure for the country. So I have this vivid image in my mind that, the banks are the ones which are laying down the railroads for the country, right? How do you go from, from Delhi to Mumbai or Mumbai to Bangalore? But the last mile connectivity, whether you go from the station to your home, right, via Mercedes or a auto rickshaw or on foot or whatever, right, whatever mechanism that is there, that last mile connectivity is where fintechs can really do a great job in terms of, and it goes for different aspects, whether it's personalization, whether it's the last mile, delivery mechanism that is there, or whether it's the, user experience or the friendliness in terms of giving that service to the customer, right? So that last mile connectivity is where fintechs play an amazing role, and they can do it at a faster pace, at a cheaper cost, and with much higher risk threshold, right? So you can look at it from a country perspective that you get to experiment with a lot of diverse models that is very difficult for incumbent banks to think and do, because DNA-wise they are not set up like that, right? And that is where, when that collaboration that is able to happen between the banks and the fintechs in a trusted environment, where the banks are able to empower fintechs to provide those kind of services and experiment on those models, I think we see that collaboration thrive. I think in payments ecosystem is a great example of the growth of UPI, which wouldn't have been possible without the collaboration between the regulator, NPCI, banks, as well as all the fintechs that are there in the industry.
So while I agree, for the kind of services that you and Sabyasachi offer, yes. But if I like some other fintechs who are into credit, who will get into savings, you will actually start seeing more challenges, right?
Absolutely not. It's not at all true, right? I mean, Rajesh, you could go ahead, but I'm just saying that,
The question I have is, will banks willingly say, yes, we can't do this and let somebody else do this? And Rajesh, why don't you share your thoughts on what's true, what's helping, what's holding it back?
Yeah, so we did an in-depth study last year. How much time does it take for, I'll take an analogy of how much time does it take for a guy to finally propose to the girl. 18 months. Again, this is about fintech and bank, not about the boy and the girl. 18 months. We had extensive discussion with a lot of fintechs. So with due regard to both of them who are established large fintechs. So, if Shashank walks in the room of an MD of a bank, they're like, oh, yeah, how are you, Shashank? Because you're Razorpay. Don't mind. But in the room, there is an early stage startup who's bootstrapped or angel. They will, as we do in traditional Indian settings, have to find an uncle or a VC investor or an angel investor to introduce them to some AGM of one bank who will keep on, fooling around. Don't mind. This is what happened. So average is 18 months. Now, does it work? No. The interesting thing is we had a meeting with 20 largest banks. All of them said, no, everything is broken, we want you to fix it. So you're like, we can become a marriage bureau, so to say. But having said that, the fact is they cannot live without each other. Banks do realize they need the agility, and as Shashank said, of fintechs for last mile reach, the new age thinking, but they have their own set of challenges in terms of procuring a fintech, in terms of governance, in terms of the future of the fintech. And fintechs have this challenge of, plugging into 20 banks for even a POC. But the fact remains, I think getting there, we are fixing it. I don't want to make it about ourselves. We do what we call as even this room, you guys don't mind a speed dating event for banks and fintechs. So, and everybody, one founder told us it would have taken them 20 months to meet 20 banks, and under the roof in 2 hours he met 20 banks. I'm quoting. So we are trying to accelerate. Things are changing. Attitude of both banks and fintechs are changing.
So you're going to create a fintech marriage bureau?
Yeah. Honestly, I mean, so there are grand plans.
I'm not even checking the other. I'm happy to invest in that.
Okay, thanks.
So, why don't I, I'm looking at the, sorry.
Can I just add one point in there?
Go ahead.
There are, 33 scheduled commercial banks. There are 12 SFBs in India. There are 140 crore people. Look at banking penetration, right? Like, there are cooperative banks, there are RRBs as well. But many of us today don't actually speak about them in the same breath that we speak about banking, right? So in that, and then there are 9,000 NBFCs who banks actually rely on to transmit credit to the last mile, right? And then there are fintechs who are actually where I think there was a recent release which said Amazon ICICI credit cards are 400 million, have gotten 400 million users. So look at the scale at which things are changing and the partnerships which are happening across the ecosystem. Till about 3 years ago, they were distinct ecosystems of lending separately, payments separately, or people were looking at how do we collaborate. Now it is a part, just as banks and NBFCs have worked together for many years, so are fintechs and banks working together now for a few years at least. Right? And this is a kind of, trend that we see going forward as well. Because you do need different kinds of distribution elements, the agility that is actually like required.
So one last thing, and I'm going to try and make this like at Coffee with Karan, the rapid fire, right? So if I can ask, Sabyasachi, if you can start, two questions. One, if you had the crystal ball, one thing that you see completely wacky by 2030, or maybe 2027 if you want to make it faster. And the second one is if you had the wish list, if you could ask for anything, and I'm not even saying from a regulatory perspective, from the regulator, from the customer, whatever, what would that be? So
I'll take the second one first because that's a little close to my heart. If the fintechs can get paid better by the banks, I'm speaking on behalf of all the fintechs in the room. Probably the bankers in the room may not like me for that, but I think that's the reality because it requires huge amount of investment when you ideate a novel idea. You need years together to invest on that idea to become really something that
rapid fire.
Yeah. So that's the first one.
Sure.
And the second one is, as I said beginning, the fraud and governance will take shape, and I think by 2027 that will really disrupt.
So whatever fraud I want to commit till 27, I'm safe. Rajesh?
I'll answer one of them. My wish list is Indian capital, family offices, invest in fintechs and actually reap the benefits. You may sound like a Swadeshi, but the wealth remains in the country so as to create a multiplier effect.
I think my wish list will be that how can we have million technical entrepreneurs in the country? How can we enable everyone to start a very easy, simple business which has some amount of tech enablement and tech skilling? I think it will create amazing value for the ecosystem.
My dream is a bank in everybody's pocket, right? As in true banking penetration across all strata of society, democratic banking. That's one. And the second, the outside kind of like, like you asked for what is something which is completely wacky. It's also actually like a fairly formalized economy. It's not in technology, it's not in fintech, but if you look at it's currently India's 90% informal economy, right? So I want that to be more formal so that, there's true change and the value across chains can be captured well.
Since I asked that, I will end my wish list or my dream. Let me start with my dream. I think, Rajesh, you mentioned savings disruption or whatever, innovation. I look at this and ask the question, why should there ever be a savings bank account? There is no reason for it to exist. With technology, I can invest my money wherever, in equity, in mutual funds, in debt funds, whatever. And if I had, with all that is possible, if I could actually withdraw that money and transfer it and pay at a T+0 now, why do I need a savings account? So I actually look at this and say that my wacky idea is savings accounts, 0 by 2030. So I'm saying that's the dream, if I call it that. It's possible. Technically, conceptually, it's possible. Practically, obviously, that is many a slip between the cup and the lip. With that, why don't I stop and say, maybe take one or two questions from the audience if there's anything coming up for people on the panel. I'm told that we don't have the time for questions, so I'm going to unfortunately bring this to a close and say thank you very much for sharing your thoughts, and hopefully if there are questions, as she had said previously as well, please share that with the team here. We'll figure out how to get the panelists to at least try and respond to that later. Thank you. Thank you very much.
That was a great and interesting panel. And a couple of questions were thrown up, I loved when we're talking about the need for a savings bank, right? I know you're booked up. May I call on to the stage Mr. Raj Malhotra, who is the founder of IAS Sati, for a brief one-to-one. The stage is yours, Raj. Thank you. Yes.
When I came in the morning
may I request our speakers to get seated?
That's all right.
That's all right.
I can understand that.
Please. This place is all yours.
Thank you very much.
Yeah.
So when in the morning I came here and I saw Anant talking about cricket, and after listening to so many senior people here, I find myself as the 12th player or the 12th man in the game. And the entire idea behind this is to ensure that the idea that we have been talking since morning about inclusive growth. Nothing is possible without genuine education, and no better platform can be there, which comes along with the collaboration with Indian Express itself. Because when we talk about education, it's not about just civil services or any other competitive exam. It is more about that trust, that faith that Express brings on the platform and the way it can help nurture the students. Taking that inspiration from Express, we at IAS Sati have developed an AI app which will not just look at the dimensions of the exam, but will also cater to the idea of mental health, because it is something that has been mostly neglected as a part of education, and without knowing the idea of this mental health, no idea of education can ever be inclusive. So bringing one-stop solution for all the aspirants who are aiming for any and every competitive exam, this is something that we as IAS Sati and Express are coming up with on 15th of August. Thank you, everyone.
Yes, thank you very much. I thank the panelists from the Wealth Management and Asset Management team for coming onto the stage. We have Mr. Sachin Kumar, who is a Deputy Editor, Banking from Financial Express, will be moderating the session. We have Soumya Rajan, Founder and CEO, Waterfield Advisors, Manish Kejriwal, Founder and Managing Partner, Kedara Capital Advisors, Navneet Munod, MD and CEO, HDFC Asset Management Company Limited, Kunal Shroff, who is a Managing Partner of Christ Capital, and Anu Tiwari, the Partner, Head Fintech and Financial Services, Cyril Amarchand Mangaldas. Over to you, Bats.
Yeah, hi everyone. As you can see here, okay. So we have this fantastic panel of veterans from our industry. Just one clarification: they're veterans by knowledge, and by you can see by the looks they are young. So, let's start this discussion with them. So now. The first question is to Mr. Navneet here. We have seen the recent surge in stock market. Investors, they have earned better than expected returns. And so their expectations have, they have increased. So they want to adopt a T20 approach, but experts suggest test match strategy. So how do you manage such high expectations of investors in the given this scenario?
So I don't think the incremental money that's coming is coming with that T20 expectations, while the delivery will be like a test match, because a large part of the flows into mutual fund industry are in the form of SIP now, where it has been sold as a product where you accumulate or you kind of accumulate wealth over a period of time by being very disciplined and then keep investing every month. And if large part of the flows are coming in that form, then I think expectations have been managed right. At the same time, I'm sure there are investors who are looking at certain sector and thematic funds, or maybe a small cap fund which may have delivered a 50, 60, 70% and getting charmed by that return and just extrapolating. That's a human bias or whatever the recency bias that people may have. But the way industry is trying to position the product is that you accumulate wealth over a long period of time by being very disciplined. And you said the recent surge in market. I mean, in India, the surge has been there for a long time. As a small kid in 80s, I remember Sensex at 300-400 and have seen the journey to 80,000 now. And over the next several years, I think if India continues to deliver what it has delivered in last 10, 20, 30 years, I think investors will have good experience. If somebody is investing for next 6 months, looking at last 6 month return, there's a possibility they may have disappointment. But I think if somebody is doing in a highly disciplined manner over a longer period, I'll just give one example, and we'll take the opportunity. We didn't pay FE for the sponsorship, but I'll use this opportunity. If somebody did an SIP of 10,000 rupees per month in HDFC FlexiCap fund over the last 29 years, somebody did a 10,000 rupees per month over the last 29 years, that money would be 20 crore rupees today, close to 20 crore rupees. That's the power of compounding. That's what India has delivered. That's the power of like disciplined investing over a longer period. Of course, coming from mutual fund industry, I have to say past performance is no guarantee of future returns, because maybe the environment was a little different, but it just shows, I mean, the potential of India, and if you continue to invest in a disciplined manner, what it can deliver to investors. And this is what we are trying to sell investors.
What do you think, what's your advice, and how do you manage the investors' sentiments in the current scenario?
My advice would be to take all your money out of the HDFC Super Saver Fund and put it with Chris Capital and Kedara. On a more serious note, sir, thank you for having us. But I think our worry has always been that, bit what Navneet said at the very end, that past performance can be no guarantee for future performance. Having said that, if you look at the macro, the global trends, I think the next 10 years should be India's decade, right? So, and what better way to play it than equity and equity growth? The only thing that I would say is this whole concept of diversification, that even most people look at diversification as equity and debt, but even within equity, it's time that, our entire investor base, whether it's corporates, family offices, ultra net, high net worth, and retail, starts looking at diversification across different asset classes within equity. So a bit of putting money historically in Nifty, the Sensex, increasingly start looking at other asset classes within that, whether it's alternatives, whether it's venture, whether it's private equity, because over time, studies have proven that the diversification strategy will always give you a higher reward compared to the risk you take on a uni product. So again, no wisdom, no crystal balls. If we had that, we wouldn't be on this panel. But I think our best advice, and also to be a little bit measured, this may not be the best time to put all your savings in a new equity account that you've opened. So the counter side of the compounding is also a product like the SIP product is a good one, because you average your entry price over time. Yeah? Nobody can say what's going to happen to the markets tomorrow. So if you put it all in today, probably not the smartest idea, but the SIP product is great to enter the markets. The question is, once you enter, what should you be investing it in?
One can be plain equities, could be index funds, but as you grow more and more mature and you have the capacity to take risk, then take a higher risk with a more, a product which carries a higher reward.
Right. So Kunal, what do you think? Means there are opportunities, but what are the challenges it brings to you, wealth managers?
Yeah, so that may be a better question for Soumya to answer, but I'll just follow up on what Manish was saying. And like Kedara, we're also investing in two pockets. One is a longer-term private equity product, and the other is a slightly shorter term, but still a mid-term oriented public equity product. And clearly the returns, if you look back over 3 years, 4 years in Indian stock market, have been very hard to match for most people. But I think it actually deludes investors into thinking this is what will continue. When you extrapolate from these levels, I think people are setting up the wrong expectations. And what's most important is to have realistic expectations. But in my mind, if you want to really create wealth over the long term, you have to focus on the number of years you want to compound, not just the X. Everybody says, oh, what return are you making? And the IRR becomes the benchmark to judge everybody. But if somebody can compound for twice as long as somebody else, that will end up creating a lot more wealth. So in that sense, I feel today's 1 year Sensex returns or 3 year Sensex returns is still not the right way, because most people here would want to compound over 10 years or 15 years. And in that sense, what Manish was saying, which is, look, there is a case to be made to diversify. I think it's important to have that at the right point in the cycle for you. But one benefit that private equity has is it forces you to have a 10-year view, because the product itself is 10 years. The data from the US and all markets shows that the average mutual fund investor underperforms the average mutual fund. Think about what that means. How is that possible? That's because investors end up selling at the wrong time, buying at the wrong time, and trying to time the market is not the right way to do it, right? So thinking long term is probably the best strategy you can have, the best de-risking you can have.
Right. So Soumya, now talk about the challenges. What's your view on this?
Yeah. So thank you for having me on the panel. I think what happens in the scenario we're seeing right now is that the investor experience in markets is actually quite short. You've had a whole number of retail investors or otherwise who've just been investing maybe over the last 2 to 4 years. And that's quite short when you look at the longer term benefits of compounding or how markets, your returns will do. What tends to happen is that in India, we tend to be fairly poor on financial literacy. So in a rising market, everyone thinks that, they're fund managers and thinks that, they can make these outsized returns year after year. That's where I think a little bit of the realization comes in when you work with a wealth manager, which is really to try and prevent the accidents from happening. And what we look at is to try and figure out how do you look at risk management better? How do you look at asset allocation, the discipline of investing? And then how do you also look at return enhancement? Because there are going to be pockets of opportunity. And when you do everything yourself, you may miss some of these trends. So the challenges I think we see right now is that there's not enough financial literacy. And therefore, we need to create that investor education. The second challenge, I would say, is actually technology. So to the extent that we've had all this technological advancement, you've also seen recent instances where you've had money heist, typically in digital assets. So when you look at just the security of the assets over a period of time, and if you were to look at data privacy, I think these are the issues that we should be concerned about going forward. So those are the challenges.
Yeah, so challenges are there. Anu, since you are from the legal side here, so how do you see some legal changes which the industry may see going forward?
Thank you, Sachin. So if you were 10 years down the line, I definitely see 5 things should have happened. Supervisory trends are going through the roof, not just with RBI, but with SEBI. I mean, we have our first onboarding ban orders by SEBI. And the penalty there is not crores, it's multi-million loss of business. Markets are maturing. We have to be seen as mature markets. So surveillance data, NSE, BSE, AI, ML, all of those things. UBO, focus increasingly will be a lot on UBO going forward. That's one. Second, you see what happened in Japan, the Toshiba effect. All your big funds no longer will be passive. And we already are seeing, I think next door is a sponsor of the next event who has sued a company, right? Domestic mutual funds will have to preserve value, will have a say on board governance, will look at M&A capital allocation. So it's no longer, the promoter. And 1,000-odd resolutions were voted down by Elliott Pimco in Tokyo. Third, I see asset classes collapsing. So far in this topic, you have mutual fund, you have PMS and AIF. I mean, day before only we had the 10 lakh PMS quasi category for mutual funds. I mean, which kind of makes it the whole PMS model. If I have 10 lakh, why would I go 50 lakh? So the lines are no longer clear. Probably you'll see them coming closer going forward. Fourth, you will see a lot more of wealth tech regulations, like online bond platform, finfluencers. There's a doubt between research analyst, investment advisor, the whole distribution, origination issue. You will have, already you are seeing discount brokerage pricing norms which came out. And lastly, if you think of exits and change in control, you will probably have more M&A friendly rules, which happened last year with mutual funds, the whole private equity sponsorship norms. So net, my thoughts.
So coming back to you here, Mr. Navneet, now SEBI on Tuesday, it proposed a new segment for retail investors with a cap of 10 lakh. So how do you see that, segment taking off? What kind of, investors you see there?
By the way, the minimum amount is 10 lakh rupees. So I don't know whether you can say that this is for a retail investor, because the way retail is defined in India. It's interesting. I mean, it's getting discussed that somewhere between MF and PMS, when we look at an asset from an asset manager's perspective or from an investor or wealth manager's perspective, people always talk about the platform, mutual fund, PMS, AIF, institutional, retail, active, passive. I mean, geography, B30, T30, asset class, the private, public, equity, fixed income, money market, alternatives. This should be the way, right? From, if I think as an asset manager, or let's say a wealth manager, it should be the customer at the center, investor at the center. And what are our core capabilities? Investment management, risk management, and product management, right? Those are the three core capabilities. Within that, it should be agnostic to whether we are putting it in an open-ended format or a closed-ended format just because of the regulation or taxation. It's in mutual fund format or that format. This is how it has to be thought. I mean, this is in public domain and it's in consultation paper. We don't know in what form finally it will come, so I won't comment much on that. But my thinking is that every asset manager, just because let's say certain things are allowed in mutual fund format, not that everybody will have that capability and should launch it because there is a demand for it, or the other way around. So I think what SEBI is trying to do, that markets have come of age, investor awareness has increased. While I agree with what Soumya mentioned, that financial literacy is still, I mean, we have a long way to go as a country, even among the rich and affluent, not talking about the retail investors. Even there, I think there's a lot more that we need to do. At the same time, markets have come of age. I think our capital market infrastructure where we are today, given the, $5 trillion now, right? I mean, the market cap, the size of the private market, the size of the bond market, now with the bond index inclusion, what it can be over the next couple of years, there is a scope for innovation within the mutual fund space. And given the capability that we have built in terms of talent, in terms of technology, in terms of, and apart from everything else that I talked about, investment management, risk management, and the product management capability, there is a scope for maybe launching products which may have higher, which may have the characteristic of a high risk, high return product. But it has to be sold right, and it has to be marketed right to the right set of investors in the right manner.
Yeah. So what do you think of what kind of, funds it can bring to the wealth managers and the new kind of investors you see after this SEBI's new proposed segment?
Sorry, repeat your question, sir.
So what kind of, what's your expectation in terms of, new investors coming in, the size of
on
or
the 10
fund?
lakh?
Yeah, on the...
Sticking to your 10 lakh thing.
Yeah, the SEBI's new the segment which it has proposed.
No, listen, I think there's a fine balance if you just step back a little bit on what is the right risk for a different type of investors. I don't know the details of the 10, but I'm assuming the classic definition when you do an AIF product, you minimum put 1 crore. Now you're saying there's a 10 lakh category for more riskier investments. Is that the case? So listen, it's consistent with my earlier thought. It's great to broaden the market and to have many segments. But at the end of the day, what are you trying to do? The whole reason there's a 1 crore minimum on an AIF product is because you assume the person who's putting that amount of money is the equivalent of an accredited investor. His overall net worth should be significantly more than 1 crore for him to put 1 crore into that product. Because, again, the point of diversification, in case that 1 crore goes and crumbles, his lifelong savings is not into that, right? So I think the fact, and that amount is very high if you look at the average wealth that an average Indian family has. So having lower things is obviously a good thing because it gets more and more people into it. My worry, sir, has always been a balance between an introduction of new products versus mis-selling new products. What you don't want to do is come out with a plethora of products which promises the moon to the less sophisticated investor, takes their money, locks it in, provides suboptimal returns, and takes out a lot of fees. That I'm saying is the counter portion of the regulation. So on one hand, it's a very good thing. They're lowering the limit from either 1 crore for AIFs or 50 lakhs for a PMS product to something else for 10 lakhs. I think as an industry, it's our responsibility to ensure that does not create products which are equally safe such that the so-called smaller investor is also well taken care of. So I think it's a balancing of both, which is important.
So Kunal,
could I just come in on that as well? Because I think one of the big things we're looking at in India is really the financialization of assets. So all the discussion around the financialization, which today is about 1 trillion for, let's say, the greater than 1 million segment that has financial assets, that's going to grow at a CAGR of about 13 to 14% over the next 5 years. So you're really saying 1 trillion becomes 2 trillion in 5 years or so. But then that has to be filled by a certain set of products and asset managers who are in a position to actually fill that gap. Today, what does a retail investor have? They only have a mutual fund if they don't want to get, or they don't have the capacity to do a PMS or an AIF. So what you're effectively trying to do is create a category so that you can fill that gap which is going to emerge over the next 5 years. So I think that's a really big part of what the entire wealth management and asset management space is going to look like. 1 trillion to 2 trillion just in the HNI space is a fairly significant amount of money.
So Kunal, what's your view? That was this new product segment needed for India in this right now, or?
I'll try and keep this really short. I think it's more in the lines of financial inclusion. Now, this is not a product that we at Chris Capital focus on, but if you look back the last 10 years and say financial inclusion has increased, access to credit has increased, what has it done? It has allowed people who used to go to unorganized money lenders to get organized capital, and as a result of that, they didn't have to pay 3-4% a month. And their cost of capital went down, which helped the common person. I believe, if implemented correctly, what this regulation is doing is ensuring that if you had 10, 12, 15 lakhs to put in, you were earlier going to an unorganized financial intermediary and saying, take my money and do what you want with it. And if it's implemented well, you now have the option to give this higher risk capital, not just pure stock market capital, to someone like HDFC, who will safeguard it, put the right governance and risk controls in place, where you have a better shot at not losing your money, not going into the wrong hands. So I think it actually brings in more inclusion and reduces parallel economy or intermediaries who are not accredited managing other people's money. And that would be a good thing.
Anu, so on the regulation side, so do you feel that this wealth management sector, is it over-regulated and it's stifling innovation?
I mean, Sachin, world over, the space is heavily regulated. I mean, every part of the world. I think if I had a wish list, two things if one could see. One is certainty. I mean, you see close to 80, 90 consultation papers have come out in the last 1 year. One doesn't know, I mean, we as advisors struggle to know what the law is at that point in time. So a bit of clarity in terms of knowing where you stand. Second, 95% of SEBI orders are overturned by SAT. You know, it is just numerically, so it's becoming a bit like tax, right? Which is again not good because, and you have vague definitions. Market manipulation, insider, front running. If you look at surveillance data, you can find 30 people all India who would have punched a trade with the fund manager. I mean, it statistically will happen, right? So just some more clarity in terms of orders, because the settlement powers they have now. I mean, there's a lot of contribution to the Consolidated Fund of India that has been made through settlement amounts. And lastly, what one would want to see is, it's like bad luck is penalized, because the standard the code of conduct, and the panelists can vouch for this, duty of care, due diligence, what is suitable for the investor. Now, if tomorrow I have a bad investment and it blows up, and it has happened, you look at Franklin Templeton, SL, Amtech, JP Morgan, you can always go back and say you didn't do something right, even though I have followed whatever I could, even including rating agencies. So, and I think that the issue here, especially with us, is a fee-based income model. You have to put equity risk.
Help me understand how this, in the age of Gen AI, how this technology is impacting wealth management sector. And what has been your experience so far? What do you see happening in next couple of years, 5 years now on?
I think if it's on wealth management, I really think, Soumya, do you want to take that one on AI? Sorry to put you on the spot, but in terms of how are you using AI to...
Sure. So I think when we look at Gen AI, couple of places where we think it's going to really be useful. The first is just in terms of a more personalized client experience. So what we're trying to do is that AI can actually sort through large amounts of data. So you have a lot of data in terms of the client. At the same side, you also have a lot of data in terms of product set and availability. What AI is going to do for you is to be able to match off in terms of what is the right strategy for what the client has told you in terms of their risk profile, their risk appetite, their liquidity needs, and so forth. And you can actually tailor it to their requirements specifically. So I think that's a big place where AI will be used. The second is really in terms of just enhanced analytics, because ultimately we have a lot of information which is available on different companies, on different investment opportunities. Now, what you want to use AI for is what would have taken maybe 2 days or 3 days for somebody is going to be done in a matter of seconds, to be able to say that this is the kind of trends that you can see from predictive sense, dislocations in markets which can be predicted. You could also look at scenario analysis, which you can't do otherwise, which would have taken you much longer. So the response time is going to be much faster, which will mean that clients will be able, you will be able to give them better inputs as a wealth manager. So I think these would be two of the big areas where I think AI will make a difference. Of course, the others is really in terms of data entry, automation of processes, rebalancing, compliance checks. But it's a very exciting space. We have started using a little bit of AI on the analytics side, but I think we're just scratching the surface right now.
Yeah. Well, I would say, so people like us who are on the deployment side, it provides a big opportunity to invest behind teams who are using or developing tools and apps to further this. In fact, if you see the last 6 months, Kunal might have more data because we haven't yet focused on it, but globally, especially in the venture state, more money has gone into AI and the whole AI ecosystem, whether it's chips or apps or other areas, than any other sector, subsector, showing the promise that this has in the coming years.
All right. So, Kunal, would you like to add something to it?
I think Soumya captured it well, and I think, frankly, we are waiting to see it play out before we really use it, and you need to have a lot of data. So today, it's mainly the hyperscalers who have most of the data who are going to use it the best, but it is a trend that we're going to wait and see how it plays out.
A few words about sustainable investment approach that the ESG coming into this play. What do you have to say about this sustainable investment?
I know we are running out of time a little bit, but I'll just say very quickly, the focus should always be on the substance than the form, right? And so the way we've thought about ESG or any of these initiatives is, does it make sense? Does it make sense for us as a fund manager? Does it make sense for our companies? So a few places in which we have implemented it is where, you're not doing wastage, and therefore you're reducing your power costs, you're reducing your other costs. So it's always good to do it where it makes sense, and when it makes sense, even your portfolio companies will appreciate it and say, this makes sense, I'm going to implement it. And that's been the journey that I think will allow us as fund managers to also have higher credibility than just telling a portfolio company, do this because it is the flavor of the month. And that's how we have been approaching it.
So I think we are running out of time. So I thank all panelists here for their time. Thank you so much, and thanks for your patience.
Thank you, Sachin. That was a very interesting panel. We are going on to next to a one-to-one with Sonali Jindal, the co-founder and COO of Kisht and Rig. So I would be moderating this session with Sonali. Thank you. Or having a conversation, right? Looking forward.
I think my decibel is very high for me to be heard, but yeah.
Hello? Yeah, this seems better. Yeah, thank you very much. And so Sonali, today when we had the RBI Governor with us, he spoke about 9 points. He enumerated what the future economy looks like and what the RBI is doing to see to that things are online. And he did mention that technology is one of the major factors which would contribute to digital transformation, and future on technology would be something that every one of us would be looking forward to. So this is something that we would be discussing now, an interesting topic in now after this conversation, of course. So let's talk about the evolution of the fintech ecosystem. You did say that, at 2016 you had started out. I know that at 2016 fintech was an evolution. Many of you would have remembered that at that moment. And so let's talk about where fintech was earlier, how technology has played an effort, and how the journey till now.
I think I will go back to my time in 2016. I was just talking to somebody and mentioning the same. In 2016, when I was leaving my banking career, everybody at HDFC Bank was asking me that, oh, why are you leaving banking, right? And what is fintech? Whether it is about lending or it is about technology. So those were the questions that one started the journey with. And I think over the last 8 to 9 years, the appreciation in terms of what fintech is and how technology plays an integral role in terms of lending, that has been established. So the proof of concept in terms of an institution that is truly built on technology, that proof of concept definitely has been laid out. So one of the key things that I would want to bring across is that when one talks about fintech, right, fintech has two components. One is obviously the lending component, which banks and NBFCs have been doing it very efficiently, and capital is an important driver. But the technology component, which is about having technology on processes like underwriting, using technology on customer support, using technology on collections, using technology on every little process, right from customer acquisition to collections, is what we've truly demonstrated. So as much as I talk about it, we as an organization have a 500, we are a 500 member organization, but around 350 people are technology and analytics. There is zero manual underwriting that happens in the system. So that in itself is a big testimony of what we've achieved as an institution or what we've achieved as a vertical. I was recently looking at a CIBIL report, which basically said that there are 26 crore active borrowers in the country. When I ventured out in 2016, that number was around 8 odd crores. So in terms of financial penetration, in terms of the contribution that NBFCs have done, fintechs have done, I think we've come a long way.
Yes, and when you talk about, see, fintechs have enabled smarter and smaller payments, okay? It has almost been now a competition for microfinance, I would say. Is it not right? So lower ticket sizes has now led to, is it a time for collaborations and partnerships? What do you think? There are many bankers in this room, of course. So
yeah. I think Capital One followed this strategy, which is called as low and grow, right? Which is about saying start small with the borrowers, then over the lifetime of the customers, give higher ticket size loans, and that is where you start becoming CLTV positive. So that is one thing that we've taken from the incumbents and basically tried to implement it. So right from customer acquisition to disbursement to collections, everything is fully digital. There are two big things that we've been able to establish. One, there is a possible way of giving out loans at a cost which is very, very low. So we've managed to acquire 10 million customers. The second thing that we've been able to prove is that there is this true concept of risk-based pricing that exists, where you can charge the borrowers differently and cover a much larger mass. So, Lavanya, to your question, I really think that it is not about any competition that exists. Fintechs have truly proved that there are POCs on technology and on underwriting which work. Now it is about getting the right capital support from larger institutions, whether it is large NBFCs or banks, and making it a very collaborative sort of a relationship.
Yes, and you made an interesting observation, that you have zero underwriting, right?
Zero manual underwriting,
zero manual
which basically means that nobody looks at the case from login to
which is stupendous, right? Now coming on to an important factor which would be contributing to it would be data and analytics, if I'm right. So now this has been technology being enabled, which is all the story is all about, and now you've come to stage where manual interaction is not even required for an important function like underwriting. So where do you think it will go on further?
So Lavanya, I would take the question in two parts. I think as much as we have used digital in the right way, I think government has also been the right enabler. When we started in 2016, there was no eKYC support which was available. There was no concept of account aggregator. There was the access to the SMS data of the customer in itself was poor. Banking messages never came on SMSs. So the UPI did not exist. So the digital infrastructure also did not exist. I think both in terms of what government initiatives have done and what the technology partners have contributed, that has got fintech where we are. I think the next 10 years, at least, the way I would see it is that it is a lot about collaboration. Fintech truly has proved that there is a niche that they have created in terms of acquiring customers. Now, if we have to cross-sell better products to this customer, get to a better lifetime value, it requires a lot of partnerships. It requires the right capital to come in, whether it is in form of equity or in form of debt or it is co-lending partnerships. So at least next 10 years, I would believe it is about fintechs working with the larger institutions and truly acting as an acquisition engine, whereas the larger institutions would act as the capital providers. So that is how I see it.
So in conclusion, can we safely say it's a time for partnership and collaboration, a new era for fintechs, and technology being the enabler?
I think, Lavanya, the way I would put it is technology is the core. I think it's proven beyond doubt that without technology, you cannot operate. There are tons and tons of data being generated. That is becoming also the core of all the Gen AI initiatives that people are running. So I would say that technology, it is a given that technology will be the core. But next 10 years truly would be about capital partnerships. It will be about product partnerships. It would be about deepening in the customer base through collaboration. That is how I would put it.
So we throw the thought out to the audience and we end the discussion. Thank you very much for this.
Thank you, guys.
Thank you. Thank you, everyone. So we had an enlightening discussion, I would say. Me and Sonali, we could have spoken more. But coming on to the main panel, which is the next frontier in technology. So what we spoke about was a precursor of what is all about, which will be discussed in the panel. We'll have this panel moderated by Ms. Gayatri Patsarthi. I'm sorry, I missed out. Okay, may I call onto the stage Mr. Nitin Shah, who is the Deputy Managing Director and Head of Digital Banking, State Bank of India, Mr. Bijit Bhaskar, who is the partner Premji Invest, Mr. Bhaskar Babu Ramachandran, co-founder and CEO, Suryodaya Small Finance Bank, and it will be moderated by Siddharth Vishwanath, Advisory Markets Leader, PwC India. Thank you. Can I have a round of applause for them, right?
So thank you everyone for joining us today, and I'm delighted to have with me this eminent group of panel members, and it's going to be great to have a conversation with all three of you, with people from large leading banks, a small finance bank, and somebody who's driving capital flows into technology in many ways. So maybe let me start with you, Nitin. Why don't you share a bit about what you believe is the new frontier in technology, and what are the 2 or 3 technologies that could potentially drive the next round of innovation, or is currently driving the round of innovation in BFSI?
I think the short answer is generative AI, number 1. Number 2, banking as a service, both which you end up using internally as well as helping you partner with people outside. And 3 would be probably a lot more innovation around customer experience, again by use of a lot more data science. I think broadly around these 3 is where most of the work is now converging, at least in banks.
Sure. No, thanks for that. And Bhaskar, in your view, what are you seeing? Like, Nitin spoke about generative AI, customer-led transformation, and so on and so forth. But in your view, what's the trends that you are seeing in the small finance banks and that segment? Yeah, I think we've got 2 Bhaskars, so that's going to be interesting. Yeah.
Sure. I think I was just telling both Nitin and Bijit, saying that the number of employees inside a bank branch today outnumber the number of customers inside by 2:1. So clearly, I think technology will be the core driver. And as Nitin rightly said, the key I would think would be in terms of not today, technology is kind of democratized to a point that even if I'm a small finance bank, I can offer the similar kind of a technology as a large bank would do. Could be an SBI, HDFC. The customer experience is what that would really be very, very important in terms of usage of technology. That would differentiate, as Sonali also mentioned in the last panel. It is about collaboration. You need not manufacture all the products to yourself, but the very fact that you can service all the other products, which is the best in class, to your customers would really require a substantial technology implementation. More than that, it is not the infrastructure. I was coming through Atal Setu from my office in Belapur. The infrastructure is superb, but to access the infrastructure, the roads are pretty bad. So that I think the technology per se is that infrastructure, but how to really have the railroads to access that infrastructure would be driven substantially by technology.
Sure. And just to continue with you for a minute more, tell us a bit about how digital are you and what's been your digital journey?
Since we didn't have any technology baggage, as I call it, technology debt, so we started zero up. So to that extent, my branches are no more than 600 square feet, completely on technology. We don't even have full-fledged connectivity. We just operate out of tabs. Our new branches, which we call it as smart banking outlets, are 1+1 with just a tab. And probably we'll have some VR experience where customers can come to the branch, but talk to us at the head office. So these are the things that we are really looking at, and that I think I don't run ATMs at all. I said not really required. I don't run lockers. So these are the ways that where I'm not really tied by legacy in terms of customer will come only when we are able to give lockers, when ATMs. Now that ecosystem is large, as again the previous speaker mentioned, that UPI didn't exist. Now with all of that existing today, I think we have to just focus on only one thing, which is in terms of delivering customer experience without making them go to the pain points.
Sure. No, so maybe I'll come to you now. Bijit, should I call you Bijit or Bhaskar is fine?
Bijit is fine.
Okay, Bijit is fine. Okay, great. So maybe let me come to you. So, I mean, Bhaskar also mentioned about VR in many ways. So obviously there are there's a range of technology. Of course, AI is the most talked about, but there's VR, there's metaverse and so on and so forth. So where are you seeing capital flows? I mean, of course, AI for sure, but, just would like to hear from you.
No, see, from a bank's perspective, I think there are various other places where they would actually be looking at investing. And if you look at it as to what are the key things that are very important today, cyber risk is probably the place where, maximum capital flow for a bank would go to ensure that, you do not have any adverse attack which is coming in. And, and that's the reality of today, right? So therefore, that's one area. The second area where the bank, I'm sure, must be investing a lot is from the digital fraud perspective. How do you ensure that you identify the digital frauds? How do you ensure that you avoid it? How can you ensure that you don't get bad actors coming into the ecosystem? And if you see the latest RBI report, I think last year the digital frauds were almost 1,500 crores. So therefore, it's really a place where you need to really invest. The third area is the entire data analytics. I think there's still so much of work that needs to be done not because of anything else, because the amount of data that banks have. Some banks have got legacy systems. It's lying in multiple places. So how do you try and ensure that you actually have a modern data lake or a data architecture so that you have a very seamless experience? And last, obviously, in the whole customer experience and user journeys, and how do you upgrade your both back-end, middleware, and the front-end systems to ensure that you can actually be ready and compete with what the fintechs can offer. So I think these are all different areas into which there will be enough capital allocation that the banks will do, and that's exactly what we are seeing even from all technology supporting fintechs. That these are the type of fintechs who will be getting more capital allocation and investments, because this is really a need of the hour.
Sure. No, I think you brought out some good points there around investments in cybersecurity, and as we speak today, the globe is having an outage in some ways, right? So, and of course, points around data analytics and so on and so forth. But I'll go back to you, Nitin, on you spoke about customer experience, and I think in many ways you're putting out railroads to connect with customers through your YONO platform, etc. So tell us a bit about that, and how are you sort of driving customer experience in a slightly differentiated way?
I think we're just trying to take it to the next level by making it more personal, hyper-personal if you'd like to call it. more use of insights that we have about customers, insights that we can gather while customers are interfacing with us across all platforms and channels. But I think we are also now moving slightly away from the traditional way of looking at customer personas and therefore giving them, any kind of intervention. Also layering it with a risk profile of customers. Because now in the context of cybersecurity again and the digital frauds, it is more important to have a risk-based filter also for the same customer persona. For example, if you have a persona which you think is most likely to consume 1, 2, 3 products because it fits your algorithms, it could also be a profile which is also vulnerable to a higher amount of risk. So you do want to create better experiences, but you also want to create some little bit of a hurdle rate there or some amount of friction so that you don't expose the customer to any incremental risk or any new kinds of risks which might emerge in future. Okay? So to that extent, I think the effort now is to make it a little more, risk-based personalization. I wouldn't say that it is only going to be risk-based and everything becomes more and more difficult, but yes, there should be an appreciation, a lot more of that, to say that yes, we would like to do this. One, we would like to do this with explicit consent of customers. And two, we would be mindful of the fact that we don't expose the customers to any undue risk. Now that puts a lot more responsibility on the bank to say that, okay, how do you manage that risk? Because the customer is not aware that they're getting exposed to a new kind of a risk. So then you need to upgrade your risk models, you need to upgrade all those tools that you use to profile customers and either alert them in advance or make sure that they're excluded from some of these things in case there is any possibility of being vulnerable to that. So these are the new things I think we are bringing in the practice now so that we don't create any new possibilities of or new categories of risk as we go down this path of just keeping to improve the customer experience.
Sure. No, I think a very interesting point you brought out about how you sort of say, trying to be the right custodian for the customer in terms of, supporting them from a risk standpoint. So I think that's great. So it's not just about user journeys and user experience and upselling and cross-selling in that sense. So Bhaskar, maybe let me, ask you this question, which is, metaverse was a hype in many ways. And the question is that hype, is it going to remain a hype, or do you think we'll see real life use cases in the banking sector a lot more as we move forward? Any commentary on that?
See, usually some of the trends which we see, including this UPI adoption which happened, many of the changes sometimes which are deep, takes long, it is slow and then sudden. So I think that phase of being slow is what probably we are seeing. I'm sure it will be a tremendous use and it will scale, and including mobile. All of that takes around 4 to 5 years in terms of where nothing happens, and suddenly you realize that in the next 1 or 2 years, everything happens. So probably I think I would say that we are in that phase.
Sure. And what sort of use cases would you relate to with vis-a-vis metaverse?
So I'd rather kind of go currently what it is not there. If now today I have to transact, as Nitin was also mentioning, banks are increasingly becoming the custodians, I would say, specifically us, who cater only to the low-income households. We are actually quasi-decision makers on behalf of the customer. When that responsibility is given to you, when that authority is given to you technically, your responsibility increases tremendously. So we'll have to make sure that the quality of service at the branch is not left only, and given that the attrition in the private sector banks is close to 40 to 50%. So you don't see the same branch manager if you're going to the private sector bank for the third time over in 3 months' time. So it's very important that customers, as they walk in, are able to directly have the experience of meeting the best of people that they can interact, which obviously cannot be in every branch. It could be at the headquarters, it could be at the service centers, and that where the technology, at least at the virtual reality, will be the first step. And thereafter, I think now as the technology improves, it can technically be interacting with the person, the best resource, without actually meeting them in person.
Sure, sure. No, I think thanks for that. And I had also learned of this pretty interesting use case, which is the future of me. So a couple of global banks have done this, which is you kind of replicate in the metaverse your future, especially in the wealth management space. So that was quite an interesting. So you look at your future self and attributes, and then based on that you drive advice on wealth management. But yeah, so Bijit, tell me a little bit about I mean, of course you kind of work with fintechs and tech fins. So where do you see the trend shifting? Is it still the fintech story, or is it more the tech fin story, and what sort of areas are you seeing there?
I think both of them will continue to see flows, because for the simple reason that both of them will exist, right? You need support for financial institutions from a tech perspective. Therefore, you will certainly find that more and more financial institutions will reach out to a lot of these new age players to automate, to digitize, to give the back-end support. And you're really seeing that. I mean, I'm sure there are enough examples in the market where large institutions have actually gone on to take some of these solutions from these tech fins as their back-end solution. So I think, and your ability to actually look at many of these entities who give really cutting-edge tech, who are nimble, who are future-ready, to actually, and when you start working with all of them, and if it is in a manner which is plug and play, it becomes easy for you to integrate with many players and operate. So therefore, I think that tech fin will continue to play a role, because that's what will make banks much more modern and much more nimbler. Fintechs, of course, there is a huge opportunity for fintechs to continue to explore the market. I think, be it on the unsecured space, there's a lot of play, I think, that is going to open up in the affordable housing space. I think there's a huge opportunity that will come in the MSME space, because these are, the unsecured personal loan space probably still tapped a little bit more. But I think there's a lot of opportunity in affordable housing. There's a huge opportunity in MSME. And I think you will continue to see a lot of interesting, entities come up there. And I'm sure that, if there are interesting use cases, there are interesting sectors, you will obviously find that capital allocation to those entities will continue to happen.
Sure. No, thanks for that. Maybe Nitin, any comments in terms of what you think is the future of CBDC, and where do you think that's going to go?
I think we need to give it time. Most of us are either rushing to conclusions about whether it's working, not working, or maybe we are hoping for a scaled up adoption a little too soon. We just need to give it time. There is obviously established that there is a very clear set of benefits when you use CBDC for both retail as well as wholesale transactions, including cross-border. But those need to be gradually mainstreamed. When we try and mainstream something which is still being tested and hasn't been tested by everybody, then chances of disbelief are a lot more. So I would think, at least my understanding is that it does have a promising future, but we just need to be patient and give it a lot more time.
Sure. Any comments from you on the same topic?
It will, as Nitin said, it will. But as of now, we haven't really found the real use cases. It has to be truly a substitute for cash. Anonymity has to be kind of an port. Otherwise, there is no difference between that and doing through the digital. I think that factor of differentiation has not been outlined very clearly for this usage to really pick up.
Sure. No, I completely agree. I mean, anonymity is probably going to be key for it to really take off. But I guess there's also this element. So while I think at some point of time, government showed some intention to say we will go that path, but I think you'll probably require a lot of strong regulations and trust in the ecosystem for the common man to really say that yes, it is anonymous in that sense. So I guess that's there. And I think the other piece is what Nitin also mentioned, which is the use case around international remittances. I think that can be a game changer, but that's not something that's easily done, right? I mean, with UPI also we are seeing only bilateral arrangements. So any thoughts there?
Much of comments on that, because we as a small finance bank focus more in terms of domestic. So I'm sure Nitin would be the right guy, or probably Vijit.
So I can just add a point or two. So therefore, with probably the opportunity for fintech players start, building use cases around CBDC, I think that there are opportunities that can play out there. The other thing is that cross-border, as Nitin said, with whatever is happening in GIFT City, and if CBDC works, again, there's a great opportunity for full, revolution that can happen on that international cross-border payments. So I think these are a couple of areas which will be good use cases for CBDC, even without the anonymity, etc., being an issue.
Sure. No, thanks. Thanks. I think that's useful. Again, I mean, just kind of sort of getting to the most favorite topic in today's conversation, which is Gen AI. So, any thoughts on of course, I mean, to what extent have we in the banking sector today really leveraged and fleshed out the benefits of Gen AI? Any comments, Nitin?
I think it's early to demonstrate the quantifiable benefits, but I think from a pure hypothesis point of view, the benefits are known, because the first set of benefits will really apply on the productivity side, and most of the low-hanging use cases are around that, which banks not just in India but across the world are trying to come up with. The second set of benefits will really come around processes, which will get improved, the models, forecasting, risk models, fraud prevention, cybersecurity. But that will be the next phase when there is a deeper deployment of Gen AI within our operating models. And eventually, it is expected that Gen AI will lead to the innovation cycle itself, where banks will be able to innovate on the back of the already established baseline of what Gen AI has been able to bring about. So I think we just need to go through that whole journey rather than trying to get to an end state right now, because there is really no end state. This technology is evolving by the week. Every day is a new learning it's something new to discover in this technology. So the best way around is to just keep testing it, keep deploying, and keep finding those low-hanging productivity gains, which are imminent, and they have been tried out both in India as well as outside India. And I think as long as that works, it gives the confidence for the next phase.
Sure. Thanks. Any comments?
Since you specifically asked for banks, so I'll tell you based on my experience with ICICI. I think there are clearly a few simple use cases which certainly are being used. One of it is obviously your entire phone banking, voice, and how that can be used to enable and improve productivity. I think this other area is basically wherever there are robotic processes. I think that's a clear yet another case where Gen AI is being used in some form and shape. It's also I think being used from the perspective of interactions with either the front-end staff or with the relationship managers to make that entire experience that much more better to ensure for that particular conversation as well as for future conversations, because Gen AI can help you contextualize it. It can make your productivity much better. So therefore, there are these simple use cases. If you expect that a bank is going to use it for writing a code, I think we are some days away from it, because it's not easy especially for a bank to start depending on certain solutions like that. So therefore, I think there are those use cases that are there. And it will take, at least in a banking world, and that's how I think it should be, because it's regulated, you need to take care of people's money. So obviously, you build use cases where you know as to how this technology works and whether there are any other allied problems that these technologies can bring about. So I think that's how it will move with the banking industry.
Sure, thank you.
I would rather look at first as a process improvement and for customer service. I think as we kind of have test the use cases, it can be of tremendous use, and as Bijit also said, in terms of customer service, in terms of contextualizing. So if somebody calls and then we know that the call will last for 4 minutes, and specifically this is a particular customer, you can really use it in terms of contextualizing the whole thing, and you can use it across. I think I would rather look at first as a process management, cut out the waste in every process. We have done it, and then legacy we keep adding addendum 1, addendum 2. So 90% of any process looked sharply is waste. So it's only 10%. And that's, I think, is better done through Gen AI. Second would be customer service. This is what I would like to really look at it from a small finance bank.
Sure. No, so clearly, efficiency, risk management, and customer service, customer interactions, I think those are the three sort of takeaways from what I heard from all of you. And I completely agree. I think some of the other stuff around upsell, cross-sell is largely a lot more machine learning and AI, traditional AI, but there's some bit of
content generation, for example, is a low-hanging use case.
Yes,
marketing
absolutely.
content.
Marketing content, absolutely, and marketing campaigns, right? Absolutely, absolutely. No, that's great, and maybe I'll open it up with for some questions. If there are any questions from the audience at this point, we've got about 5 minutes remaining. So if there are any questions, we could take questions for the panel.
Good evening, everybody. I'm Anirudh from Ashiana Financial Services. I have a query on what Gen AI can do for customer experience.
Sorry, Gen AI can do for?
Customer experience, enhancing customer experience. Anybody on the panel can answer.
Yeah, so there was a bit of that was shared, but do you want to just summarize it?
So, look at it from this perspective that let's assume that today, typically, if you see the interaction between a front office staff or an RM with a particular customer, the whole process is by stating that there's a conversation that's happening. There's no way for you to record it. Then somebody will have to put, capture a minutes, and you don't know where that minutes is going, what is happening out of it. And let's assume the next conversation happens with the same customer. You sometimes restart all of it, or that memory is lying with the individual. It's not an organizational memory. Now, imagine if all of these things is actually happening in a system where it's getting recorded. Let's assume that you're doing it on a platform. Even if it is, let's say, something as simple as Teams. At real time, minutes are getting generated. Real time, key points are being picked up. Real time, you're able to generate as to what is the next possible product that you can offer, or the possible service issue that the customer has, depending on the conversation that is happening. And ensure that all of these things, and what is the solution that the customer is looking for, all of these things can be rendered real time without having to rely too much on either the individual's knowledge or he reaching out to some superiors, etc. Because it can be done at an organizational level, and this whole thing then remains an organizational memory, so that even subsequent interactions can become that much more meaningful. I think this is one of the use cases that you can look at.
Yeah. Okay, we have one more question.
Yeah, hi, good evening. My name is Adil from a tech company.
Just keep the mic closer.
Yeah, sorry. My name is Adil from a tech company based in Bombay. My question is for Mr. Bijit Bhaskar, partner Premji Invest. What kind of major investments is done by Premji Invest, and what are their return expectations, and what type of investments generally Premji Invest do? Thank you.
Return expectations, obviously, I'm not going to tell, but the type of investments that we do typically are, obviously it's a private equity firm, so obviously they're larger checks, so it's not at a VC level or at initial seed level. But any interesting solution which could be in the space of either the fintech or the tech fin, which can bring in new use cases, new segments, new innovative methods to do the business which are more productive, and it could be in any of the areas of financial services. It could be lending, it could be wealth management, it could be insurance, etc. So the entire landscape of that is the area in which we operate, and obviously just like any other private equity, the expectation is that it gives those returns. Yeah.
Okay, so I think we got two questions from the audience, and thanks so much. We'll take a last question.
My question is that how frequently you upgrade your technology. See, Intel has come up, after every 18 months, they come up with a new generation of the processors. And in banking, finance, everywhere, whatever the technology you're using, what is the frequency of upgradation of the technology?
Anybody who wants to take that?
See, the frequency of upgrade is again based on multiple aspects. One is that it doesn't really have to be upgraded just because the manufacturer is upgraded. You don't change your car because a new model has come, right? Just because a new model is there, you don't discard your car and say that I'll buy the new model. Okay, so when you're running with a technology which is meeting your purpose and is being supported by the OEM, you run with that. You obviously keep upgrading, you keep applying the new features. When it is turning obsolete, or you have a visibility to say that yes, it is going to turn obsolete, there will be no support, there is much better technology available, then you start the whole replacement cycle. But the upgrades is an ongoing thing. Upgrades doesn't have to wait for a time-bound thing. If it is an upgrade that's required every 6 months or lesser than that, that takes place.
Okay, thank you. Maybe I'll just quickly go through a quick 30-second round. Okay, and all that you need to tell me, I'll tell you a technology, and all that you need to say in the context of BFSI. In the context of BFSI, is it a hype? Is it hype or real? Okay, so just quickly, we'll just go through that. So, Gen AI?
Will be real.
Will be real. Will be real. So, slightly futuristic. Okay. Quantum?
Hype.
Metaverse?
Metaverse is gone. I think the phase came and went also.
It's
but
gone.
quantum,
Okay.
I agree, is, did you say hype? I believe it is still in a research phase right now. We just need to understand it better.
Yeah. Okay.
And the reason I say that is because our technologies that we've used for computing are based on pure mathematics. Now you have physics coming in quantum computing. Our people are not trained to be both physicists and mathematicians. So when we understand that through some academic research, which is anyway going on across the world, this could be the new frontier.
Sure. No, I agree. I mean, maybe it's a hype at this point, but it'll be real in 2 to 3 years, possibly. I'll continue with a quick one more round. Sat tech, satellite technology for banking.
I haven't even thought about it, so I'll pass.
Okay.
I can answer that question because we did it, I remember, in ICIT. It's got its use cases, but it's limited.
Okay, so more hype.
I wouldn't
In the
say
context
it's
of
hype,
banking, you're saying it's more hype.
That's why I said it's got its use cases, but if you look at the entire thing, it may be one or two use cases.
We can add one more word, niche. So it's niche.
It's niche,
okay,
yeah.
Fair, fair. 5G?
5G is coming as a grand rollout, no? So it's not, you can't escape it. So it's not like it is going to help every single industry. Why just banking?
Fair enough.
Yeah, even
okay.
6G.
No, fair enough. I just thought we'll have a quick round of some fun. So thank you all. Thank you very much for joining me. And it was lovely having you with me. Thank you. Thanks, everyone.
Thank you, panelists. We had a last panel discussion for the day. We talk about the journey to 2047 beyond staying on course with outreach expansion. After Mr. Debashish Panda's speech, I'm very sure there were a lot of questions and where insurance was going on, and we were talking about his theme of vision for 2047, and today we take on, this panel takes it on. We call to the stage our moderator, Mr. Roshan Puvaya. We have our panelists, Mr. Tapan Singhal, Mr. Ravi Vishwanath, Sumit Bora, and Kasparas Kromhout on the stage, please. Thank you. Probably a few minutes' time. Yeah.
This invariably happens after every battle. I think we need to now. We have a 5-minute break. Card exchange session. Can we start now? I mean, has everyone settled down? Yeah, hi everyone. In the afternoon, we heard Mr. Devashish Panda, the chairman of the IRDAI, talking about the journey to 2047. And insurance for all was the topic. I mean, why 2047? Because it coincides with 100 years of independence for India. And at the moment, we still have a lot of ground to cover in the insurance space. And with me, I have some of the country's top insurers as well as insurance broking agencies as well. So just to start off, I'll start with you, Tapan. With regards to insurance for the underinsured and the uninsured segments, what innovative insurance products can we come out with? We have some from the government saying like the 200 rupee premium, PMJJPY, all of that. But are there any innovative products that we can come so where we can cover a large segment of the population, if not all?
I think let's approach the problem statement first. See, insurance is not something that people normally are excited to buy. If I ask the audience, I ask any one of us sitting here, who got up excited to buy insurance any day? No, the answer is no. So you may come out with any innovative product. The issue is that people should be buying it. So the problem statement here is that if I look at insurance typically, it's always a collaboration between the government and the insurance industry, which gives amazing results from a social security perspective. Case in point, if you look at the Pradhan Mantri Yojana on health space, it has covered so many people across states. And each state may have a different scheme, like now Maharashtra has come out for everybody, 5 lakh sum insured. And you see millions of people have benefited from it. Now, from a perspective of the basic necessities of insurance, there are 2-3 segments which has to be taken care of. First and foremost, health. Because about 10 crore Indians go below poverty line because they can't afford the health care every year. I think that is the data point. Second problem statement is if you look at all these catastrophic losses like Sikkim, Uttarakhand, all these flood losses which happen.
Disaster.
So a lot of people who work very hard, build houses, build contents or SME, MSMEs, and most of them not covered also. One incident and it just pushes them back by 30, 40 years in terms of, now that has to be addressed. Third is crop. If you look at, though we have this Fasal Bima Yojana, but it still covers about 25% of the farmers, in terms of it. When US, I think if I take it back 10, 15 years back, US, India both had about 25%. Now US is reached 70% coverage of farmers. Now that is the third issue which comes in terms of the social security and the benefit. Fourth would be the term life or the natural death, which should be covered. So basically the products such as these 4-5, which are very basic necessity for every individual of a country to be had. If you look at the developed markets, they would have a healthcare for all. They would have like 95 penetration for home insurance and the countries look at US, which would be there. They would be having this. So as a country, we have to, in collaboration with the government and the regulator, as an industry, provide this uniform or universal coverage to every citizen of India in this 4-5 thing which is there. So a lot of efforts are being made. We have, you must have heard about this Bima Vistar, Bima Vahak. Yes. The product has been designed from the industry along with the regulator, in which you have a life component, a term life. You have a content for the buildings, and you have a cover for health also. So this is being created, distribution is being created, but it has to be worked a lot more in collaboration so that the entire country can be covered for these together.
Okay. Ravi, if I was to come to you, especially from the health angle as well, if you could just tell me about some innovative products that we could have.
Same question, yeah. So I mean, just picking up where Tapan said it, I don't think it's a product distribution problem. I think there is a, I'm just speaking on healthcare for the moment, or health insurance. So there was a recent survey done, and 34% of people said that they don't buy health insurance because they don't see the need for it. And this to me is something that is bizarre, because we're in a country, as Tapan said, 100 million people, 10 crore people go below the poverty line because they can't afford to pay, pay their healthcare. 21% of people, have to borrow. We're a country where only 40 out of every 100 needed surgeries get done. Okay, and the rest of the people don't do the surgery largely because they can't afford it, and they just basically die. And I think that there are some fundamental issues when it comes to healthcare, health insurance. First of all, we as a country don't really have healthcare. What we have is sickness care. You get sick, you go to the hospital. We don't have a good primary, secondary care system, issue one. Second, healthcare is completely fragmented. So, you have this pharmacy, that doctor, that hospital, that insurance company. None of these guys talk to each other. There is no central data. There is no real way for either your doctor to treat you or for your insurance company to understand, the full risk of what is it that they are taking on their books, and that impacts the kind of products and other things that can be sold. And then finally, you also have this system of kind of institutionalized mistrust between the payer and the provider, where the payer does not trust the provider does not trust the payer. And that then leads to a whole bunch of unnecessary outcomes, which both parties have to do that are logical. The insurance company has to manage its risk, the hospital has to manage its revenues. At the end of the day, it's the customer who isn't covered, right? And until you solve these things that are more fundamental, at least when it comes to health insurance, you're not going to really make much progress, because on private health insurance, 14% of people are covered in our country, 4%, 5% are covered in retail plans. There's a long way to go.
Right. Kasparis, if I was to come to you, how can you leverage technology? I understand you use a lot of technology, especially in the micro insurance segment. So how can you leverage technology to create accessible micro insurance solutions?
Roshan, I think from what I could see, I've been in India now for 14 years, and I think I've been lucky to come into the Shriram Group, specifically Shriram Life, so I can speak on the life part of it. But the Shriram Group has always been focusing on the slightly lower segments, trying to serve the community in that way, so lower middle market, even depending on which product, slightly even lower than that. So there's always been a necessity to innovate and to bring products and solutions that could actually help at that level. So in some ways, if you look at life insurance, in some ways we do microinsurance. And we've been fortunate that through our sister companies, there's been quite a bit of innovation. If you look at the millions of truck drivers and truck owners that we insure, you have to bring that, let's say, education and awareness, but it comes through providing something that they can actually get insured for. So even if we started with credit life insurance, which is pretty standard, but it was not initially accepted until they started seeing the claim payments. So in the community, when you start seeing claim payments happening, then suddenly the awareness becomes very, very high. And then that provides you with a basis to do more innovation. And now we are seeing things like, for microinsurance, we see some companies doing platforms where they bring, on the group business platform, you bring different groups together instead of doing each of them as one group, which typically as a life insurer, we would ask a huge amount of questions. The group would be too small. It would be difficult to insure. You see companies bringing groups together in platforms where we can insure them as a larger group. We can take a larger view. So I think there's a lot of innovation that is happening right now and that can happen. And there are many ways. Technology now helps us. When I came here in 2010, I struggled to get ECS to work for regular payments, right? And then NACH came, and then so many other new technologies came, which made it much easier. So continuously technology is improving to such a rate that it makes it much more easy for us to get things done. Now it's just a question of, how can we apply our thinking and bring solutions to the market that can actually make that happen.
Okay, yeah. And with regards to distribution, if I was to come to you, Smith, beyond just the traditional channels, what partnerships can insurers get into to expand the reach of insurance?
So obviously there are many channels from the distributor's perspective. Almost there are 6-7 channels from agents, brokers, IMFs, corporate agencies, So all these channels are there. And, again, we have partnership like from a broker's perspective when we talk, we have something called a POSPs. So there are almost 22 lakh POSPs which are attached to insurers and brokers. So as far as channels are concerned, there are enough channels in the system. Obviously, technology, you're talking about technology. I think that is what we need to use to make those channels more viable in terms of, how they do the last mile delivery and how they can connect with the customers and how, they can solicit the policy. So I think that's where the key is. So we have almost 50 lakh people working in the insurance industry when you talk about agents, POSPs, and, the insurers and brokers. So I think technology led by people and a phygital model could probably lead to that.
Right. Tapan, you want to add to that? How we can expand the reach of insurance? Distribution.
So if I look at those Sumit mentioned that there are about 30-40 lakh distribution force, but for a country like India, that is still very small. The point is, how do we solve this problem? First is the last mile, the Gram Panchayat as the basic unit. So can we all say that, do we have a distributor in every Gram Panchayat of the country? I'm not sure if the answer is yes. So let's start by cracking that. And we heard about the Bima Wahak, and very soon, I think we'll be an industry trying to tackle that every Gram Panchayat, at least at the last mile, we have a distribution network which caters to all the segments of insurance, be it health, be it life, or be it non-life. That's on the reverse side of it. Second, let's say if I look at in terms of even very aware, educated people sitting here in this room, and if I ask that, can somebody stand up and say that they have a health cover for themselves, not by provided the company, because that is transient, Second, their home is covered, their content is covered. Third, they have a term policy, the product that I mentioned about, Fourth, they have a personal accident policy. And fifth, they have a cyber. Today, phishing, malware at individual level is very high, A retail cyber product, I think if I just put, and if somebody stands up and say yes, then we don't require any more distribution. I think we have reached a saturation. If only one person can stand up and say that. If the answer is no, nobody can stand up and say, I have all this product and I've taken them, or somebody, distribution sold to me, then we have it, which means that we have to create a massive distribution. And we are in talk with the regulator in terms of simplifying the licensing process, looking at different models of distribution, looking at new segments of distribution, looking at even the tech part that you mentioned, people who want to be pure virtual distributors. How do we put that together? As an industry, we are talking about it. But in my belief, our country, if I look at the insurance growth, double digit for past 20 years, phenomenal, CAGR, will remain so for the next 20 years. But the kind of growth that the industry should be looking at is plus 20% to 30%. And it can happen with the kind of distribution explosion, and it should happen. Till we get these answers, till we get a hall where we ask this question of basic insurance that everybody should be having, and everybody stands up and says, yes, we have it, then I think we have reached a place where we can say distribution has.
It's interesting you mentioned that, because I think the government earlier had incentivized insurance distribution to some extent through tax benefits on ATC, ATD, all of that, which had people taking at least the basic insurance for health and for life, all that. But now with the shift to the new tax regime, some of that is going away. So do you see an impact of that on insurance distribution?
So I think I've mentioned this many times. My request to the government is that either we have a social security framework for the citizens of the country, No, it's fine. Like they are protected, it's fine. As an industry, it's fine. Or we encourage behavior in which individuals are able to protect themselves and safeguard themselves. Now, how do you encourage behavior? One is tax rebate. I think we have seen this work. We look at the life penetration that we see today, the way it has moved up. It was because of tax. Look at health. People do value that, and they have a role to play in looking at behavior. Or let's say even for home insurance, we're having so much catastrophic losses. If you check the amount of SME, MSME which have got destroyed, the guys would have been future big industrialists. In the entrepreneurship journey, they have become like poor people on the street. Why can't we have a mandatory requirement of cover for all SME, MSME? Why can't, even a simple, let me tell you, if you want to crack this health for all, and we don't want to pay anything from the exchequer. Let us say the government says we don't have the money. In US, you have a condition in which every employer has to provide a cover for every employee of theirs. Now, let's say in India, we say every employer should provide cover for every employee, and the payment can be from CSR fund. Second, you already have government schemes. The government schemes premium is how much? 1,500 rupees to about for a year for a 5 lakh floater cover for family, which means that if I have a house help and if I have mandatory to cover the house help, what am I talking about? 150 rupees a month? Will I not do it? Or anybody say no to that? Now, it doesn't even require government no money. It's the intent to see how do we solve this together, how do we put together. In the light of the question we asked, the tax benefit should be there. The government are losing it. It's creating a social security net by individuals for themselves. They're building it up. And it's a very powerful thing if we want to say that we are a Viksit Bharat, we are a developed nation. This is the basic minimum the citizens of the country should be having.
Okay. Well, that is from the government side, but
I think, just one more thing to add, just from the government side, right? Just from a consistency of messaging perspective. If you look at something like health insurance, it is taxed today like a luxury. So people pay 18% GST to protect themselves against, and we talked about all the stats about, people going below poverty line, etc. Why should that be? Now, I know there's a lot of discussions going on about this. Hopefully it will change. But just building on Tapan's point, I think it just needs to be a consistent approach.
Okay. No, so I was thinking, adding to what Tapan said, insurance companies right now are more interested with just sales, more policies, sell more policies, which of course they should be doing. But do you think that we should be also looking at educating at least at the grassroots level, since we're talking about inclusion and insurance for all, and making them aware of what insurance can actually do, how we going with
So
that?
before others answer, I just want to give some inputs on what's happened on that, and then we say. So as an industry, we all agreed to every year give a part of our collection of premium for this awareness creation. Okay. This has already been passed in the council, and you'll be seeing impact of it. I was speaking to the chairman IRDAI. He says even the regulator is going to do that. So there is a lot of work happening in terms of building up the corpus money for building this thing. And every individual insurance companies by regulations also has to do awareness, which they have to submit a report to the board and to IRDAI. I think I'll just give some input here and before I pass it on.
Yeah.
And I think that, those are good steps. And as an industry, I think we all have to do a lot more at the grassroots level to educate people. The 4 main covers that Tapan spoke about, for example, everybody should have it. There is no before you invest, before you do anything else, you need to protect what you have. And these covers are not expensive. I mean, this is one of the cheapest markets for insurance globally. It is affordable. You can find a lot of good carriers with affordable premiums. You must protect yourself first. It's kind of a basic. And as an industry, I think we all have to go out there and do everything we can to make sure that we communicate that message to people through all means possible.
Right. Kasparas, in your experience, how have you been going about at least making people at the grassroots level literate, since you all deal a lot with microinsurance like you're talking about?
It's almost counterintuitive, because if you look at just looking at it from the life insurance perspective, how it has been sold in this country, many other countries as well. Given the tax benefit and given all the others, it's been mostly positioned as an alternative investment or a tax-saving device way for more wealthy individuals. As insurance professionals, we all want average ticket size to go higher. We all want persistency to be high. We're looking at those parameters. But if you are going to cover everybody in the country, you need to be ready for the opposite. You need to be ready for much lower premiums, so a lower average ticket size. You need to be ready for other types of products. You need to be ready for lower persistency, and things like that. So it goes counter to that. But having said that, yes, a lot of awareness happens in that process. We all have the responsibility to do that as an industry. In my experience, what we have seen is, as soon as even if somebody's underinsured, or which most people are in India, but even if at the lower segments, when people at least get some insurance, that spreads the awareness that when it pays out, people become more aware about it. So I think it's still, in a way, it's still early days in India. It's still a very nascent industry. It needs to develop and grow. It needs to move towards from savings towards protect yourself first, as you said. Right. That message needs to happen. So, and all of us in the industry needs to work towards that, so people get covered first, rather than only using it as a savings vehicle.
Okay. Sumit, when we speak of insurance for all by 2047, and you can add to this as well. One of the big things is, how are you going to deal with the increased risk and underwriting that would be there when we speak of insurance for all?
So I don't think so. That's a bigger problem. If you have enough capital, obviously, the risk would be absorbed by the insurance companies. And, there is enough capital in the system. There are only 31 insurance companies on the general insurance side and 24 on the life. So as market expands, newer people will join in, more capital would come in. And obviously with the new generation, underwriting skills on, the AI and, the technology building up. So I don't think so that's a challenge for the ecosystem to really bother about. Probably we need more education. I am very passionate on the subject which you just spoke about on the education. I think that is where we are lacking. We don't have a formal education system where in the school, college, we are taught about insurance. I always feel that we need to go back to explain to the child what is the meaning of risk, how the risk has to be transferred, and what risk has to be retained. I think the day a child in a school or a college starts knowing about all these subjects, when he becomes mature, probably he'll queue up to buy an insurance for himself. And I think that is what I aspire to do. As an insurance broking association, we have already taken those steps. We have already generated a PowerPoint presentation which we have circulated to all the broker members, and we are urging all broker members to, go to their school, colleges, and, do it some session on a weekend to make these awareness, So that's what we are doing. Thank you.
Okay. And what kind of disruption do you see coming from, we're almost out of time, so in the interest of brevity, what role do you see AI playing in the insurance industry? I know that, for fraud mitigation and all that, there's a lot of ground that's already been covered by AI. And what kind of disruption do you see coming in from the newer digital-only insurance players? I can start.
So the way I have always mentioned is more the merrier.
Okay.
So US, you'll be surprised, has 6,000 insurance companies. And 6,000, yeah.
Wow.
And we have 60, 70, I think. If I look at even UK, they would be, even Singapore would be having close to 2,000, 1,000 plus, if I'm not wrong. So the more the merrier, I think, for a country of our size and population and the need, the number of communals. So all kind of people, companies are welcome first to begin with. They'll all create a solution. They'll all find ways to reach out to the customer. And hopefully that would open up the market and make it much better for the customer. That is the first statement. But have they done it till now? The answer is no. And not only in India, across the world, if I look at the tech, so-called pure tech players, none, and I can say that none have really been able to make a disruption to any legacy kind of part. So the problem statement is somewhere else. It's just not a pure tech solution of looking at insurance, because as I said, fundamentally the difference is in most product categories, the consumer is looking for the product. No? Be it in e-commerce, be it a loan to be taken. In insurance, the consumer is not looking for the product. I think it has to be handled very differently. That is what currently it is.
Okay.
And I think just to build on that, right? If you look at, I think this whole dichotomy between legacy and tech is, there is no legacy player that is not tech today, right? I mean, if you look at the company that Tapan runs, I mean, this is more digital than probably any other, insurtech that's kind of around, for example, right? What's the difference? The difference is that the legacy companies or traditional companies, if you want to call it that, their DNA is how to know which risk to take and how to manage the risk and the operations. What tech companies are supposedly better at is in having a better customer experience. I think that it is much easier, it's not easy, but easier for a legacy company to figure out the tech to improve the customer experience than it is for a company that knows good customer experience to figure out the risk.
Okay.
That's my view.
Yeah.
Yeah, from what I've seen here, I think especially life insurance, this is something that needs a lot of personal face-to-face interaction. And yes, technology solutions are very critical. They help a lot. They make a big difference. But disrupting purely from a technology perspective, in my view, would be very difficult.
Okay.
I think you need maybe from a technology perspective with a very large scale, coming in with a large customer base already. Maybe that could be a disruption. But purely with a technology solution, no, because somebody needs to still go and speak and interact. And my experience.
In hand, and obviously the expectation from people, grew every year in terms of the servicing. So unless you have that great technology along with a physical model, which we required in insurance, as people said, because the jargons are difficult to interpret. So you need somebody to convince, to handhold, and then probably technology to service it. So I think hand in hand, if it goes, probably we can do much better.
Great. I'm sure this discussion go on for quite some time. There are a lot of questions. Can you take just one or two questions? That's it. Because we have to, quickly,
So it's insurance as a product, insurers are selling trust. So there isn't like ROI until there is a claims. And we see in India, we want to push insurance for all. However, there's a place where there are a lot of anecdotal incidences where a claim is not done, or there has been a incident that has happened, and there is a bad mood. So that again leads to insurance as a product not being trustworthy. So how can brokers be there for these sort of grievance addresses for customers?
See, first of all, we as an insurance industry have not marketed very well in terms of what is the final outcome. So last year we did around 2.89 lakh crores on a general insurance side, where almost 2 lakh crores claims were given back. Probably we have never highlighted these kind of figures. So claim to milta hai, itne paise to gaye hi hai, 2 lakh crores has gone out. But probably that kind of outreach has not happened through the media, through the insurance industry, through the regulator. So I think that is what is key. And from a broker's perspective, obviously we are representing the customer. So we make sure that, and obviously there is an issue in terms of understanding between the need and what is being pursued by the insured. So when a person buys a policy, probably he feels everything is covered on the earth, but it doesn't happen. It's a contract. It's hard-coded contract, what is covered, what is not covered. And I think people's expectations sometimes reach beyond that. Probably we could definitely help in decoding that fact and helping those customers. As far as grievance is concerned, obviously our clients, we take care of the grievance, but we also help if we are not able to solve the problem, to approach probably to the ombudsman or to the other forums.
Yeah.
So I'll just leave you with two questions. Look at the answers of that and then try and think about it. First is, how much profit does the general insurance industry make overall? And how much profit does the banking industry make? So I'll leave this question to you. Look at that, yeah. Second is the number of grievances to the transactions. What is available publicly, let's say for general insurance, how much, and how much is it for the banking world? And then after you get this data, then ask yourself why this perception on the general insurance. I leave this homework for you. Next time when you see me, ask me. I'll tell you. But
okay.
Do this homework to be able to figure this out.
Can we take this offline, because we have to conclude and we're running a little out of time. So you can take your question offline. With that, I'd like to thank everyone for this very interesting session. Thank you so much, and hope to see you again at our next summit as well. Thank you.
Yes. We understand that our audiences are interested in insurance. Can we have an address? I request all our audiences to please listen. Sorry. It's too loud. Am I too loud? Okay. This is better. Can we have Mr. Sundaraman Ramurthy on the stage for his address, please? Yeah, after 2 minutes. Yeah, thank you.
Good evening, everybody. I'm sure it should have been a very long day for many of you. I'm sure you should have dared the rains today and come and spent long hours listening. I'm also told that there is some high tea after my talk. I don't want to be wasting your time and making you feel hungry. I'll make it very short. Whether it is sweet or not, I wouldn't know. First of all, I would like to thank the organizers for having me here. The platform where RBI Governor spoke, to be present there in itself, I consider as a great honor. Thank you so much for that. when I saw this summit as BFSI Summit, it took me back to my beginning days of my employment. I started as a career banker somewhere in 1982. The banking in those days were very different. Soon I became a probationary officer in State Bank of India. In those days, it was supposed to be a very coveted post. The first 2 years are grilling time as a probationary officer in those days. I was posted in a decrypt village branch, but because of the deposit, it was a scale 6 branch. It's a place called Kadalur Old Town in Tamil Nadu. There, most of the men were working in Gulf. It's only the women folk who will be at home. So naturally, they are very afraid to talk to any outside people. Believe me, every Saturday, where it was half a day, the number of withdrawals will be skyrocketing. You will be surprised to know what is the withdrawal amount. 10 rupees, 20 rupees. It is very different that with 20 rupees you can make 1 week full of whatever you want to buy, you can buy for your household with 20 rupees. Since the amount is small, they will all come to the teller counter, give the withdrawal slip. Some of this may be jargons to many of you here. And they will make the withdrawal from the teller. The teller is supposed to make the payment and then put it in the spike. That day I was assigned the teller role. New to the branch as a probationary officer, to train me everywhere, I was put in the teller role. Hundreds of payment. Every household, somebody or the other coming and standing in the queue and taking some 10 rupees, 20 rupees withdrawal. After all that, we all used to sit and write what is called as day book, and then a book called long book. There was no Finacle in those days. There was no computer. And then we used to do the daily trial balance and balance sheet and what is called as P report to RBI. Saturday, everybody will be in a hurry. After half a day, people would like to run home. So if because of somebody that day, the day book and long book are not tallying, they would like to kill him or her. That day, the day book and long book did not tally. We were searching and searching and searching. We found a difference of 20 rupees. So we realized it should be from the teller counter. That means all the guns were ready to shoot at me. And they said, it's too long now. Enough. We will go home. Monday morning, we will come and see and send the report. Ultimately, it was traced to a withdrawal slip, which instead of putting in the spike, I have put it in the passbook and given to the customer. Now, how to collect that instrument back? We know the person, we know the address, we have to go and collect it back. That lady was not ready to come out of the house to meet us. She was afraid. And somebody known, the mukhya of that village was to be told to go and collect. Why am I telling you all this? One, of course, to prevent you from sleeping. And second, is it the banking you see today? Has it not transformed from 1986, I was in that branch. From 1986 to today, how much of a sea change? Today you are talking about a total bank deposit of around 200 lakh crores. I think the number in 1997 for 5 lakh crores. 250,000 ATMs. Digital payment accounting for around 90% of GDP. 165 billion transactions. you talk about UP, SI or whatever it is. Digitalization has transformed the entire country. It is just not deposits and payments, it's also digital credit. I'm told a significant portion is coming as digital credit these days. How this explosion has impacted the economy and the markets, where I am coming from. Settlements in stock exchanges used to happen once in a while. Then it became weekly settlement. And from there it became T+5 and became T+2 and T+1. How was it possible? Digitalization of transactions of banking. How much the speed of a transaction has increased, and how much therefore the rotation of that money has speeded up because of all this. Just before COVID, the number of unique client codes that BSE had was around 5 crores. Today I am having around 18 crore unique client codes in the last 3-4 years. This 12 crore, where has it come from? Only 25% from cities. Where is the balance coming from? Tier 2 and Tier 3 cities. Why and how? Financial inclusion. I'm told that the financial inclusion rate, which used to be 25% in 2008, has become 80% now. RBI's FI index has become 60 point, which used to be 60.1, has become 64.2. Indian insurance sector, I am told, is one of the fastest growing insurance sectors among G20. Fintech industry in India is estimated to be around 150 billion US by 2025 and the third largest. This sector is poised for a significant growth even further. Notwithstanding, already it has grown in a big way. I just told you my experience from a day book and long book to Finacle today, almost all payments digital. People at some point of time are going to forget checkbook. I am sure many of you would have never seen a withdrawal slip. The country is growing. Between the age of 20 to 65, 65% of the population begin to that. The middle class is growing. Consumerism is growing. Therefore, the markets are growing. Many a times we all get surprised. How come this market is growing so much? Will it withstand it? The country is growing. The GDP is growing. The youth percentage is growing. The contribution of youth to the country's development is growing. In the coming days, with more and more use of technology, I am sure BFSI is going to see newer and newer heights. Many of the young professionals here in this room, I am sure, are poised for a very great growth in your career. I don't want to take more time of yours. I thank you very much for patiently listening to me after all this whole day long session, and wish you all a great success in your career. And thanks once again to the organizers for having me here. Thank you.
Thank you, sir. May I invite Sumana Sarkar, the Bureau Chief, Financial Express Digital, to have a one-to-one conversation with you.
Good evening, all of you, and a warm welcome to you once again, Mr. Ramamurthy. What a day it has been, from trying to chart the changes and the transformation in the banking sector to now we have come where we would want to understand from you the changes or our changes in investment strategies for the BFSI sector. And it's such a momentous month for us here in FE also to think that BSE completes 150 years today. So in that journey, obviously the BFSI sector has played a key role. If you could elaborate on that journey.
BFSI sector has just not played an important role in the history of BSE. It has played a great role for the economic development of this country as a whole. I'll give you some figures which will help you to understand that. Banking sector is the second largest sector in the Indian markets today after IT. We have 40 banking companies listed with us. The combined market cap of all these 40 banking companies is $625 billion US. The total market capitalization of BSE has just crossed 5 trillion, as you will be aware. You all should have 100% heard the term Sensex, which is the oldest index in India and probably one of the oldest indices in Asia. 38% of the index is represented by banking sector. Just it is not that which is the role of this sector in BSE's journey. As I told you just a few minutes before, the transition from T plus anything, as what we used to call the settlement cycle, to T plus 5 to T plus 2 to T plus 1, and we are already doing some amount of T plus 0, it has all been possible because of the nice way in which the banking sector has gotten enmeshed with the securities industry. Securities industry also has mutual funds in it. And I was telling somebody before this meeting, the number of folios in mutual fund has already touched around 19 crores. I just told you a few minutes before, the unique client codes in BSE is just 18 crores. The mutual fund folios have touched 19 crores. The amount of money collected through SIPs is increasing every month. In May, it was around 22,000 crores. How was it possible? How it is being done? Mostly by mobile, right? And how the mobile is able to do it? Through digital payment, through the banking sector, which has gotten nicely enmeshed with the securities market. So BSE's role as a market regulator and a stock exchange and a service provider is enabled in a big way because of the digitalization and technological transformation of the banking and financial services industry.
You touched upon retail participation, and if we see the banking index, it's yielded over 23% returns in the past 1 year. In that context, if you could talk about retail interest in the BFSI sector, especially, and overall retail participation in the markets.
See, overall participation of retail in the market has always been high because if you look at it, who are all the various participants in the market? Domestic institutions. That is very easy to say who is a domestic institution. Foreign participatory institutions, very easy to identify. Proprietary trading activity, very easy to identify. Whatever the balance is left, we are loosely calling it as retail. The moment we loosely call something as retail, the image that comes to our mind is the image of a person, the R.K. Lakshman's person, who is standing in the Horniman circle. Is it true? It is not. Whatever you could not classify, you have classified it as retail. Because it was easy to classify for you domestic institution, foreign institution, and proprietary trade. Whatever individual trade was there, you called everything as retail. And you gave a simple figure, which is the R.K. Lakshman's figure. No, that is not retail. Retail is a mix of multiple things. There are very high net worth individuals who trade. And there are very, very small people for whom only one trade at a time. One share, one trade at a time. So it's a mix of a very heterogeneous group of people. And this group of people constitute the bulk. Why they constitute the bulk? Domestic institutions are permitted to trade certain things or not permitted to trade certain things. They trade for delivery. They cannot buy and sell the same script the same day. Same is the case with foreign institutions. So the activity is very limited from these participants. Proprietary trading people generally provide liquidity on both sides by giving quotes on both sides. So who is the other side who takes all the quotes and buys or sells so that the machinery of trading is well oiled? It is that what we so call as retail. So the participation has always been a significant contribution to the market. I don't have specific amount and percentage of retail participation in BFSI sector as it is. But since you touched upon BankX giving returns, let me give you some more additional interesting data. The last 10 years, BankX has grown from 17,500 to 60,500 now. In the 10 years, what has been the percentage growth? The return is almost 246%. If you take Nifty Financial Services Index, which is provided by NSE from public domain data, which has top 20 companies from the financial services sector, during the same period, it has yielded slightly a lesser return, 233%. This shows how the BFSI sector has been growing all along.
So in that context, the other thing that I would want to ask you is in the recent past, we have seen a spree of regulatory action against a lot of players in the BFSI segment. So how do you think these improve the prospect of the sector as a whole or improve the prospect as an investment destination?
I am not able to honestly relate to this question. I'll tell you why. The regulatory actions are regulatory actions. And why regulatory actions happen? When a sector is growing very fast, along with it, the probability of fraud also grows. Fraud takes multiple forms. I'm told that the frauds have increased so much. I'll give some number. The fraud cases has increased by 708%, it seems, in the last 2 years. This is as per RBI data, online frauds. I'm sure every one of you are receiving phone calls or WhatsApp messages. Every third day I receive a phone call from US, +1, right? Dear customer, you have entered into a transaction of 43,200 rupees with your Regalia card ending with a number alpha, beta, delta, gamma. If it is not your transaction, please press 9. If it is your transaction, please press 1. I don't have a Regalia card. Then where I can have a Regalia card with a number ending with alpha, beta, delta, gamma? Typically, what will be the reaction? People will press 9. Then what happens? Somebody comes on the line. And when somebody comes on the line, they ask you certain details, which innocently you tell in your panic, and that's it, your bank account is wiped off. In such a situation, if this is the type of fraud, regulatory actions certainly have to be stringent to ensure there is a control. What is the difference between growth and development? Growth can be cancerous. Development is always positive. So when growth happens, a regulator will be worried that it should not be cancerous and it should be development. So naturally, there will be regulatory actions. I'm not sure how it will impair or impact an investment. If at all anything, that should give confidence to the investors that there is a regulator who is watching like a hawk to see that there is no malpractice happening in the market, and therefore they will be safeguarded. Who will not be safeguarded? Who can never be safeguarded? If an investor thinks that he can invest the following way, he can never be safeguarded. What is that way? Let's assume I am the investor. If I start investing in a stock because my neighbor told me that his friends' neighbors, wives, sister-in-laws, brother-in-laws, grandmother's some brother told that this is a good stock. You know what? He bought it last week at 2 rupees. Today, just in 5 trading days, it has become 200 rupees. So immediately, suddenly, you become mathematically intelligent. In 5 days, if it has grown 100 times, how many working days are there? How much it will grow? And if I put 5 rupees today, what it will be? And then you start dreaming, and you put all your money, and then what happens? You don't find the code for that company after a few months, or few weeks, or few days. And you are told, oh, that company, it has been delisted, or it has been suspended. Then you start shouting up and down, telling, I am a poor retail investor, please protect me. But why you were in such a situation, why you are in such a situation, you have to be protected. You didn't bother to protect yourself, no? That is the type of investor who should be worried. If somebody is not the type of an investor, every regulatory action should give him more courage, that the regulators are looking at it like a hawk. He should make his analysis and invest.
Very true, very true. It's a very interesting day that we are having this conversation here, because it's also a day where many exchanges globally have faced outage. But here in India, especially BSE, it's been a pretty uneventful day. If you want to throw a bit of light on that.
I'm not sure whether it is an uneventful day. It's an eventful day because there were no events. Because everybody else had a problem. Fortunately, we had no operational glitch or anything arising out of this, whatever the Microsoft issue which you are talking about. Some of the brokers who would have provided in their mobile platforms a patch, those clients might not have been able to trade. As an exchange, we didn't have a problem. As a clearing corporation, we didn't have a problem. Therefore, it was a good day for us.
Absolutely. And on that note, you know, your closing thoughts, if you had a crystal ball to gaze, your outlook for the future.
Unfortunately, I consider myself as, if I can use Hindi, if that is okay, I am a chammach in the big banda of kheer. Chammach kheer, which is there in the big vessel. I am here to serve you with a platform. So I don't know what will be the future of the market, and I don't predict it, and I don't comment on it.
Thank you so much for sparing time.
Thank you.
With all your insights. Thank you so much. Thank you.
A big thank you to all the audience. Thank you very much for being with us today. It has been a good day for us too. Thank you, and meet you all next year. Thank you.